All right, welcome back, everybody. Welcome to day 3 of the 2025 TraderLion Trading Conference. Super excited to see you guys here. Let us know where you're tuning in from right now here in the chat. And again, thank you guys all for the fantastic feedback on the prior weekend. And we're going to be continuing the momentum here this weekend with another fantastic lineup. Again, we're featuring market wizards, top educators, super performance traders. There's so much fantastic material as a part of this conference. In my opinion, it really is the best trading education event of the year. So with that said, let's kick things off with today's agenda. First at 9:30 a.m. Eastern, we've got future market wizard Lance Breitstein discussing why more information isn't the answer, which is a great presentation to have at a conference where you're learning so many different setups, so many different methodologies. And this conference is all about, synthesizing, finding what works for you, and some great tips on how to actually do that from Lance. Then at 11 a.m., we've got Lee Tanner discussing a basic growth stock investing system, basically presenting CanSlim and the rules that he follows to identify the greatest winning stocks and manage them correctly. That's a very important second part there. Then at 12:30 p.m., we've got Arora discussing his SVRO entry setup and trade case studies, discussing his methodology and how he manages positions. This will be fantastic as well. At 2 p.m., we've got Vandenbord discussing how to grow assets during uptrends and protect them during downtrends. And then at 3:30 p.m., we've got our very own Nick Schmidt discussing alternative entry tactics and how he incorporates weekly charts into his process. This will be perfect for folks who work part-time and still want to, participate in fantastic trends and, ride them for their full length. Then at 5 p.m., we've got an excellent closer, Tendler, the author of The Mental Game of Trading. He's also the lead educator of the Trading Psychology Masterclass that we worked with him on to create that resource. That's fantastic. And he'll be discussing overcoming overconfidence in the market, a really important topic that will be a great discussion. So let us know in the chat right now, which of these speakers are you most looking forward to? And, if you've got 2 or 3, you can put them in the chat as well. All of these will be fantastic, and I'm really looking forward to hearing all of them. With that said, again, we work very hard to put this together each year. This is now the 5th year that we're doing that, which is pretty amazing. But, we work very hard to keep this free. So if you could help us out by spreading the word, paste it in the chat of your Discord, wherever you communicate with other trader buddies on, on X, on Twitter, wherever, you might help us find another trader. Go ahead and spread the word. You can scan this QR code, and that will automatically post something like this, or you can click the link that's in the chat right now. And again, help us spread the word and help other traders find this resource that we're building. So thanks in advance. And again, help us pay it forward by spreading the word about the TraderLion conference. A huge thank you to NinjaTrader Live for helping power this conference. This is a tremendous resource where they're basically live 6 days a week with live analysis, thoughts, methodologies, risk management. It is a fantastic resource, and you can go ahead and scan this QR code to learn more. Basically, you can tune into NinjaTrader Live for daily futures trading, real-time market coverage, and actionable strategies. And again, I highly recommend checking them out. It's a great way to help support the conference by going ahead and clicking the link in the description or scanning this QR code to check out their platform and all the great education and educators that they have over there. So huge thank you to NinjaTrader Live. I also want to mention that there is a great way to get the most out of this event, and that is the free, 100% free VIP pass. Basically, this gives you access to all the recordings, notes, extra resources that we're creating as a part of this event. Again, this is 100% free. It allows you to access all the recorded sessions because, yes, all these sessions are recorded, and you'll be able to watch them as many times as you'd like to. And I know I'll get this question quite a bit today. Are these presentations being recorded? And yes, they are. And you can actually scroll back on the URL today that you're watching and go back to any point as well. We'll be adding timestamps here, but really to get the most out of it. And again, to get the slides, to get the extra resources, and all the other bonuses here, you're going to want to go ahead and sign up for the free VIP pass, and you'll get access to not only this year's, but also the prior years as well, which is a tremendous amount of material for market wizards, top traders, and educators that you don't want to miss. So definitely go ahead and register if you haven't already. This will also give you access and enter you into free giveaways for TraderLion Masterclasses and Deepvue subscription. So again, you don't want to miss this. So definitely go ahead and sign up for the free VIP pass if you haven't already. All right, I do want to mention a resource that we're incredibly proud to have just created and just published about a month ago. This is the Trader's Handbook. This is our debut book that covers basically building and refining a trading system. Each chapter covers one aspect of a trading system, from entry setups to risk management to post analysis. Everything is covered in this book, and we've got a great bit of feedback testimonial here from Mark Minervini himself. The Trader's Handbook is a comprehensive encyclopedia for investors interested in learning the ins and outs about technical analysis and stock trading in general. Packed with explanations, practical insights, and real-world examples, it also features a model book section showcasing historical stock market winners, highlighting their breakout points, key patterns, and notable price behavior. A great addition to any trader's library, and that's again from Mark Minervini, two-time U.S. investing champion and the author of Think and Trade Like a Champion and Trade Like a Stock Market Wizard. So if you haven't yet picked up a copy, go ahead and listen to Mark and grab yours. We've got over 400 reviews and rated 4.9 on Amazon. So really happy with all the feedback. We've got tremendous reviews out there as well. And I highly recommend picking it up. And not only do you get access to the book itself, which is a great resource, but in addition, by sending us the receipt, and there's info on TraderLion.com/handbook about how to do this. By sending us your receipt, you get access to the free educational course that goes along with it, where we recorded a webinar that goes along with each of the chapters. We recorded several bonus webinars as well, and there's other bonus articles and resources that are in that educational course. So this is not just a book. This is basically your ticket to unlock that free educational course, which is of tremendous value and will really help you accelerate your learning curve. That's what this Trader's Handbook is all about. So check this out if you haven't already. Go ahead on Amazon, read the reviews, see it for yourself, and highly encourage you to pick up your copy. All right, with that said, I also want to mention that on TraderLion.com, we have a ton of excellent free resources. We've got a whole library of free courses. The Ultimate Trading Guide is fantastic as well. We've got the archived TraderLion podcast, educational articles, and much, much more. So again, you can visit TraderLion.com, which is linked in the description, to learn more about all these excellent free resources. I recommend checking out all of these. We've got a tremendous batch suited for anything that you're looking for, from setups to risk management. There's something there for you. In addition, if you want to go even deeper, we work tremendously hard to partner with fantastic traders, market wizards, and trading professionals to create the best foundational courses on the market that go incredibly deep into their systems. You can learn stage analysis from Stan Weinstein himself. You can learn swing trading from Oliver Kell, the U.S. investing champion and record holder. You can learn market, historical analysis from John Boyk, who dove deep into every market cycle going back over 100 years, and really building the blueprint for what creates a successful trader and what creates a successful stock. This is fantastic. Also, a lot of excellent bonus guests that appear during this masterclass, so definitely check that out. And then if you're working on your trading psychology, and Jared will be speaking later on, this is the best resource out there to learn that and learn how to do it practically, and not just think you're working on your mental game, but actually how to build resources and build systems to improve your execution, confidence, and handling of your emotions. So highly recommend all of these masterclasses. I've learned an immense amount from each of these, helping create them, and all of them are currently 30% off during the duration of the conference. So you can visit TraderLion.com/university to access those deals. And if you haven't taken any classes from us just yet, I would recommend the Swing Trading Masterclass with Oliver as kind of your first one. And if you've taken that class, let us know in the chat right now, what did you think of it? Me personally, I know Oliver taught me an immense amount, and creating that class, with each of the webinars being about 4 hours or more, was a fantastic experience that really helped me accelerate my learning curve. So definitely recommend the Swing Trade Masterclass with Oliver. All right, with that said, in addition to putting on this conference and creating this educational resource, we tried to do something good with it every single year as well, by paying it forward by raising money for an excellent charity that we support, St. Jude Children's Research Hospital. We're already over well over $3,000 raised, which is fantastic. And if you've enjoyed any of the conference session so far, please go ahead and donate at least $1. That's my ask for you. It's well worth it. Help us pay it forward. We take no cut from this. YouTube takes no cut from this. This goes directly to St. Jude. So definitely go ahead and donate if you haven't already. I'll be doing so myself. So definitely go ahead and donate if you're able to, and consider a donation to St. Jude's using the donation box to the right side of the stream. Again, even $1 is great, but $5 is fantastic. And with $20 or above, I'll give you a virtual high five. So definitely go ahead and help us pay it forward. If you've watched any of the presentations from last weekend and found them valuable, and you get at least one takeaway, which I know you have, definitely go ahead and donate. It's well worth it for this great cause. Again, just want to mention as well, we don't just put on this conference each year. We work very hard to create the best videos associated with trading education. This includes webinars with market wizards, the TraderLion podcast, educational tutorials, and the Trader's Handbook webinars, which again, each of those covers one full chapter of the book. That's a completely free resource, which you can find on the TraderLion YouTube channel. So if you've enjoyed the conference so far, definitely go ahead and subscribe and check out the rest of the material we put out. We're working hard to get to 200,000 subscribers this year, so you can help us achieve that goal by clicking subscribe. It's 100% free, and a huge thank you in advance. All right. And with that said, thank you so much for attending today. We've got a great lineup. Again, let us know in the chat right now who you are most looking forward to. And we'll be right back with Lance Breitstein in just a second. So stay tuned. Take care. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Lance Breitstein. He'll be presenting today on why more information isn't the answer. Lance is a record-breaking trader formerly at Trillium. He is now an advisor at S&B Capital and the founder of the Impact Competition. Lance, first of all, a pleasure as always to talk with you. I always learn something new, so thank you so much for taking the time, and really looking forward to this. Welcome.
Thank you for having me, and good to be back for another year of this killer conference where there are always so many incredible guests, speakers, where even I myself end up listening and studying. And I am taking a little bit of a controversial take, one that might be the antithesis of this TraderLion conference. So we're just going to send it, and then when I don't get invited back next year, at least I know why. But hey, I've been kicked out of a couple parties before. Nevertheless, why more information is not the answer. So like you had mentioned, a little bit of my background and why my trading mentorship is $10,000 an hour, but I'm giving it all for free here. So I have 100 milli plus in verified trading profits, almost 15 years trading. I was Trillium's top trader, and I set their all-time highest annual P&L. Since then, I have managed and trained dozens of traders. I was running their Chicago office. I am now an advisor to S&B Capital, and I was Wired's day trading expert. To this day, I am still a mentor to many 7- and even 8-figure P&L per year traders, soon to be one of Jack Schwager's market wizards, which is a very long-winded way of saying that I've seen a lot of trading. I've traded at a high level, but most importantly, I have mentored so many traders, and I see what leads to traders failing, why traders don't really get liftoff, and also why traders stall out. I recognize that this audience tends to be more intermediate, more experienced. A lot of you probably have your strategies and your edge, and a lot of you want to achieve that next level. So why is it that so few kind of do? I know that you all are not part of the group that it just doesn't get any liftoff. You are a group that, by the nature of even listening to this conference, you are willing to do the work. You are willing to put in the hours, and that is not most people. Most people do not stand a chance at trading, but you all have already found some success or very much are willing to do what it takes to succeed. So the question I really want to pose and make the center of this whole presentation, What if what we needed wasn't more knowledge or information? And if you think about it, today we are living in the golden age of information. It is accessible, it is free. We now have ChatGPT that can tell us virtually anything. We've got all this knowledge on nutrition, weightlifting, productivity, psychology, business knowledge, trading knowledge. So why doesn't it actually translate? Why is it that the more we've learned about nutrition and healthy eating, we've actually become fatter? We've become less fit. Why is it that the more we've learned about psychology, we've become less happy? This knowledge has not translated into real results. And in trading, back when I started, there was not the just total broad breadth of so much knowledge on YouTube. There was not a TraderLion conference. There were a couple books. The Market Wizard series still existed, but it was not one of those things where there was FinTwit with just hundreds and thousands of good traders sharing their resources openly. So why is it that nevertheless traders still struggle to the same degree? You need to ask yourself, maybe more knowledge is not always the answer. And I think if we reflect on this at a broader level, we see this paradox in so many areas of life today. Like, look at all the self-help books. Over the last 10, 20 years, there have become hundreds, if not thousands of these books. If they all worked, you wouldn't need so many of these. We still wouldn't be short on time. We wouldn't be short on happiness. If these books actually did anything, it would lead to real results. And I think most people know that, guess what? We still are short on time. We're still short on happiness, and we're still caught in the same trap we always have been. And I would argue that more information is not the issue. In fact, it is the trap. And for those that are very astute slide readers, you might notice that some of these words are being doubled. This is a bug in my PowerPoint deck that I can't fix somehow. I tried everything, so I gave up. And I did not want to replicate this. So
you're just emphasizing the issue. Here
I am to talk about the issue, and tell you that the application is the problem. There are dozens of diets. There are dozens of workout plans, thousands of books on each of these subjects. Our knowledge has truly never been greater in all of history. Yet we are the unhealthiest we have ever been. Just to emphasize that point. So there's this myth going on that more info is going to give you more certainty and actually affect your application and your efficacy. And it's all just an illusion. We tell ourselves that if we just mastered one more indicator, if we just had one more expert opinion, or maybe just one more news source, we'd finally have the certainty we would need to level up our trading. This fantasy keeps us endlessly chasing the next information fix instead of facing the uncomfortable unknown of reflecting on what the most effective work we need to be doing is. And like actually doing it, right? How many people might get lost in productivity books, in fitness books, in diet books? When if you're trying to be productive, you need to be doing the hard work. If you're trying to lose weight, you need to be restricting your calories versus what you burn. If you're trying to build muscle, you need to be hitting your protein intake and lifting. And the nuances of your workout plan are far less important than are you consistently doing the actual heavy lifting and getting the protein. So there's this modern trader trap that's going on right now. We have so many amazing podcasts. We have podcasts like Words of Wisdom. He travels the world to meet with some of the best top traders in the space. And it is so produced, much like Diary of a CEO, and they're incredible to listen to. We have conferences all over the country and the world. We have Twitter. We have all of this fully out there. We have more trading courses, myself included, I'm part of this, than have ever existed before. So aren't we all here today to learn more information, to learn more strategies, to learn more indicators, to think how can we expand this? So is this going to actually be what we really need to be doing? Because it's all this fire hose, an infinite supply of never-ending information. And guess what? By this time next year, there's going to be infinite more, and it just increases and increases and increases. But what if all of that information that we think we need to be consuming is misdirecting us from what we actually need to be doing? So here's the truth. More info is more often a distraction. If you're trying to do your technical analysis and the pattern suggests ABC is going to be a breakout, what happens is you start consuming financial news and you hear financial analysts that say, oh, we're expecting this to be weak, or it's downgraded, or it's overvalued. Or maybe you see on Twitter someone that you respect, a good trader, who might not trade your strategy, and they disagree with your opinion. How does that affect your trading? Does it make you better or worse? And the illusion of all this learning is you're actually not really making progress. Each new course, each new video, each new lecture, each new tweet, you think it's going to help you, but are you really actually getting closer to implementing what you're trying to be and achieve? So let me tell you a little story. At Trillium, where I spent pretty much my whole career, there was a trader who would do a lot of things right. He would put in a lot of hours, he would get in early, and he had some incredible edge. He was a good news trader. He knew the headlines that mattered, he was willing to put in the work, and he had really good reaction time. Some of the prints he would get on certain trades were incredible. But he had one big issue. He was never sizing up his trading. And if he wasn't willing to size up the trading, he was never ever going to actually clear his costs and make real P&L. And so he would go on weekends because, again, he was putting in the work. He wanted to succeed. He was willing to do the work and put in the hours, but where his time went was not the effective place that was going to kind of leverage the constraint on his trading. He didn't need more edge. He didn't need more strategies. All he needed was to increase his size and make his trades really count. And so he'd go on the weekend, and what would he do? He would read equity research reports. That looks like work. It feels like work. You're going to an office. How can one deny that this is work? He's clearly doing the work and he wants to succeed. The issue, though, is while it looks like work, he's putting all of his effort into something that is not fixing the one constraint on his trading. It was not actually increasing his size. As a result, I saw him make the same mistakes again and again and again. And guess what? That trader is not a trader anymore. He never was able to cross the barrier despite having edge, despite having trades that many people would kill for. Just couldn't make it. So do you identify as any one of these? Are you the research analyst? Are you ineffectively studying the fundamentals as a way of avoiding the trading mistakes? Are you the strategy hopper? Bouncing between swing trading, scalping. Oh God, I'm sorry guys. I won't punish you with all this. Just know this isn't me. And momentum without mastering, it's killing me. The indicator collector, adding layers of complexity with each new YouTube video watched. Or the expert follower, trying to synthesize conflicting advice from multiple gurus. We feel this sense of knowledge FOMO, but it's still FOMO. The same way we feel FOMO if we're not in a trade. The anxiety is real. What if that next video, that next podcast, that next tweet, that next course, what if that actually has the secret that's going to fix my trading? Just like FOMO leads to impulsive entries, FOMO learning leads to compulsive consumption without actually integrating. Both are driven by insecurity, not being a real intentional strategy. So let me break into another case study. Many know Pradeep Bond. He's done a lot of amazing teachings on episodic pivots, and he's been very generous and public about his strategies and how he executes these trades. That information has been publicly out there for decades now. Decades. There's been, since then, hundreds of thousands of traders that have not succeeded, despite a proven strategy being out there in the public. Meanwhile, many people might have heard of Christian Kualamagi. He is a Swedish trader that took Pradeep's strategies and ended up making, to my knowledge, if I'm not mistaken, over $100 million trading those strategies. I think, again, I don't know Pradeep's full details and financials, but I think he even exceeded Pradeep and has become one of the most famous just traders for what Pradeep kind of pioneered. So what was so different about Qualamagi versus the 100,000 other traders that failed? Then the real question is what Qualamagi did. Qualamagi is why is it that what he did is exactly what my trainer did, exactly what my good friend Greg Shabika, LX21, did, and every elite trader I know, they all have this in common. So Qualamagi kind of found out about Pradeep's strategies, and rather than endlessly consuming the infinite training books out there, he started doing the hard work. He started going back in time, and he started looking at hundreds and hundreds and hundreds, if not thousands and thousands and thousands of charts, annotating them, and figuring out and refining that strategy for him. He was doing the hard work, the work that really hurts your head, the work that when you wake up in the morning, you try and avoid it, the work that you avoid by distractions via trading content. And instead, what he did was he went through all these data points, refined his strategy, and proceeded to just absolutely crush it. My trainer who taught me, he did consume a bunch of trading knowledge, but what really happened was he started going through thousands and thousands of charts, annotating them, and figuring out the patterns over time. Greg Shabika, LX21, he, rather than go to college, he was building swing sets. Over the winter, when he wasn't building swing sets, he started to read about a couple trading books. He started to study charts, and this was before even electronic charting. He manually backtested every single strategy that he was studying. What he wasn't doing was kind of on Twitter. Twitter didn't even exist. He wasn't on YouTube. YouTube didn't exist. He read a couple books, he started to think about this stuff deeply, and he started to do the work. Every elite trader I know has that in common. They were doing the hard work that mattered. They were not getting lost in the infinite amount of content out there. So let's use a simple analogy. Let's say I wanted to become a pro quarterback. Let's say that Tom Brady, Patrick Mahomes, Peyton Manning, they all had courses out. How would you become a pro quarterback as fast as possible? I think a couple things should be obvious. First of all, no matter what path we choose, we know it's going to take work. You know that nobody is going to make it into the NFL without doing tens of thousands of reps, hundreds of thousands of reps. You know they're not going to make it into the NFL without thousands of hours of game time. If you wanted to become a good quarterback as fast as possible, you would not be taking advice from the millions of armchair quarterbacks online or on social. You would not care a thing about what they say, because guess what? They're not professional quarterbacks. You would want to shut out all of that noise on the internet as possible. You don't need to follow every single QB course or every single video out there. What you would want to do was find a couple mentors you respect or that coach you and can directly help your trading. And no matter what, you would still need to put in thousands of hours of work throwing the football, practicing, reviewing game tape, going to the gym, and refining your actual style of play. There is no substitute for that. And no matter what, you're not the same as Patrick Mahomes or Tom Brady or Peyton Manning. You don't have the same flexibility or the same height or the same weight. You have your own strengths and you have your own weaknesses. Nothing can ever replace or change that. You're going to need to do the work and develop your own style based on what makes you great. And so the things I recommend you start to do is you want to choose a few trusted sources. And you want quality over quantity. Identify 2 to 3 sources that align with your style and your time frame. Ideally verified traders with proven track records. You then want consistency. Much like with diets, many work, but most people are not following them long enough to actually translate it into results. You then want to cut out the noise ruthlessly. What do you want to filter? You do not want to listen to financial news commentary. You do not need 99% of the stuff on Twitter and social media. I promise you, Not only is it a distraction, but it's even worse than that for reasons we'll get into later. You also want to cut out a lot of the bullshit going on in the Discord chat rooms. There are productive chat rooms and there are productive comments, but there's also a lot of people just fluffing themselves up, cherry picking their trades, and ultimately distracting you from, again, doing the work and the focus you need to be doing. And then also, look, there's probably 1,000 verified really good traders somewhere out there on the internet. You can't learn from all of them at once. You can't do it, and you don't need to do it, and it's going to be counterproductive. All you need is a couple that you trust to really take you on the path. And you also want to block out anything that's making any prediction about the market. If I've learned anything in my time as a trader, nobody knows what's going to happen. Anybody that's speaking with certainties or anybody that's speaking with confidence that they do know, you're just wasting your time. So then once you have that figured out, you want to do the reps. Same way with the quarterback analogy, there's no substitute for that. So what does doing the reps actually mean for traders? It's doing a lot of the work that Qualamagi and my trainer and I and others have done to find success. A lot of it is chart time. You are going through thousands and thousands of charts. You are studying them with intention. You are annotating them. You are looking at the nuances and figuring out what really matters. You're also building a playbook. And this is a concept I'll dive a little bit more into. But that's just the foundation of finding edge and pattern recognition. There's no way you can get those charts into your brain or find the ones that make sense to you without just looking through a lot of them. The next step, of course, is going to be real-time trading. You want to execute your strategy while building real-time consciousness and build the ability to identify, execute, and capture plays in your playbook. With the quarterback analogy, that's the equivalent of just actually playing a game. You need game time experience because that's ultimately what the job's going to come down to. Yes, you need to do a bunch of drills, but the drills are solely to help you execute in real time. Then as you're doing that, you're going to be collecting data, you're going to be backtesting, journaling, doing your write-ups, watching tape, and refining. The same way as a pro quarterback at the end of each game or any game you play, you're reviewing what you did well, what you could have done better, and you're building plans to work on that. That A, B, and C, that really is like 90% of the work people need to be doing. So to break that down further, the chart collection. Before you build that playbook, you want to collect and categorize as many charts of in-play stocks as possible. If I was starting totally from scratch, this is how I would start. If I knew nothing about trading, if I knew nothing about edge, I would simply be trying to find the craziest charts possible, the most volatile, the biggest ranges, the biggest volume, the stocks making the really big moves. And I would screenshot every instance. I would put them into Evernote or I would put them into Notion. And I would start to organize these charts by different variables. I think most people have a basic idea of technical analysis. So maybe we can group them by breakouts. Maybe we can group them by breakdowns. Maybe we can do trend lines. Maybe we can do moving averages. Maybe we can do some type of mean reversion play. Maybe we can categorize stocks that have all had breaking news on them. Maybe we can categorize stocks that have had massive, massive volume capitulations. Maybe we can categorize stocks that have made 3, 4, 5 legs in a single direction. All of that is going to be the foundation of building edge and the pattern recognition we need to succeed. Then you want to annotate all those variables that made the setup better or worse. For example, is a breakout better when we have more consolidation before the break or less? Is a breakout better when it's the 4th leg or the 5th leg versus the 1st? Is a breakout better when there's breaking news leading the stock to break the level, when there's a catalyst involved like that? Is a breakout better when the market is working with it and breaking out as well? You can only do those studies by collecting all of these charts and going through them. And once you do that and you make those annotations and you start to develop this sense from seeing hundreds of these, you can begin to rank them based on quality. And that ranking, that can change over time. You're going to learn more. You're going to learn what nuances matter. You're going to refine. But just to begin, that's a really solid plan. The next step is you're going to be building your playbook. And I assume a lot of you already have this, whether formally or not. And what this playbook is you take all of those charts and you start to codify how you would capture that strategy, what your exact setup criteria is with visual examples. You want to make entry and exit rules with no ambiguity. What is your stop? What is your out? How are you going to size your position? When should you be larger in the trade? And when should you be less? What are the full risk management parameters behind this trading? What are going to be your pre-trade and post-trade checklists to make sure you're executing your strategies? Those charts and that playbook, that gives you the foundation to trade. With that, you can really start to move into real-time trading. When you're doing the real-time trading, that's where you can start to use stuff like a daily report card to help you focus on one single goal to be conscious about. What is that one goal that's going to make the largest impact on your trading? For that unnamed Trillium trader, the one single goal he should have been focusing on when he went to work was how can I increase my size? Not how can I have more knowledge, not how can I study a different indicator. No matter how much knowledge, indicator, different strategies, or edge, none of it was going to make a difference unless he fixed the one constraint for him, which was the ability to bet larger and increase his size. And he put in so much work, but he never did that one thing. He never did the one thing that mattered to make that trading business a success. And you want to find that goal and then just consciously, relentlessly focus on that goal in real time. And so many traders, I would see them day to day, and they would do what I would call mindless trading. Mindless trading is where you're just going through the motions. You're going to the driving range, but you're not thinking about your swing. You're not making those micro corrections. You're not incorporating feedback after the trade. And I love thinking about the golf analogy as I try and improve my own very shitty golf game. You would think that the more time you spend at a driving range, the better you're going to become. That's actually not true. If you go to a driving range and if you do thousands of the same shitty swing and you reinforce shitty habits and you're not mindful and intentional, that practice isn't making you better. It's cementing the same mistakes that are actually holding you back from succeeding. And so what I really push people to do is when you're in real time, how can we be as conscious as possible? When we're executing those trades, how can we have that one single goal we're working on streaming through our mind, that stream of consciousness? That's what actually makes it deliberate. And again, it's not comfortable. It takes work. It takes effort. It takes intention. It is far more mentally draining to go to the driving range and be thinking about every single swing and making those micro corrections. All of a sudden, the driving range isn't so much fun anymore. It feels like work. And that's because it is. And work is what leads to success. Not fun. Sometimes they overlap and work can be fun. But you want to know what also feels fun is seeing yourself make real progress, right? It's almost that paradox. When you're doing deliberate practice, it's not easy. It's not fun. It feels like work. It's not pleasant. In the short term, it sucks and it hurts. But in the long run, that progress is fulfilling and it feels great. And you're proud of what you've achieved. And so many people fall for that trap of consuming content because in the short run, it feels good. It feels like you're accomplishing something. It feels like you're productive. But in the long run, it leads to pain. And you get to choose your pain. I don't remember where I saw this, but no matter what, there's pain. You get to choose your pain, whether it's short-term pain that leads to long-term gain or short-term pleasantness that leads to long-term pain. And I know which one I want. So then once you're doing this real-time trading, you then move on to the data collection and the back testing. And obviously all of these to some degree eventually run in parallel, right? So you want to be tracking your win rate, your average win and your loss, and your expectancy by setup type. There's so many traders I know that are working really hard, but they don't collect this data. And so they don't really know, are they being as effective as possible? Are they doing the work that's going to really get them to that next level? Without data, you're kind of flying blind. One story that I always like to tell about data collection is when I was running an office, I had some trainees, and one of the trainees was trading every single IPO that came out. And after another shitty IPO that he lost money in, I said to him, like, hey, why the hell are you trading all these shitty IPOs? And he said, well, I've got my data. I make money in IPOs. I make $20,000 in these IPOs. And guess what? I also knew his data. And so at face value, factually, that was correct. He does make $20,000 trading these IPOs. But he hadn't done the hard analysis. He hadn't done the hard work and really studied that. Because if he looked one level deeper, what he would recognize was he makes $50,000 in the 3 hot IPOs and then proceeds to lose $30,000 in the 7 not hot IPOs. And that one piece of knowledge, that has all the leverage. Because guess what? If you start doubling your size and increasing your size in all IPOs and you get 7 shitty IPOs in a row, all of a sudden you're a losing trader and you think you don't have edge and you're on the exact wrong path. But with the right data and the right change in the right spot, if you start cutting out the shitty IPOs, you only trade the hot IPOs and then you double your size, guess what? You just went from making 20K in IPOs, you're now making $100,000 and you've got a career. And so that data is so important. And so I study the data of my trades and my strategies, but I also study my own performance data, the ratio of positive days to negative ones, the average winning day versus losing, the profits by the setups, and the variables that impact your trading performance. You want to know a piece of data, couple pieces of data that enormously impacted my trading, but that weren't found in any podcast I've ever listened to? The 2 most common places that I lost good chunks of money. It wasn't FOMO, it wasn't on tilt, it wasn't because of some indicator. It was going through my own data and finding out that if I was ever hungover, sick, or tired, I was taking my biggest losses like almost every time because of one of those 3 reasons. Another sneaky place where I was taking big losses was the day before vacation. If there was a long weekend or if I was going on a trip, I eventually studied the data, which is not fun or enjoyable, and I learned, oh my God, so often the day before vacation, I'm letting my guard down. I'm halfway mentally checked out, and as a result, my data is awful. And those are very easy changes to fix. All of a sudden, it's something as simple as, hey, guess what? The day before vacation, I'm either just way sizing down, I'm having a tighter daily loss limit, or I might just not trade at all. And all of a sudden, you're saving huge amounts of money for very, very low effort. And that change works into perpetuity. That's a lot of ROI for a very simple change. But I've never seen anyone say that in any podcast. That was just unique to me and my data. And so that requires you to spot trends and figure out, when do you trade at your best? When do you trade at your worst? And what plays do you need to size up or down? But the truth is, you're not going to find that answer from anyone else. It is unique to you. And so much of trading, at a high level, the principles are common, but in the actual application, the answers are all within yourself. The other part is you want to be journaling and doing write-ups to capture each day's lessons. Record what matters, learn from yourself, and figure out, why did you miss your setup? Why did you hesitate? One thing I find amazing about missing trades or over trading or FOMO or tilt, there's a lot of reasons why people overtrade. In fact, I'd argue there's infinite reasons why people overtrade. There's infinite reasons why people hesitate. There's infinite reasons why people miss setups. I can give you maybe 10 of the most common, but ultimately the only person that can figure out the answer for you is you. And so that requires you doing the journaling and recording your thoughts, you recording your emotions while they are as fresh as possible. To do some of that journaling, I use a format that I call the daily report card. All of that is totally online and free if you just Google it. And the same for my trade write-up template. And I recognize not everyone works the same way. There's some people that are less systematic. They don't do the write-ups. They don't do the daily report cards. And you need to find out what parts of this method work for you. how can you make it sustainable so that this is something you can do for the long run? So you might be asking yourself, what does this most commonly end up looking like at the various stages of development? First, I want to tell you a story and a lesson with it. And really that lesson comes down to always studying the outliers. When I hire people, which I guess I don't really hire people anymore, but when I hire traders, I would tell them that the learning curve was at least 2 years. If you were not willing to commit to a 2-year learning curve, you might as well not even get started. And I think for many of you, you would recognize that is true. And that's for a full-time trader. If you're doing this part-time, if you're doing this with a job, if you're doing this without proper mentorship, if you're doing this without proper resources, the learning curve's even longer. And like I said, if you're trying to become a pro quarterback, you can't just magically find some shortcut and become a pro quarterback in 6 months. Nevertheless, sometimes there are outliers. There are outliers that find very high levels of performance in very short amount of time. And we need to study those. So let me tell you a little story about someone I mentored last year. He was about 1.5 years in, and he made over $1 million in 2024. How's that possible? Many of us would want to say luck. And truth be told, I actually, that was my first assumption as well. When he wanted to work with me, I was like, oh boy, we've got someone that ultimately is likely still a beginner and probably did this with a couple YOLOs, as the kids would say. And we did this call, and I was dead wrong. There's always going to be a portion of luck, but what he did was actually very much legit. The reason why he succeeded and the reason why he did so much better than traders with 3, 4, 5, 6 years more experience was because he found what the best plays of 2024 were. He found what the themes were, and he followed a very basic system that I had kind of just taught openly online, and he followed that. And so there were trades like last year, the Tesla 360 breakout. And there were trades like that, and he trailed it using prior bar lows, not even for a lot of size. Couple thousand shares. But there were some times where that would work really, really well. He was in the right themes with the right system in a momentum market where swing trading momentum was insanely effective. So he was catching stocks like Tesla, making its 80-point plus move and trailing it. He was catching stocks like MSTR, and he was catching breakouts like the quantum names. And all of these were replicable, easy to learn patterns. There was nothing crazy complex. Essentially, all he did was identify that this is the market and the type of style that has been working for 2024. He built a system to spot these setups, and he executed, and not even for crazy size. You know, you're talking, if you do 5,000 shares of Tesla, which was towards the back end of the year after he had been kind of growing, 5,000 shares of Tesla, the way that broke out, that might even be 25 to 50 grand of risk. When that goes, 80 points or something, you make $400,000, right? And this is a trader that the prior year was kind of negged to, nearly nothing. Same with the quantum names. You were able to swing some of those trades, and that was what was hyper in play. So yeah, there's always some degree of luck, but what he did was he found the areas that offered the absolute most leverage to him. And guess what? He didn't need news sources. He didn't need equity research. He didn't need a zillion indicators. All he did was figure out the most effective way to capture the simple setup. And he didn't even use a lot of size. And it was scalable. There's no reason why the million he made couldn't have been 10 million. It really could have. And so anytime I hear a story like that, I always try to reverse engineer, right? For many people, it is just luck. For some people, it's not. And you need to always find the signal. What was this person doing that's so powerful that allowed him to do that? And so here's what I think are kind of the high leverage points at each stage in a career. In the beginning stages, you absolutely do need to explore in this stage. That's when you should be open to different ideas. That is when you want to find the right mentors, the right sources of information. That is when you want to listen to this conference and absorb like a sponge. Content absolutely has its place. Also during this stage, you want to be building databases of charts. You want to be collecting the data, testing hypotheses and different strategies, consuming content for practical application of these strategies, figuring out your indicators and your ideas, and also finding a trading pod. In other words, people that you can learn from and they can accelerate your learning and help boost your strengths and minimize your weaknesses. This exploratory stage is when you're doing exactly what Qualamagi did, exactly what Greg Shabika did, what my trainer did, and I did. And yes, to even find what to look for in charts, it requires someone that's laid out the path. You do need to follow. It does help here to study what the greats have done, to study what all the really good traders as a part of this conference do to find their edge. But here's what it doesn't look like. You don't really need to be reading books on psychology at this point. Psychology, like you don't even have edge yet. You shouldn't even necessarily be risking capital. There shouldn't be FOMO, tilt, and all these other things. You don't want to be just bullshitting on Twitter, meandering aimlessly. You really, really, really want to consume content, but make sure that if you consume the content and it has a use, you're testing it, you're collecting the data, and you're making it applicable. At the beginner stages, that's the real work you need to do. At the intermediate stages, this is perhaps when content can be most harmful, if not moderated. At these stages, you want to be drilling deeper on your edge and refining your strengths while minimizing your weaknesses. What does this look like? Refining the variables and setups. What makes your best setups great? What makes your worst setups not great? You want to be building a risk management framework. What is your daily loss limit? When do you need to be sizing down? When do you need to be sizing up? What is the right amount of risk to risk on certain days that are more opportunistic than others? You want to be figuring out how to spot more of your easy money trades. Something many people way underestimate, especially if you're starting to be profitable. You want to find, how do I capture every single easy trade in my playbook? It is not acceptable to miss your easy money trades. Then, often what provides the most leverage once you have that edge from the beginner stages, you need to be prudently increasing your size. You need to be removing the low ROI strategies and maximizing the best ones. You need to be watching tape to enhance your edge. What that doesn't look like is once you've found edge, there's no point anymore floating from strategy to strategy if what you're doing is working and in play. You don't want to be changing timeframes. You don't need to be adding indicators right now. And most of all, you don't need to be comparing progress to others. You need to be focusing on your work and your edge and further watering the plant that's already starting to sprout because of the hard work you put in. And one thing that I'd like to emphasize is in the early stages, you want to explore. But once you find something that is promised or starts to work, that's when you want to drill deeply, not broadly. And what I would say and remind you all is that the jack of all trades makes $0. The master of one trade makes millions. And so when I was first learning from my mentor, he was a master of a couple strategies, actually even many strategies, because he had been trading for over a decade. And I was trying to learn from a fire hose. I was trying to learn all of his strategies at once. And so let's say in trading, to make money at a strategy, you might need to be a 6 out of 10. I was a 3 out of 10 at a bunch of strategies. I was making no money. But there was one strategy I started to really study and hone in on. It was trading exhaustion gaps. And sure enough, this play kind of panned out, and I was able to short Tesla. And at a time when I was normally making $1,000, I made $10,000 in that one trade. Now here's the thing. My boss made hundreds of thousands of dollars in that trade. And that's when I realized, forget every other strategy that I'm currently a 3 out of 10 at. If I just get good and become exceptional at this one strategy, I can have a career at this job. And so guess what? That same exhaustion gap strategy, that strategy in 2024 probably made me over $5 million. And I did other things in 2024, but had I done nothing else, that is one hell of a career. And there's people like Qualamagi who's made $100+ million doing one or two strategies, but doing them really, really, really well. So that depth is more important than breadth at that intermediate stage. And those most successful traders, they specialize ruthlessly. It's a small set of setups that they recognize instantly. It's a time frame aligned with their personality, and it's a risk approach that fits them. They go narrow and deep rather than wide and shallow. And what you might also realize is nothing I just discussed is based on anyone else. It doesn't matter how much another trader risked. It doesn't matter how another trader traded it. All it is about is you finding out what works for you and drilling in deep to make it work. In the advanced stages, often the lowest hanging fruit here is continuing to maximize your size. You want to spot more setups and ensure you are mentally and psychologically at your best each day. So what does that look like? That means further pushing your size, journaling, potentially now working with a trading psychologist because there's probably ROI there, optimizing your sleep, automating strategies and systems to capture all plays in your playbook. Then, if your plays aren't in play, that's when you can potentially be adding on new strategies while continuing to refine your risk management. What that doesn't look like is falling into the knowledge trap, consuming content rather than executing your best practices, or endlessly game planning low probability events. What you really want to do is just be pushing that size. You don't need to obsess what others are doing. You're playing your own game and you're successful at that game. And it's time to maximize it. Then at the elite stages, the lowest hanging fruit here is about maximizing the edge you've already built. That's where you're elite at a strategy. You're making millions or tens of millions out of strategy. And the question becomes, how can you expand that strategy to maximize its expected value? How can you expand to different time frames, potentially with more liquidity? How can you automate this process so you can do it at all hours of the day, across all markets, across the globe, across different products itself, and build processes to do that, as well as optimize your psychology? Most important in this stage is you don't need to be comparing yourself to others. You don't need to be drifting into areas outside your expertise. I see so many elite traders that are exceptional at what they do, and they see other people finding success elsewhere, and they drift into their strategies and they lose their core competencies, whether through boredom or through FOMO and tilt or whatever else. The psychology game is what ends up beating elite traders more than anything else. So everything I've said here, how can you then supercharge these practices? First of all, mentorship. Having direct feedback from someone that is a pro is infinitely more valuable than all the noise online. Any person online does not know anything about your specific situation. All the time on Twitter, I get people asking me, should they quit trading? Should they stay with trading? Should they risk 1% of their account? Should they risk 5% of their account? Should they expand strategies, or should they refine their best one? Guess what? There is absolutely no way I or anyone else can answer that question. I don't know anything about these traders. And guess what? Anybody that's ever speaking to you in a mass-produced online format, no one can speak directly to your situation. But if you get mentorship you trust from someone in your trading pod, or from someone that has walked the path that you've walked, similar strategies and everything else, they can give you that feedback. They can help accelerate your learning. And all the pros that I've seen do exceptionally well, every single one of them has had mentorship in some format. It can't be understated how much faster you can move, right? If you look at any good athlete, if you look at any good quarterback, golfer, if you look at a power lifter, a bodybuilder, they all have coaches. Even if they're technically better than their coaches at their craft, they still have coaches to help guide them and refine them. That feedback, that learning, and that accountability is unmatched. The other thing that I've found is every single person that has an outlier output, and it's not just in trading. If you look at someone in the podcasting space, like Mr. Beast, if you look at Lex Friedman, if you look at Huberman, these are people that their output punches way above their weight class. And the reason why is if you look at their routines, they're making the space for the real deep work. 1 hour of deep work is easily at least worth 10 hours of consumption. So a lot of these people, when it comes down to getting the work done, they're turning off their phone. Even if they have massive social media presences, they are getting off social media. They're using apps like the Freedom app to block distractions. And what I've personally found to be my number one hack for actually having high output and doing the hard work is ever since I was a trainee, I would block out 2 to 3 hours of deep work on Sundays. The market is closed. I'm not getting emails. I'm not getting text messages. Sunday mornings are by far my most effective, refreshed time when I can just hammer out hours of work that actually move the needle. There's nothing pulling me in a million directions. And that work is so, so critical for all the times when during the week you are distracted. The other thing, touching on this social media stuff and how poisonous it is social media really distorts your psychology. And I see this all the time. And I've done pieces on this, but I can't stress to you. The data points to me being one of the best traders in the world. Objectively, I am a good trader. I think that's fair enough. When I spend time on Twitter and online, I feel like I suck. I feel like I am poor. I feel like I'm missing so many opportunities and so much money. And if I'm feeling that, everyone else out there stuck in that social environment is just being ruined. I have every process in place to focus on my strengths, and I still feel that toxicity suck me down. And I recognize this because I have an inside view. I know so many of these people posting this stuff. And what you see, first of all, is survivorship bias. You only see the winners, never the thousands who failed. Anytime there's a really, really good trade, do you want to know, first of all, if someone's still posting on Twitter, think about this. The people with the most followers are the people that by definition have been around the longest. They've only been around the longest because they've succeeded. They've found success. You don't see the thousands who never even reached that point. The other thing is, even for these successes, every single person cherry picks the trades and comments they share. Trust me, everyone. You should always be asking yourself online, if I'm seeing a P&L, if I'm seeing a trade, if I'm seeing a chart of executions, why am I seeing this? Even if they're a 100% legit trader, people emotionally do what's most comfortable for the internet likes. People are not readily sharing their losses. They are not sharing their mess ups. They are not sharing the stuff that comes embarrassing. No one ever highlights their tweet, hey, look how wrong I was on this market call. What they say is in a whole Discord of, just spamming bullshit the whole day. Look at the 3 things that were right in my private Discord, and now I'm going to share it on Twitter. Look how good my calls were. And here's a fascinating thing. There is an incredible trader I know. He is one of the best in the space. He crushes it. There were months where he didn't crush it. You will not see those P&Ls online. The P&Ls weren't shared. Where were they? But when he does do well, you see the massive P&L. And that isn't necessarily malicious. It's not necessarily malevolent. It's simply because it's just psychologically more comfortable to share the good times, and you're incentivized to not share the bad, psychologically and emotionally. And so even for the very best, that dynamic exists. How do you think, all the other people, even less than them, are doing? You think they're not taking losses? The other thing I would say is ultimately none of that is actionable or emotionally productive. How much of the hours and hours you spend consuming social, consuming YouTube, consuming books, consuming blogs, how much of that is actually actionable for your trading? Will it make a single difference? You want to really reflect on putting time in to improve, not for the dopamine fix. Busy does not mean progress. Here are some of the signs you might be stuck in that consumption trap. Are you always buying new courses and books? Are you not finishing or actually doing the data and the testing and the hypotheses of the work you previously started? Do you spend way more time on YouTube and Twitter than actually doing the hard work, the backtesting, the chart studies, the self-reflection, the journaling? What you want to be doing is you want to pick your lane and you want to build in silence. Choose your strategy, one that makes sense, one that you have data, and commit to it. Block out the conflicting voices and the approaches. Log the screen time, studying your patterns. Develop in isolation without external validation. And I still count that as with a pod. Like if you can still work with a team together, just block out the rest of the noise. The real measure of progress and if what you're doing is working is your equity curve growing over the long run. That's how you judge success. It doesn't matter if anyone else is finding more success or less success. You're here to play your own game. And a lot of this comes down to iteration. You want reps over reads. You want to figure out the principles that are working for you, the time that's leading to a high ROI. You want to be implementing these changes immediately, not next week or next month. You want to be reviewing your results and then refining and iterating again and again. So many of the best traders I know, they have the fastest feedback loop on when they study their trades, they figure out the problem, they propose solutions, and then they iterate a plan to implement that. It's this boring work that actually makes great traders great. Think about the Kobes, think about the Steph Currys, the LeBrons. Those are not the people just bullshitting on YouTube. Those are the people that are at the arena hours before warming up, doing their same practice drill. They're the ones at the gym. They're the ones recovering. They're great because they're putting their time in the real stuff, not into the stuff that just gets you caught up doing bullshit. The greatest people in the arena are the ones performing and doing their best, and they're not focused on what the people outside the arena are saying or doing. So my challenge to you all, spend 1 week and track where your work time gets allocated. Take the time to reflect on what one improvement to your trading would have the best ROI. I can't tell anyone what that improvement would be without looking at their data. And guess what? You are the one that needs to do that deep reflection. That's the hard work that people avoid. You need to break it down and build a plan for how to execute on that improvement and systemize that improvement into your daily routine. If you haven't read Atomic Habits, that's one of those books that actually matters because it's actionable and it tells you how to systemize this stuff into your routine and how to construct an environment that blocks the noise, blocks the distractions, and maximizes the odds of you hitting that routine and seeing the progress you want. So that kind of begs the question, should you stop consuming other info? Not necessarily. Like, look, I get it. We're all human. We all enjoy the podcast. We all enjoy the Twitter feed. We all enjoy the scrolling. We all enjoy the trading books and the self-help books. I absolutely do consume this stuff. But here's the most important 2 points. I consume a lot of this content, but I don't consider it to be true productive work. I recognize it as entertainment that might have new ideas and inspiration or be motivational or emotionally empowering, but it's not the true productive work that's going to make the big difference. And so it's okay to engage with this content, but do not let that content distract you from doing the true deep work that needs to be done. It sounds so cliche, but every single day, whether it's for my trading, my businesses, my health, I have my list of the most important things I need to do that day. Maybe it's studying a chart. Maybe it's backtesting something. Maybe it's building a filter. Maybe it's a certain piece of content. Maybe it's going to the gym. I have my list of the 5 or 6 things I need to do that day. Without fail, I hit that list every single day. If I want to bullshit and watch content and consume after the fact, that's fine. But no matter what, that list gets hit. So let me tell you another story. As part of my daily report card, I have my little 1% improvement idea. So every single day, I would not leave the office unless I wrote down a 1% improvement idea that would make me a better trader the next day. And so no matter what, for years and years and years, I was making sure I was hitting the most important things that were going to make me better. And I was not leaving the office until I did that. Once I left the office, hey, fine, I can do whatever with my time. But that did not happen until the big ROI stuff was coming first. When that compounds over years and years and years, that's how you end up an 8-figure trader and not just mediocre, like many fall into the trap of doing. So with that being said, if you found this presentation to be dumb and useless, ignore everything I mentioned here. And instead, follow me on YouTube, Twitter, Instagram, and TikTok. It's endless. The options are literally endless of where you can consume this content. And ultimately, thank you for listening. I know this was a controversial topic. I know this was not part of the magical secrets many might have wanted. It's because I don't have any more of those secrets. I've told so much of my strategies, my views already. But I think it really comes down for many of you seeking that next level to do the hard work for you.
Lance, first of all, thanks so much. And, I think, this was a great presentation. This is, I think, perfect, because we always kind of say here on this channel, especially with the conferences, where there's so many different perspectives. There's day traders, there's swing traders, there's position traders, there's people who are more on their investing side. Take what you find useful, test it out for yourself, make it your own, and ignore everything else. So I think with all these different perspectives that are shared, what you said here is really important and relevant, that you want to make sure that you're focusing on improving your process, your system, and you can find little bits and pieces to take from others. But at the end of the day, you have to put in the work and put in the productive work and make it your own. So I think, first of all, thank you so much for this. To start with, I want to kind of use maybe an example of a trader who wants to master your right side of the V setup. What would be your process if you're starting completely new in terms of finding historical examples, studying that setup, trying to build conviction and confidence in executing, that specific entry tactic?
Whew. That was a good water break, actually.
Yep.
So yeah, and I think this is important, right? So let's get granular with this. What you're referring to is my concept called the right side of the V, which is essentially like, okay, if a stock is panicking, rather than buying on the front side as it's going down, 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 you want to wait for the turn, and you can buy at the same price, but your expected value once the turn is in is better than on the front side when the turn isn't in. And so the most common question when people hear about that concept is they say, how do I not suffer death by 1,000 paper cuts where I just get chopped up every time the stock goes like that? And so what I say is you need to find the most extreme examples. And so if somebody wants to study the right side of the V, what you want to do is really almost on any time frame, but ideally on the time frame you're most focused on. Step one, let's start collecting charts. Can we find some type of stock filtering software? So I use stockfetcher.com, which is absurdly cheap. I don't think the price has gone up in the 15 years I've been using it. I think people could do this using ChatGPT encoding or whatever filter they do. But the first step is how can I build a filter that can help me spot these setups retroactively so I can backtest them? And then you want to find the most extreme of these setups and just simply collect the charts. Collect the charts without biases. And then start to provide context to the chart. Was there any breaking news that happened? Was there anything going on in the market? Was there anything going on with similar comparables? And you want to build this database. And for something like a big capitulation right side of the V chart, you can find hundreds of those. In fact, you can find thousands of them on all sorts of time frames and over 10, 20 plus years. And one thing I love doing this exercise too is you will find that this concept and this type of capitulation trade has existed since as far back as the data goes. I've seen this chart pattern pan out in 2008. I've seen it pan out in 1987. The concept, a lot of these principles are universal. And what you can do is collect all those charts. And once you have those charts, start to synthesize like, okay, what makes this the best, okay, like the sharper and bigger the move, the higher the volume upon the capitulation, the more legs we've gone down. And you start to find out what the best charts were. And you can even just purely reverse engineer it by saying, like, which ones bounce the most after? Why? Like, is there any logic that's kind of universal as you start to suss that out? And what you then want to do is figure out what system would allow me to best capture this. And you can test things. Like, I'm a big fan of just in something that's trending or counter trending, using the prior bar lows. And so you can run a back test or just manually crunch some data or just use your eyeballs and say, what happens if I use prior bar lows as a stop? What happens if I use a 20 period moving average? What happens if I just hold for 1 hour, 30 minutes, 2 hours, 2 days, 1 day, 5 days? What happens over time? And you collect all these back studies, testing different entries, testing different exits, testing different price targets, different stops. And overall, you're then building a system by doing that work. And so I think that's the type of hard work where, like, yeah, you can spend years looking for a strategy or years reading books on trading strategies. How many people have really done a project like that and just gone really deep into the data? How many people have in their Evernote or their Notion 200 plus charts of big panics? But that's a lot of the work that people need and should be doing. And look, I guarantee you there's a zillion other speakers as part of this conference that have given incredible strategies and examples. And what you want to do is you want to find out, right, like a productive task is go through this conference and write down every single case study, every single strategy that people present, and then make it a project. How can I find 20 more similar charts, and how can I backtest those? And that's how you go from consuming content that's inactionable to making it actionable and relatable to your trading.
Yeah, that's a really great answer. And I'm glad that you mentioned context, not just looking at the chart itself, but getting more of the context. I think AI and ChatGPT is really helpful for this. I love, you can, if you find a chart that had a capitulation day, say, hey, what was the news on May 8th, 2013 for this stock? And it makes it so much easier. You used to have to go to the investor news on the website and go find that day or whatever, but AI has helped that immensely. And one thing I did want to ask you there is, after you've done that study for quite some time, maybe you've done it for months, year plus, what are some signs that traders can use as, maybe milestones to help build their confidence to say, hey, all right, you're starting to have depth in the setup, you're starting to really get it. Maybe they've started taking trades and that's working for them. But what should some traders be looking for to say, hey, you're on the right track, if you get my meaning?
Yep. So I think what you inevitably need before you start trading and risking capital, and I think even experienced, advanced, elite traders end up putting capital at risk far more quickly than they should. And the holy grail is you find data tested upon a set of rules that has positive expected value. And when you look back through, even if you just have 5 charts, like there's going to be strategies where you don't have 200 charts of data. You might only have 3 or 4 examples. But the question is, if you follow that rule set, does that data point to you making money? If so, you can start to test it in a real world environment. And then what happens, because the reality is a lot of this stuff can happen in parallel, is you look for more examples going backwards at the same time that you're spotting and filtering and screening for these opportunities going forward, and you build this database up over time. So you might only have, like, one analogy I'll give is CPI in 2022, when all of a sudden inflation was a big deal. I always tell the story of CPI, to me, was one of the hottest trades of that year. And towards the end of the year, I had a lot of traders that I would mentor, and they would say, I'd say, hey, why aren't you getting involved in this? They would say, I don't have enough data points. And my response would be, well, yeah, like, CPI hasn't moved the market for, at least a decade. No one has these data points. If you're going to wait for 50 data points, it's going to be too late, right? And what ends up happening is you might get a couple data points, and then you start to forward test, and you test it in real time. And if your hypothesis and your data starts to work, you gradually, prudently start to size up. But guess what? When a new strategy becomes in play, or when something new happens, there's not going to be necessarily content you can consume that's going to give you those answers. What was the playbook for trading, the tariffs in April? Well, guess what? You needed to study 2018 and the tariffs then. What was the playbook for trading oil on the recent war in the Middle East? Well, guess what? You can go back to October 2024, and you can go back to, I think it was 2019 when the Houthis hit Saudi Arabia's Abqaiq. And guess what? I've never heard of a single podcast or lecture or tweet giving me that information and that data. But that's the hard work to find the comparables and then also, build that framework going forward.
Excellent. And one other thing that's kind of similar to what you've been discussing that I've seen you do that I think is a great exercise is it seems like from what you've tweeted out, each month you go back and see what were the best opportunities of the month. And I don't know exactly your process for reviewing those, but I've kind of adopted that. I do it on a weekly basis and monthly basis a little bit as well. But yeah, maybe talk a little bit about that. What do you do to collect those opportunities to study later, see if you caught them, see if you missed them, and how do you analyze them further to in the future, take that study and improve your trading?
Yep. And so what you're referring to is pretty much, I don't know, towards the beginning of each month, I do a tweet, and it's been going on, 2+ years now, where I tweet what I thought were the best opportunities based. And again, this is all based from my perspective. I know There's traders out here, and this is so important. Like, there will be traders out there that do not trade a single trade that I think is great, and I don't trade a single trade that they think is great. And that's fine, right? It's just my perspective. But I compile that list. And so what I do is over the course of the month, I'm taking this list proactively, which is useful. And then the benefit of a trading pod is I will then, at the end of the month, reach out to a couple of my trader friends that are kind of similar styles. Not exactly the same, because if I get exactly the same list, it doesn't help. But people that are like all within my wheelhouse. And I ask them, hey, what's your list for the top ops? And I review theirs. And there's some times where it's like, oh, wow, I didn't even see this opportunity, or I didn't even think about this that way. And I'm like, wow, you're dead right. I really need to be studying this. And it's such a low time commitment way to really hone in on, like, what are the 5 to 10 opportunities I need to really study and database and write up from this month. And another great best practice is if you have a trading pod where you do this work together, you should just do a review together, each going through your list and why, and present it. And what I would also say is when you get a couple of really strong traders, if there's ever strong agreement, wow, this opportunity was really good, that's big signal. Like, I think most 7 and 8 figure traders I know, they all thought Circle was the stock of the month last month. Right. Guess what? Like, okay, that's a sign that I need to really study Circle. I tell my followers, you need to really study Circle. So I think that list is a very high ROI way to direct your attention to the right spots. And it doesn't take much effort.
Yeah, let's actually use that as another example. Say you're going to study Circle more. What would be the process you would do? Would you go day by day on your time frame and see what were the opportunities for your system? Do you look at the outside news and context that came about with that IPO? What theme it was in? What would be your process for really doing a deep dive on that setup and opportunity?
Yep, and so this is such a great question because even like we always have more to learn. And so I was doing my monthly review for some of the videos I make, and Circle was the big ticker. And so I did exactly what you said, where I'm like, okay, like Circle was the ticker of the month. Let me just purely look at this with no biases and figure out what were the really big opportunities. And as I started to go through day by day, and I mean, I'll look at a daily chart, then I'll zoom in on the days. And that raised a very important point where I was like, wait a second, Lance, like, no one's talking about one of the best trades. And Lance, you weren't even thinking about the best trade. The IPO priced $61. Or
Yeah, I
sorry,
saw
the
that.
IPO priced $31.
Right.
It opened at what, 80 something? Like, how many traders recognize, like, oh wow, like, first of all, the number one original opportunity was, can I get an allocation?
Right.
And guess what? For many traders, you actually could have. This was not that crazy hard to get an allocation to. There were some places you could have got that. And even if you can't, it's at least worth being mentally open and asking these questions. Okay, no, can't get an allocation, fine. At least I checked that box. Then on IPO day, I study the IPO day. I've got a database. I've got a database of, I don't know, it's probably 100 plus IPOs at this point. Again, mostly the hot ones, not the shitty ones, because but I know that it's abnormally likely that IPOs make a strong opening drive. It's also abnormally likely that if they make that strong opening drive, a lot of them then have a really nice counter leg. That's play 1 and play 2 for me. Another common play in IPOs is some of them then end up range bound for most of the day. And I'm hands off for the most part. And that alone saves me a lot of money. Then a lot of those tend to break out at the end of the day into the close. And that play can be incredible and follow a ton of momentum into the overnight. And so then you play the breakout and then you play the overnight trade. And so just on that one day, and Circle ended up staying range bound. But when I do that study, I'm observing all this. I'm looking into my database. I'm adding one more chart to that catalog.
Right.
So that's part of it. And then even there was the day it ended up having options, which was a couple days later after going up massively a couple days. There was a play there I did selling options, which then kind of, it's a way to short the stock when many players otherwise can't. Many players who are locked up might be able to hedge their stock using options. And so we did have a move. That was another potential interesting play. We then had a technical daily swing where we don't pull back too much. We have a shallow pullback. We start to curl higher. Then boom, we gap above the breakout level. And we then start to consolidate. And there's a swing trade. I think the price was above 140 or so. Then 2 days later, we have the stablecoin legislation. Coinbase and Circle explode. So now we have a news catalyst that this is breaking higher on. And the funny part about all this is, well, with that news catalyst, we then have a swing trade where we hold prior bar lows for a bunch. And the best part of all this is I'm telling you all of this right now, and I don't have a single chart up. Why am I able to tell you this? I'm able to tell you all this because I put in the hard work. Nobody out there is doing that hard work for me. I've not been able to download a podcast or a tweet or this that walks through all the detail that I studied on my own, going through bar by bar and dissecting all these opportunities and knowing that stablecoin legislation, we then had day 3 into kind of a euphoric exhaustion-esque play. Then we had the next day the $245 buyer, and that was kind of the money shot on the short once that buyer broke, and that set up a swing short. And so all of that is all in my head from doing the really, really hard work and studying it and going day by day. And this is as someone that has been trading almost 15 years now, someone that is not really the active trader they were. And so then if you're in the trenches trying to make this a career, that's the hard work you got to be doing. And there's no substitute for that. You can't get that without going through these charts and having that mental database, because I have 100 plus IPO charts. I have 100 plus charts of all these patterns. And that's what leads me to have the success I'm able to have.
Yeah, excellent. And I think that process is extremely valuable. One question I did have for that is, how do you capture kind of the intangibles surrounding a case study, outside of the price action? What information do you like to capture related to the theme that the stock was in when it makes a move, or the newscast around it when it makes a move? Because again, sometimes you have to go hunting a little bit more for, what made Circle so special in the first place. Why would you be looking to get an allocation early on? Because it fits a theme that's hot in the markets, all of that. If you get my meaning.
Yep. So I think to some degree, some of this stuff will always be subjective and qualitative. what made the 2021 atmosphere so special? Like inevitably, you can look at a chart and be like, "Holy crap! This made one hell of a move." But what you really also need is the experience of having been there and knowing, like, wow, like everything was squeezing then. There was so much money coming into this, Wall Street bets, everything was momentum, momentum, momentum. So that context is important. And there's ways to even take qualitative data and make it quantitative and a little bit more objective. And you can say, wow, the market was like 8 out of 10 strong. 10 out of 10 strong. Back in 2021, it was 12 out of 10 euphoric or something. And
Right.
guess what? If that Circle IPO happened in April during the market panic, again, we don't really know what would have happened, but I would like to think that that was not going to explode like it did. We had CoreWeave that IPO'd, and kind of with the whole AI data center demand, when we saw the market bounce and NVIDIA and everything kind of reclaim and go higher, that IPO started to really, really take off. I don't think Circle would have done what it did if CoreWeave didn't do what it did. And in fact, on some of those days, we started to see the two trade with a decent
tandem.
correlation. Yeah.
Yeah.
And so that stuff is going to be hard to codify, but you can still annotate that and describe the market you're in. And I think even as part of a good trade write-up, and I have a template for this somewhere online, those write-ups should include that context, because that context matters. It matters what's the market like, what's the psychology like, what has been in play at the time. If you recall, I think this was maybe 2023, there was a time period when small cap biotechs were just absolutely exploding and going nuts. Like, oh my God, you get one headline, these things were going up hundreds of %. If you're a small cap trader and you trade mean reversion small caps and you don't notice that pattern's happening, you're going to get just absolutely blown out and crushed. And so that context does matter. And it really helps to just be aware of, like, what are the themes in the market right now. There is a lot of momentum. There is a lot of froth. We are seeing small caps be very, very lively again. So that definitely should be a factor in a lot of this stuff.
How often before you're going to place a trade or as you spot a setup, do you remember a similar type situation precedent that you can use from, years before, having done the work and built that database up? How often does it happen where you're like, this looks exactly like, insert ticker here, and that helps build your confidence, and just it reminds you of the situation and increases your focus on that potential opportunity.
Yeah, I mean, I think there's some traders, especially when I was doing this, 60 plus hours a week, I was just like near photographic memory, just because you're spending so much time thinking and delving into these charts. Now much less so. And so there's some traders that are really good at those analogies. Like Native Investors Live is really good at those analogies. But I would say what I've done over time is I've more so built a framework for understanding price action. So even if something has no direct comparable, I still have my way of viewing things, right? Like, okay, I want a capitulation to have accelerating bars. I want us to be stretched above a Bollinger Band. I ideally want us on day 3 or more. I want us to have multiple legs. I want us to have really crazy volume. I want us to have a buyer at $245 being the sole thing holding the stock up after a margin increase. And maybe someone was short a lot and now they just can't hold this anymore. I want to, yes, like examples are great, but I think the true meta is when you're able to go beyond a specific example and build yourself a framework for understanding why price and market structure acts kind of the way it does. And understanding, wow, this is what euphoria conceptually feels like and sees like. This is what the other side, panic and capitulation, right? Comparing April in the market versus, a couple weeks ago in Circle. Those are two sides of opposite sides of the same coin.
Right. Excellent. No, Lance, this has been great. Do you have any last bits of advice or thoughts, either on building a model book, building a database of setups to study, or just larger from the framework of your presentation, learning to learn about what actually matters when it comes to trading.
Yep. I mean, I think if people just took away one thing, it is how effective, how much one person can accomplish if they simply take even just 1 hour of deep work more than what they're currently doing to work on the high leverage kind of constraint for their trading or anything they're doing. And it's not comfortable, but it's so important. And if you study the people that have had outlier success, I think you'll find that those are the people. Like it's not crazy intelligence. It's not like, obviously you need all this stuff, but so much that differentiates output is the ability to really just spend a non-crazy amount of time on the most important thing. And taking alone just the time to figure out what that is for you.
Awesome. Lance, thank you so much for your time. Where else can people go if they'd like to learn more from you about your style? Where would you point them to?
Yep. Well, I am always dropping fire on my Twitter, and I'm doing a big YouTube push where just trying to pump a lot of good free content over time. So either of those channels at the one Lance B.
Excellent. Well, Lance, thanks again so much for your presentation. We will be inviting you back after all. Thank you so much. Yeah, thanks again for your time. To everybody watching, hope you really enjoyed. Check out the resources mentioned. Leave a like on the video if you did enjoy. Subscribe if you're new to the channel, and we'll be right back. Stay tuned. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Lee Tanner. Lee is a former chemical engineer and U.S. Navy submarine officer, and he's been a CanSlim investor since 1988 and is the co-organizer of the Petaluma IBD meetup. Lee, first of all, thanks so much for being here and looking forward to diving into your presentation.
It's a pleasure to be here for the TraderLion Conference 2025, and I'm going to talk about a growth stock investing method, the Bill O'Neill growth stock investing method. And I'm going to show some of the rules that I use and some recent example stocks. First of all, this presentation is for educational purposes only. I'm not recommending stocks and securities to buy or sell. All investing has substantial risks of big losses, and CanSlim is the registered trademark of Investors Business Daily, or William O'Neill and Company. I'm not sure exactly which now. Anyway, the Bill O'Neill growth stock investing system, which is sometimes called CanSlim, is really pretty straightforward. He tells us to look for stocks that have these top fundamental and technical characteristics, which he describes as current earnings, annual earnings, something new, supply and demand, leadership qualities, institutional sponsorship, and to do this while the market's favorable. And then to study the charts and to pick out stocks that have these properties that are completing standard Cropper bases and that have a 30% prior uptrend that tells us institutions are already accumulating positions. And then study these charts carefully and determine what the pivot point is or the ideal buy point, and buy the stock exactly at the ideal buy point. That's a word he uses, exactly there. And then we hold the stock. If it goes down 7-8%, we sell it without questions, and that's our capital protection sell rule. Otherwise, we hold it, and holding it is a key part of this system We hold it. The objective is to hold it till it goes up to the profit goal, which is 20 to 25% from the standard base pivot point. This is something that gets overlooked when we read the book, this holding part. And some people, it'll get up here and it'll start to come down and they'll want to take profits. We hold it. This is not swing trading. Then when it gets up here, almost all the stocks that are bought this way get sold when they're up 25%. There's very few exceptions to that. And in his book, he has only one exception, which he calls the certainty exception. And that doesn't get applied very often. So that's the basic system. It's simple and it's rule-based. And since it's rule-based, it means that I can learn it and I can do it. It's like doing a recipe. A Draminier souffle is a fairly complicated thing to make correctly. But if I have a recipe, I could do it. And I may not get it right the first time, but I can eventually learn how to do it. That's what CAN-SLIM investing is like. I can do it. I can learn it and follow the rules. Now, some people ask, does this still work? Everybody knows about this. Bill O'Neill first started teaching this to the public in 1984 when he launched Investors Daily. And his first book came out in 1988. It's been updated several times, last time in 2009. So everybody knows about Bill O'Neill's growth stock investing system called CAN-SLIM. Well, it still works for sure. And the reason it does is chart patterns are based on psychology and the laws of supply and demand. And neither of these have changed. The same patterns work today as did decades ago. When we go back and study old charts and new charts, we can see that for ourselves. The other thing is earnings growth expectations are what attracts big money to come into stocks. Institutional investors want to put their money into stocks that they think are going to have high earnings growth, and those are the stocks we want to pick out. Now, Bill O'Neill teaches us, the individual investor, the easiest way to do that is to pick stocks that already have a recent history of current earnings and annual earnings, and something new that's driving that earnings growth. Now, everybody knows CAN-SLIM, but very few people actually practice it. There's many variations to it, and the markets are much larger than they were in 1985. They're hugely larger. There's more stocks, and there's more dollar volume. So CAN-SLIM still works just fine. And I'm going to be talking about the classic William O'Neill book version of CAN-SLIM that's taught in these books here. The first 4 books teach the CAN-SLIM system. This book by M.P. Schmidt talks about individual investors who have learned to do it. This is the best bang for the buck if you want to learn CAN-SLIM investing. Start out with these books. I suggest them in this order: 1, 2, 3, 4, etc. Also, the investors.com website, the Investors Business Daily paper, is tailored toward CAN-SLIM investing. And the website, even though they do other things now like swing trading, leaderboard, is primarily CAN-SLIM oriented, and so it's a very useful website. They have a good section on learning it there. You can go to that as well. Now, I like to consider the Bill O'Neill CAN-SLIM business as 6 basic activities. I break it up into sort of 6 basic activities. The first activity is what we're doing today. By looking at this video, we're studying and learning, and when we study and learn, we want to develop written rules. The next activity is making a watch list or deciding which stocks to buy. This is the most difficult activity, but it's the second thing we need to learn to do. And it really is the hardest part as far as I'm concerned. Then buying just right. This takes some effort to do it right. It's not just a piece of cake, but it's not that difficult. Managing a portfolio is really straightforward. And selling just right. A lot of people worry about this. They think selling just right is hard. It's not. It's actually one of the easiest aspects because it's very strictly rule-based. At least the way I do it is. I want objective sell rules so I know when to sell. Then we review periodically to see what we're doing right and wrong, and we learn from the experience, and we do it over and over and over. It's like the recipe. The first time we do the recipe, it may not be very good, but the 5th time we do it, it's pretty good. The 10th time, it's probably perfect. So now we don't learn CAN-SLIM investing quite that fast, but we can get to it pretty quickly. Here's an example, a recent example. People asked, does this still work? This example shows it does. This is Netflix on April 1st this year. Netflix had all the characteristics that O'Neill tells us to find to pick a stock. It was after the earnings report. It was on the IBD 50 list. Any stock that's on the IBD 50 list has good enough Kansas Slim properties for me. It was on the Big Cap 20. It was on the Growth 250. It was on the leaderboard. It had a very strong prior uptrend. From here to there, it was a shallow base. The base was 23%, and the general market had corrected 27%. It had a very strong relative straight line because of that. 5 top mutual funds owned a position in this, and it just reported earnings. So this is a very good setup. The only flaw in this setup was this was a 5th stage base here. Pattern recognition said it undercut, but barely. This is a late stage base. But I only need, when I buy a stock, I'm only looking for it to make 25% advance. And this stock will probably make a 25% advance if this breakout works at all. So buy it right here. It's easy to buy right at the pivot point. The earnings report was on the Thursday. Friday was a holiday. Monday, it traded up to that. It could be bought there. If you missed it that day, you can get it early the next day. There were 2 add-on buys that might have been made, and it went to the profit goal, and that's when it would be sold. There was absolutely no reason to hold this stock past the profit goal, even though it later went higher. We sell it at the profit goal, and we made a 25% gain in 7 weeks, almost a 500% compounded annual growth rate. With the add-ons, it was a 20% overall gain and about $12,000 in 7 weeks. That's good work if you can get it. So that's the classic Bill O'Neill growth stock investing system, just to demonstrate it in that one stock. So the first activity we do is studying and learning, and whenever we're doing this, our work product here is written rules. That's the work product of this. The next activity is to make this watch list, and this is the most difficult part, but we can simplify it. Now, I look for stocks in specific places, and I try to make my work as easy as possible. I use the IBD screens that are investors.com. These are easy to use. The IBD 50 is my go-to screen, but then the sector leaders, IPO leaders, Big Cap 20, Stock Spotlight. This is the shortest screen and most selective. This favors stocks that are new issues. This favors higher cap stocks. This favors stocks that have a higher relative strength. The market surge list, Growth 250 list, is designed to pick stocks with the characteristic of every stock in the database that was ever successful, to pick it out before it broke out. It's a combination of several screens. It's usually about 300 stocks. They don't change that much every week. If you go through all those, you're not going to miss anything. The stocks, ideas that people share with me, I look for there. And stocks that I keep track of, and I have custom screens. But the go-to list is the IBD 50. That's where I start. I never do a watch list without starting there. And that's only 50 stocks. And any week, there's only 2 or 3 of those that are in bases that are near a pivot point. Most are extended, or some will be deeper in a base. So it's not that difficult to do. When the market's correcting, this is when it's the best time to do this too, by the way. The next activity we need to do is to buy just right. Now this is, Bill O'Neill says, buy exactly at the pivot point. This takes some skill, some practice to be able to do that, but it's very, very important to be able to do that. So buying just right, exactly at the standard pivot point or before. I use Wallen, William O'Neill, and IBD taught early buy points. I use these a lot. I buy one full initial position at one price. Now it's okay to scale in, and I used to do that, where I'd buy the first tranche, maybe 50% of the position right after pivot point. Then I'd buy the 30%, maybe 2% above that, and maybe 4% above that, I buy the final 20%. I stopped doing that. I found out it didn't help me, so I just buy it. But it's okay to scale in if you want to. And I don't use any volume signature. I want the stock to have breakout volume, but I don't wait to see the volume to make the buy. This is kind of a departure from what you think Bill O'Neill is saying in his book, and in fact, it is a departure from what he says in his book. But he and his portfolio managers don't wait for volume either. So the key for me is to learn these early buy points and to use them. And they are pretty standard. This is a standard cup with handle. This is a trend line early buy point on a handle, cup with handle. This is a handle high early buy point. And this is the hardest one to find here. Picking it the low when volume dries up. That's very hard to use. I don't use it very often. Double bottoms have a similar situation. The standard, a trend line, and then this shake up plus 3. This is one of my favorites here. I'll talk about that more later. So as I said, I don't use a volume signature to make my buy. Price wholly is my trigger. And I want there to be a plus 50% breakout volume, but at the standard pivot point. But I always buy before I see it, because if I wait to see the volume, the price is always higher. If volume's flowing into there, price is moving up. And I'd rather get it right at the price and then take a chance that it won't break out. So here's an example. This is NVIDIA in January 4th, 2024. It has a very strong prior uptrend, and it has a base. And this is probably the best. This stock probably has the best CAN-SLIM characteristics of any stock at the time on the database. And it's got a flat base here, and pattern recognition said this was like 11% flat base. And here's the weekly chart. You can see the prior uptrend is really powerful, and lots of accumulation in here. This is a very desirable setup with a double bottom base. It had a shakeout plus 3. You could have bought it there, but here's the base now, and there's 4 weeks tight right here. It's on the IBD 50 list right at the top. They identified this flat base here in the little note down here with that pivot point. And sure enough, a couple of days later, it did break out, and it had huge volume. Now, if I wait to see this volume, the stop price is already going to be 1 or 2% above this pivot point. I don't want to buy it up there. I want to buy it closer to that pivot point, and maybe even a little bit before. So I'm going to zoom in on this base. Here's the weekly chart I'm zooming in on. I got 4 weeks tight. So this is the 505 standard pivot point. Here's a 504 or so cup pivot point. So I can at least do that well. It's also a 4 week tight pivot point. So I can do at least this handle pivot point, 504.33, but I can draw a trend line on this handle from that high to that high and continue it on over, and I can find an ideal buy point on here. That's about 497. You got to kind of pick it off. I use another chart program that I can pick it off more exactly. Now I see here it's not just a flat base. It's a 7 week cup with handle, 11%, 6% handle, and it's tight in here. It's a really attractive setup. Now, the advantage of buying this early here is the minus 7% from this point is down here. It's below the 50-day line. If I buy the stock at this 505.48 pivot point, the minus 7% is right at the 50-day line. So by buying early, I have a better chance of not getting shaken out if the stock corrects a little bit. Also, by buying it early, if this position starts to fail, I have a better chance of recognizing that it's failing and being able to sell it before it goes down 7%. So, on Monday the 8th, instead of waiting for the stock to get all the way up here and seeing the volume, I buy it early, and I'm going to try to buy it at 497, and there's going to be no volume showing. Probably not even this much. It gapped up that day, And ideally, I would buy this with a broker's buy stop with a limit. I would be ready to do it, over the weekend. I'd put that order in. So if I weren't looking right at my computer, I wouldn't miss the buy. So I put a broker buy stop at 497 with a limit of like 500. I'm really stingy on my limits. Bill O'Neill doesn't suggest doing this. He says use market orders, but he has a floor trader and he has people helping him. So I use these kind of orders and I'm stingy. And if I look up and I'm missing it, I can always cancel this order and put in a market order. So at the end of the day, this was a nice strong breakout. I see the volume I'm like, I see the relative price range has gone up and everything looks good. But if I had waited to see this, I would have bought this stock probably 2% above this higher pivot point. So as soon as I get the fill, I start looking for the volume. Now, if there isn't any volume, I can always sell the stock. If the breakout looks like it's petering out or not occurring, I can sell the stock. If the price is okay, I usually don't sell the stock, even if the volume's not there. Sometimes the volume will come in later. Sometimes it'll come in over a few days. And many times the early buy points that I like to use don't get the signature breakout volume anyway. So, and I can look for the volume right away as soon as I get a fill. And the investors.com website, if you get a stock quote, they have a little thing here where they project what the end of the day volume will be. Now, on this day for NVIDIA, whatever time of day I did this, this was near the end of the day. See, I did. They tell you the update time. They were projecting the volume would be below average that day by 32%. So I can go there. I used to put a Excel spreadsheet and I could figure it out myself, but they have it there for me now. Another recent example, Amphenol broke out on May 1st. Now, Amphenol had a double bottom setup here, and I could have done that, but I wasn't looking at it then because it wasn't on the IBD 50. By this time, it's on the IBD 50 at number 47, big cap 20, growth 250, second stage, 6 top funds have a stake in it. What's the new factor for Amphenol? Well, these data centers are being built out. They're building these data centers, and Amphenol makes the connectors that go into the connections that connect all this stuff together, all the blade servers and stuff like that. It's after their earnings report and it's after the follow-through day. On the daily chart, there's a standard double bottom pivot point. Could have bought it there after the earnings report if I'd been looking at it, but I wasn't. So here it is, the standard cup, the follow-through day, the earnings report, and now it's up here at the standard cup pivot point. And if I had been, the relative strength line is making a new high, I would have bought it properly on the high of this day, right here, because I tend to put my orders in a little tiny bit before, and this would have filled that day, but that'd be fine. So we'd buy it that day. Here's the cup base. It has good parameters. There might be a couple of add-ons. At the profit goal, it's sold. There's absolutely no reason to hold this stock past the profit goal. Bill O'Neill has only one rule in his book for holding a stock past the profit goal, the certainty exception. This stock doesn't even come close to that. In workshops and stuff, he discusses some other rules, but that's the main one. This stock gained 25% in 9 weeks, 260% annualized. A $20,000 position would have gained $5,000 in 9 weeks, not including the add-ons. You have to do the math to see you'd earn more with those. So the next activity, so that gives a couple of examples of buying just right. The next activity is portfolio management. This is pretty simple, but it takes some thought. First of all, I need to decide how much money I want to invest in growth stocks. I don't necessarily want to invest all my my 401k or anything, all my money in growth stocks. I need to pick out how much I want to invest in growth stocks. And usually I'm going to have a portfolio of 5, 6, or 7 stocks in the growth stocks, depending on how much money I have. So if I have $100,000 I'm going to put in growth stocks, I'm probably going to have 5 stocks. If I have $500,000, I'm probably going to have 6. If I have $1 million or more, I'm probably going to have 7. Bill O'Neill talks about this precisely in his book. And he says limit it to 6, maybe 8 at the most, because you don't want to have too many stocks. You have trouble keeping track of them. It simplifies the management. And when you have one of these stocks that's really a barn burner, that goes up 200, 300, 400%, you don't want to start out with a 2% or 3% or even 5% position. You want to start out with a 15 or so percent position, so it has a meaningful contribution to your financial welfare. I buy equal sizes of these because I never know ahead of time which one is going to be the best, and it simplifies management. I make add-on buys to the positions that are successful. That's part of portfolio management, and I have a list of the add-on buy points. I use margin if it's a margin account, and I need to decide how much margin I want to use. If you're new, don't use any. If you're and gradually get experience, you can use more. Of course, if in a retirement account, you can't use margin at all. That's no problem. Then I check daily to see if the stocks I own are getting near an add-on buy point. And I check daily to see if the stocks I own might be getting near a sell point. Portfolio risk management. If I size my portfolio for 5, 6, or 7 stocks, the position sizes are going to be 20, 17, and 14% approximately. If I have a 7 stock, and then I have a capital protection sell rule of minus 7%. If I have a 7 stock portfolio with equal size and a 7% capital protection sell rule, my portfolio risk is 1%. Now, that's what Van Thorp suggested using. Van Thorp. He suggested a 1% portfolio management risk. 1% is not a magic number. It's a good safe number. If I have a 6-stock portfolio and a 7% capital protection, my portfolio risk is 1.2%. A 5-stock portfolio, my portfolio risk is 1.4. 1.4 is a very acceptable risk. The following buy points, there are 14 of them listed here. That's quite a lot. The first 3 of these are really like a balance off the 50-day line, or pulling back to the 50-day line, or regaining the 50-day line. We can simplify this to 7, a 50-day bounce, a 3 or 4 week tight breakout, a new high after a gentle pullback, like a handle on a cup. I use this one a lot. A short stroke, a continuation gap up, I use that quite a lot. The 12 or 15 days up, you got to watch your charts pretty carefully to get this one. You might skip it, and then only have 6. And a breakout from a new base. If I own a stock that breaks out from a new base, I can buy a whole new position at that point. So there's a few add-on buy rules that I use. Usually I buy 20% more shares, and there's 3 ways to do that. The most cautious way is to buy 20% of the dollar value of the initial position. So if I had a $10,000 initial position, I would buy $2,000 more with each subsequent add-on, no matter how many add-ons I've made or how long I own the stock. Each add-on would be the same. That's the simplest way and the most cautious way. The next way is to make a 20% add-on of the number of shares that I had in the initial position. So if I had a 1,000 share initial position, I would buy 200 more shares each time that I made an add-on. And so now I only make add-ons if the stock price is going up. So by buying 200 shares, I'm going to be adding slightly more dollars each time, but not hugely more than this. The most optimistic way to make add-ons is to buy 20% of the current position just before the add-on. So if I start out with $1,000 share initial position, and I make the first add-on, I'd buy 200 shares to add on. Well, now I'd own 1,200 shares. The next add-on I'd make, as the stock moved up more, would be 20% of the 1,200 shares. Now you can see that progresses pretty fast, and pretty soon I'm making big add-ons. This is the optimistic way to do it, and this is the way I do it. I have a rule. If the add-on price is within 6% of the last buy price, I do not make a full 20% add-on. I scale it back, or I skip the add-on altogether. I don't want to cluster my add-ons too close together in price and get a stock price that's too close to the current price. I don't want to get what they call top heavy. So if I look at the add-on and the add-on price is going to be only 3% above the last buy price, I will scale it back, either skip it altogether or scale it back to just a 10% add-on. If the stock price is within 5 to 10% of the profit goal, I don't make an add-on, because every time I make an add-on, the risk is 7% capital protection sell rule. Well, if I make an add-on within 5% of where I intend to sell the stock, it's going to be, I'm upside down in risk to reward ratio already. So I'd say 5 to 10%. I use 5%. That's pretty optimistic. You could say 10 or 12 or 14 even if you wanted to be more cautious. And if there's a new base breakout, I can add a new initial position, and then I'm going to take a new profit goal based on that new base breakout. So we did portfolio management. Selling just right. A lot of people worry about this. It's actually very easy, because I make my sell rules very objective and easy to follow. So there's 14 basic sell rules for the classic Bill O'Neill cancel investing. You can find more. There's lots of other variations. IBD years ago had a list of 20. Bill O'Neill's book has a lot of discussion about sell rules. I've sort of boiled it down to these 14 basic rules. The blue dot ones are totally objective. They're very easy to follow. You could put in broker orders for those. Capital protection. If it goes down 7%, sell it. You put a broker stop in. Profit goal. When it's up 20%, sell it. You can put a broker sell limit order in. I don't use a sell stop for that. I use limit orders. Earnings reports, very specific numbers. Decline from the peak, again, a very specific number. You can put in a trailing stop with the broker. The red dot one here is more subjective. You need to train yourself to use this rule. And the good news is, if you don't use this rule, it doesn't matter. You can skip this rule, because if the stock goes down enough, it's going to trigger the capital protection, which is totally objective. The scary gap down is mostly objective, but a little bit subjective. The same with the short-term profit extension, and the same with selecting some stocks to hold for longer-term gains. So to apply these, I just check on a daily basis to see if any of these rules might be triggered. Now, I can simplify these sell rules and get it down to 10. If I don't use these others, I can still do very profitable growth stock investing with this system. Very profitable. And I just check every day to make sure that a sell rule is not going to be triggered, and I check particularly over the weekends. I can spend more time. Now, what about the general market factor, the M factor in CanSlim? I know from studying long-term charts, the market's going up about 75% of the time, so I should be optimistic. When the market is going down, I have sell rules to protect me. So if I misread the market, and I think it's going up, but it's really going down, I'm not going to get hurt if I follow my sell rules, if I check every day, because my sell rules are going to trigger me out and save me. If the market's going up, however, and I'm not invested, there's no rules to protect me. I will have losses that aren't accounted for in the books, but that they're going to be losses nonetheless. Now, let me explain this a little bit. I think it's pretty obvious, but let me explain it. My bias, therefore, is to be overinvested rather than underinvested. So let's look at the recent market correction. It came down about 15%, started to rally, and that plunged, and it was very, very ugly in here. And plunged, it was down, as the NASDAQ was down 27% right here. Now, it'd be very easy with all the news and the hubbub and everything that was going on here to say, well, this market is really broken. And I just better be very cautious and stay out of it. This is wide and loose here. The news was very negative, the trade war and all that stuff, et cetera, et cetera. And now there's a Father's Day here, and I could even be pessimistic through that because it was a pretty anemic Father's Day. And I just remember the news was very negative on here. Well, now all of a sudden it's above the down-sloping 50-day line. Now, I expect this, it's only 2 legs down. It's going to be 3 legs down. And I just better not get in here. I better be careful. Well, next thing you know, it's up here, mid-May. I think, oh, man, geez, this thing's rallying. I'm not invested. Maybe only one stock or something. This is not good. Well, geez, this is too late. This is going to correct. I just know it's going to correct. So I think this is the worst possible situation for me, a growth stock investor, to get in, is where I'm sitting here uninvested and the market's rallying. And now I'm sitting on the picket fence. It's just terrible. So for me, it's much, much better to be optimistic down here, even though it looks horrible, and to try some positions. If they don't work, the sell rules get me out. If they do work, I'm invested as the market rallies. So, and I've learned this the hard way over a long time. So that's what I do. So the way that works for Lee is this market plunges 15%, starts to rally, and then this was a Friday here. Thursday gaps down, or Friday gaps down, and then closes at the low of the day. The news was ultra negative here. And I just knew from experience that this market was probably going to have at least a short-term bounce, and I should try and find something to buy. And on Monday, the market plunged down here and started to rally back. And mid-morning on Monday, in fact, fairly early on Monday morning, Pacific time, I said, this is time to buy. So I turned my buy switch on. Now, I could have waited to the end of the day. This is a really nice accumulation day here. Now, the next day, the market had a distribution day, or a distribution day. And it looked pretty bad, but it didn't get to the low of the prior day. So my buy switch is still on, and I'm looking for stuff to buy. The next day is very, very powerful. Now, I attribute this to a lot of short covering, and there's options trading and all kinds of stuff goes on these days that causes this type of surge. But this was a positive day. So my buy switch is still on. And the next day, it plunges, it gaps down. But when I do the math, this is an accumulation day. It's a support day because it's a 40% true range. And so that's also a good day. My buy switch is still on. The next day is another accumulation day. Now I look at the weekly chart. This is a very strong accumulation week. This is the highest weekly volume in a few years. This is very strong. Now, this doesn't mean the market's going to necessarily rally, but it confirms to me that I'm glad my buy switch is on, and I'm glad that I probably already bought 1 or 2, maybe 3 positions. Now, what do I do when I'm wrong about the market? And I do what I just described, and it doesn't work. Well, it didn't work the first leg down on this correction. It went down 15%. It's well below the 200-day line. And there's a rally day right here. Even before that, I'm looking to turn my buy switch on. And so I did. And I picked out this stock here, Ascend Pharmaceutical, and I bought it here. And, well, we know the market didn't rally, so what happened? The market started to rally, and then it failed. It went a pretty steep correction, with this kind of gap down business here. Well, what happened, Salik? Well, I bought the stock here, and the breakout failed, and right here, I know the breakout failed. And I can see the market's going down, so I sell it here. I take about a 3% loss. Well, I take a 3% loss here, but I have to do that at this point to be willing to turn the buy switch on when it's down here. If I don't turn the buy switch on here, I'm not going to turn the buy switch on here, and I'm going to miss out on the opportunity. So I just need to be able to do that. Now, that's the way I work. You need to figure out how you want to work. So that's the market factor. Now, periodically in a year, we review what we do and learn from our experience and make improvements. And Bill O'Neill calls that post-analysis. I can't discuss that in this presentation, but suffice it to say, he says, put your winning trades in one bucket, your losing trades in another bucket. Then review the winning trades and see what you're doing right. Review the losing trades and see what you're doing wrong, and try to learn from the experience. And take what you've learned and improve your written rules. Now, one of my favorite early buy points is the shakeout +3 buy point. Now, Bill O'Neill calls it a shakeout plus 3-point situation. He describes this in the first 2 editions of How to Make Money in Stocks, not the 3rd and 4th, but it's in the advanced home study courses, and it's in the IBD Investor Corner articles. And Bill O'Neill originally took this from Jesse Livermore, and it's basically a double bottom setup. Got a prior uptrend, the first leg down of the double bottom, and then the second leg down undercuts the first leg. That's the shakeout. The shakeout +3 buy point is when the stock comes $3 above the first low. So if this low was $100, the buy point's going to be $103. Now he says, so I'm going to say, if the first low is $40, the shakeout +3 buy point's going to be $43. Now this $3 rule applies only for stocks between $30 and $60. And that's because that's what Jesse Livermore gave Bill, and that's what he used. Now, IBD and Bill O'Neill have extended the applicability of this shakeout +3 situation for stocks outside the $30 to $60 range. And they've done that by going back and studying their database. And for stocks over $60, I used +5%. And that's because $3 at 60 is 5%. And for stocks less than $30, I use +10%, because that's $3 at 30 is 10%. And Bill O'Neill, in his examples, he sort of does a scaling like that, but he still uses equal dollar amounts. You can study his examples and figure out what works for you. So another recent example stock. We'll go back and we'll look at Netflix with a shakeout +3 setup. We looked at it with the standard pivot point. Now, as I said, my buy switch goes on early. This stock had the first low here, came down and had a shakeout. That shakeout was on the Monday. Now, this is an interesting setup here, because as the market plunged from a 15% correction to a 27% correction on the NASDAQ, this stock didn't go much lower. On the Friday, which was a horrible day, it closed near the low of the day, but only about equal to this low. And then on the Monday, it went lower, but then closed above that. So this relative strength is quite strong. And of course, we saw that before. So the shakeout +3 on this is shakeout +5%, which is this green line, which is 897.24. I could round it to 900 if I wanted, but I tend to just use that number. This has all the properties we looked at before. The earnings report's not due for a while, so I can buy it right here. I probably wouldn't buy it on this day just because it's a little bit too wild and it closed below that. But I could have bought it the next day. I had 3 more days to buy this right at that shakeout plus 3 buy point. And the minus 7% line is down here. So that's a fairly safe, even though this market's swinging around wildly, this is a pretty good place to buy it. Now, it turns out the earnings report is due here after the market closed on this day. And per my earnings report rule, I do not have enough profit cushion to hold for the earnings report. So the stock needed to be sold by the close on that day. In the post-market trade on that day, that was the Thursday before Good Friday, the stock would have been bought back at about the same price. You could, in post-market trade, you could see that the earnings report was okay. The stock wasn't going to plunge 20% or something. You could buy that back right away and have about a break even there from selling it. And so I would manage this stock as if I bought it here and didn't do that sell and buyback here. The next Monday, after the long weekend, the stock rallied up to the standard pivot point, and relative strength is stronger than ever. Now, the stock continued on as it did before and goes up to the standard profit goal as it did before. There's no reason to hold it longer. You sell it at the standard profit goal, and this has a bigger gain. That's the advantage of these early buy points, is you get a bigger gain. I get a 39% gain in 9 weeks, 700% compound annual growth rate, and overall 26% gain with these add-ons. Get an extra add-on in there. So that's the advantage of these early buy points. And the shakeout plus 3, I favor it. Here's another example. Robinhood broke out on April 10th. Now, this is before the follow-through day, but again, this was using the optimistic point of view. I'm saying my buy switch is on. I explain why. Here's the 10th in the market. That's the NASDAQ market. Let's see with Robinhood. Robinhood, like Netflix, it made a pretty big plunge here on the 15% part of this NASDAQ correction. It rallied some, and then as the NASDAQ comes down almost twice as much here, Robinhood doesn't. It comes down just a little bit more, and the relative strength is stronger. And this is a good setup here, but there's still a shakeout plus 3. It was on the IBD 50 list as it went up here, and so it had good canceling properties just by virtue of being on the 50 list. Had a very strong prior uptrend. There's accumulation in the prior uptrend. It has a good shakeout plus 3 buy point right here. And there was a couple of days to make the buy right in here. So it was easy to make the buy right in here, and it never corrected much. Now we get over to here, and this is where the earnings report is due on Robinhood. However, unlike Netflix, because I bought it early here, I have tons of cushion, a 28% profit already. It doesn't look like on this chart, but the numbers are bigger than on the Netflix chart, the spacing here. So I have a 28% profit cushion. When this earnings report comes out, I don't have to sell the stock. I can just hold it. After the earnings report, it didn't do all that much. It went down a little bit after the earnings report, and then it surged here. Now, this is the type of surge going to the standard profit goal that meets the criteria for using the short-term profit extension rule. And so in this situation, I would apply the short-term profit extension, and that would be the 10-day line right here. And I'd end up holding this stock past the standard profit goal. It's one of the few methods of holding a stock past the standard profit goal. And this stock has kept on climbing. And I don't know where it is today. I forgot to look. But, this chart here is a couple of days old. This stock so far is up 147% in 12 weeks. And it has a compound annual growth rate of over nearly 5,000% right here. And I'm going to use this 10-day line is my trigger. I'm not going to let the gains I have in this thing get away from me. I have a friend who bought this stock down here, like this, in this area. And he didn't use the exact 5 point I use. He used a different one. But he has this in a margin account. He has a big, huge, giant, whopping gain in it. He has a giant position in it. Another recent example, Rubik, May 1st. It was noted in the write-up for the IBD 50. Recent new issue Rubik is a double bottom base with a 76.11 entry point. So I look at that chart. Here's the mini chart. I read these mini charts right out of the book, right out of the newspaper, just like this. And I can see this stock is a top group, 11th out of 197. Now, it's a new issue, so it doesn't have the greatest CPS rating yet because it doesn't have much in the way of new earnings, but it has a good composite rating and a strong relative strength rating. And it's good enough to be on the IBD 50 list, so it's good enough, mostly good enough for me. It has a high volume, and it's a $70 stock, so it has high liquidity. That's good. It has a very strong prior uptrend, 180%. And I can see that right on the mini chart, 28 up to about 80. And so that's good. I can also see right on the mini chart, I can see strong accumulation. You got these accumulation weeks here, and then I have 5 straight up weeks right here going into this base. I have a couple of strong accumulation weeks in the base. And the note down here talks about the standard pivot point, but I can see there's a trend line on this, the early buy point trend line. The daily chart has a strong uptrend. It has all these properties here. Double bottom base, earnings report was here. Market follow through day is here. I buy this stock right here. Then I'll probably buy it on this day right near the high. And I probably used a market, a broker buy stop with a limit. I got right near the high that day. The buy point's there. The profit goal is right here. There's no reason for me to keep this stock past the profit goal. It triggered the certainty exception. That's what this flag is. They call it the power from the pivot flag. It was up 20%, 3 weeks or less. However, one of the key criteria for applying that rule is that the market's in a strong bull market. And I did not think mid-May that this market was in a strong bull market. I figured it was a bounce off a low, and I expected more correction. So I would not have applied the certainty exception. Here's one of the most attractive aspects of Rubik is this very, very powerful uptrend out of the first stage base here. This undercut, so it was technically a first stage reset, but I really consider it more like second stage. Now, why not apply the certainty exception? I didn't consider this a strong bull market. Now, maybe I was wrong. The market has since gone into new high ground, and it may be a rally. This correction may be similar to 1998, where it was a V-shaped correction and the bull market continues. But at this time, I didn't figure it was. Now, what about Combalt? Combalt was mentioned in this note here. So I went for Rubik. Maybe I'd go for Combalt as well. It was on the IBD 50 list. It has decent properties, not as good as Rubik, but good enough. If it's on the 50 list, it's probably good enough. And this one was. It had a good prior uptrend. It has some accumulation in the base. Here's what the daily chart looked like. The market follow-through day was here. The earnings report is here. So I'd have to wait for the earnings report. And this was buyable anytime after the earnings report, anytime between here and here. Now, I didn't buy Combalt, but if I had, I might have bought it when it made a new high right here, or I might have bought it at the standard pivot point. Well, not everything works. Not everything on the 50 list, and certainly not everything that I buy. So This would have been bought right here around 173.50, the new high right here. And it started to go, and then it failed. This day right here is very clearly a breakout failure and plunged below the 50-day line on high volume. That's when it needs to be sold. So Comball, I ended up with about a 2% loss. And I might have made an add-on buy here, so I would have had even a little bit more loss, maybe 3-4%. So the sell rules work. With Rubik, it was a 32% profit when I sold it at the profit goal. With Comball, 2, maybe 4% loss when it plunged below the 50-day line. Now that's how the Bill O'Neill growth stock investing system works. I make good money on the ones that work, and I cut the losses short on the ones that don't work. And in my actual work, less than probably about half the stocks I buy, maybe less than half, 40% work, and the rest don't work. And the average losses that I have on the ones that don't work is probably around break even, because some start to go up toward the prop goal, and then they fail, and they don't have to go all the way down to -7% to be sold. So the William O'Neill growth stock investing system is like this. Pick stocks with tip-top canceling fundamental properties that are completing full standard bases that have a 30% prior uptrend. Buy exactly at the pivot point or even early using sound early buy points and skilled chart reading. Apply good portfolio management practices. That means not too many stocks and to be concentrated and to monitor carefully what you own and to watch for sell rules and add-on buy rules. Sell per your written sell rules only. Never sell anything unless it triggers a written sell rule. And I don't allow myself to change my sell rules or any of my rules during the week when the market's open. So I can't just, jot out a new rule when I feel like it. I have to wait till the market's closed on the weekend to change my rules. That way, I really am rule-based. Then periodically review my trades and learn how to improve. Here's a big winner, App 11, August 8, 2024. This was a variation on a shakeout +3 situation. The stock had a really strong prior uptrend. During this time, it was on the IBD 50 list, all during this. This is the kind of stock I'd be observing the prior uptrend and see it on the 50 list, and I'd be keeping an eye on it for when it formed a base. It formed a base here, and truth be known, I bought it here, and look at that, it didn't work. But I didn't get discouraged. I sold it here, actually. So, little loss. But this guy comes now, he has a shakeout +3 situation. And this is a nice support day here. The market corrected here. My buy switch is still on. Actually, I think the market pulse said a 20 to 40% recommended investment here. But there's an earnings report, so I have to wait for that. So the earnings report, now this is the shakeout +3 buy point here. That's the shakeout below this 72.15. Well, the next day after the earnings release, it trades up here, and that's the buy point right there. Now, the market was under pressure with a 20 to 40%, but my buy switch is on. Well, it rallied out of there nicely. It broke out here again, then stalled. See, it broke out here and stalled. It broke out here and stalled. But by being in early, I could ride out this move. If I bought it here, I'd have to sell it again. And I'm not so sure I'd be up for buying it again. There's a good chance I wouldn't buy it again. Now the third time is a charm. But by buying it early, I'm in it here. Now, for whatever reason, this stock rockets up right here. I don't remember what the news was, but it just surges up here. And it gets to the profit goal. And this is another time to apply the short-term profit extension and just hold on to this guy. It's one of the few times you keep a stock past a profit goal. But when a stock is climbing like this and gets to the profit goal, that's when you do it. And it just keeps on going. It's very easy to manage. And you can use the 10-day line as a guide or even the 21-day line. It's just easy to hold. Now, this stock just kept going, and it sort of got climactic here. And I get nervous about this, and it broke the 10-day line here and triggered a sell rule at the low here for me, and I sold it there. This had a 338% gain in 14 weeks, a monumental compound annual growth rate. It gained almost $68,000 on a $20,000 initial position with no add-on buys, and you would have had some add-on buys. And it was very easy to do. Now, other people probably would have held this stock through this base. It didn't really trigger a big cushion sell rule, and probably it should have been held. Selling it here was a little premature. And if you did hold it through this base, this is when it would get sold. A very sharp decline from the peak and a base breakout failure. Now, selling it here gained more, almost 400% in 21 weeks, with almost $80,000 gained on a 20% initial position. There would have been some add-on buys. Another example that was easy to find and manage was FTAI Aviation. And the big thing with this company was they lease aircraft, but the big thing was maintenance. They came up with a new maintenance program for the engines on 737 aircraft. And they came up with an engine exchange thing so they could swap out the engines that needed overhauling, and airlines could keep their planes flying with less downtime. So now it took a little digging to see that, and you might not even see that the first time you bought the stock, but after a while, if you owned it, you might dig into it and find that. It's on the IBD 50. It was on the 50 for many weeks here. It has a sound tight base. It has a strong prior uptrend. 2 top fund zone shares. There's accumulation in here. You can see that right on the mini chart. You can see it. And there's something new is that aircraft engine swap out maintenance. It has a 10% flat base, the second stage. And then I'm looking at, I zoomed in on this, and it looks like NVIDIA. It's got that couplet handle thing in here. So I draw a little trend line and make an early buy point if I want, and buy it here on this day. Now look, there's no volume, but I buy it anyway. I'm not going to wait for the volume. I'm going to buy it because price only is my trigger. Now the stock trades up, and there never was breakout volume. You see, I don't want to wait for breakout volume. The stock trades up, gets to the profit goal. There's absolutely no reason to hold it past that. It's a nice 25% gain in 8 weeks. It's very good money. I take my money and run, and I'm a happy camper. 8 weeks later, the end of October, this stock is setting up again. Now, it was last on the IBD 50 list, the beginning of October, but the fundamental characteristics haven't changed. So it still has top fundamental technical properties. And I'm going to look at the chart, and it's set up in a consolidation here with a trend line early buy point right here. And that's a good time to buy it. And so it's an easy time to buy it too. And lo and behold, there's some volume on this move. And even though it's not a standard base breakout, and look what the relative strength line does. And so it's easy to buy right there. And it climbs nicely. You had several days to buy it. You could even buy it at the standard pivot point here. And it's just a nice setup. There's lots of time to buy this stock. And look what that relative strength line is doing. The market's in a little correction here. And this stock is just going. Oftentimes, the very best stocks break out first. And if we look at this base, we'll see there's the first leg down here. This stock continued to make new highs as the market was correcting. And it didn't start to correct until the second leg down of the market correction. And on the third leg down, this stock barely made a new low. In fact, I think it didn't even make a new low. I thought this is not a double bottom here. So this is a very strong relative strength situation. So we buy the stock here on the weekly chart. And look what this guy does. He comes out of there and he rallies quickly. He doesn't trigger the certainty exception, but he comes out of here and there's 8 of 9 weeks up. And the down week is barely down at all. This is a very strong move. And because we bought it early, I have a 30% profit here, 33% profit when it gets to the standard profit goal. This is another situation where you can apply the short-term profit extension rule or just make a decision to hold the stock. You're just going to hold it. And Bill O'Neill talks about that. And that's one of the sell rules, one of the 14 sell rules. Is just decide you're going to hold it for a longer term gain. You've studied this stock, you know a lot about it, and you just have confidence, and you have enough profit cushion to just do it. Just hold it. And maybe use a wider decline for the peak number, or say I'm going to hold it unless it breaks the 50-day line. Or if you want to be stingy, you can say I'll hold it unless it breaks the 21-day line. Anyway, you hold this stock at the profit goal here. And this is what happens. This is one of these stocks that just turns out to be a real big winner. You don't want to start out with a 5% position in this stock. You want to start out with a 15 or 20% position in this stock because this puts big money in your portfolio. Even if it's not on a margin account, even if it's in a retirement account, this type of gain here is big money. This is a 270% gain in about 60 weeks. It's capital. If you're in a taxable account, it's long-term capital gains. And on a $20,000 position, that's $43,000 gain. That's huge. And then you figure all the add-ins. This is really big and easy to do. You see the rules are easy to apply. Let's go back and revisit NVIDIA. We looked at that with the number 2 on the IBD 50 list. It had this nice setup. We looked at the early buy point here. We can make an early buy point at 497. Pretty easy to do right here, as we showed before. Now, that's the buy point on the weekly chart. This is a weekly chart here. This is the buy point out of this base. Now, this stock triggered the certainty exception rule, and you would apply the certainty exception rule. It's up 20% in 3 weeks or less. It is a bull market. There was a minor correction, so this stock is coming. There's a short correction in a bull market. This is a very powerful stock. It has the best candle properties of any stock in the database at the time. Certainty exception, you're going to hold it for 8 weeks. Pretty soon it's up here. You get past the 8 weeks, and you're going to manage and under what's known as the big cushion sell rules. You're going to hold the stock through a base. So you do. Now, this is a pretty easy base to hold through. Nothing untoward happened. And when the stock breaks out of this base, you can buy a whole new additional position. And it triggered the certainty exception again. But the way I work, I wouldn't do the certainty exception 2 times in a row. I would sell it at the profit goal here and be a very happy camper. Now, you can go back and study this. It's entirely possible you'd still own this stock and you would have held it through the base that we just had. But that's not the way I work. So, initial position here where we showed you before at 497, certainty exception, hold it till we get up in the big cushion rules, hold it through this base. There's a handle by it here, new position. Sell the whole thing when you get up here to the profit goal, the standard profit goal here. And be a happy camper and take the money and run. Now, on this setup, looking where we would have on the first position, we'd have 140% gain in 47 weeks for 87 or about a 90% compound annual growth rate. We'd have a $29,000 gain on the first initial position here, not figuring that out in buy points, and there would be some. Then on the second position, full position here, and I'm just going to assume another $20,000, but it actually should probably be more because by this point, your portfolio would be bigger, hopefully. It would be. But I'm just going to say 20,000, another initial position. The gain now would be $6,400. So the combined gain would be about $35,000. Now we're 6 months into the year, and if you had a $100,000 portfolio and you were buying $20,000 positions or a 5-stock portfolio, your portfolio has already gained 35% and you're halfway through the year on just this one stock. If you broke even on everything else you did that year, you had a 35% year. If you have 35% years regularly, you're rich pretty fast. Here is a really giant winner. This is an all-time monster stock. And it's Monster Beverage, which at the time was called Hansen's Natural. And the time of this model, this is a model stock, is from August 2004 to July 2006. This is a stock we study. The first buy on this stock, and this is a model that we've done in the Petaluma IBD meetup, and you're going to get a link to go where you can study these details. The first buy was in this base here, the green arrow. There were 2 add-on buys right away, and then the breakout failed. The decline from the peak sell rule was triggered, and it had to be sold here. But it formed another base and would be bought again right here in another breakout. And that breakout didn't fail. And it had all these add-on buys made here using the standard add-on buy points that I had in that list before. And went all the way up here. And finally went through a base and then had a late stage base breakout failure here and was sold here. Now this stock in the model was in a margin account. We assumed it was in a margin account with $20,000, and the initial position was purchased with cash, not margin. And the add-on buys were made using margin. This overall, this $20,000 initial position gained almost $1 million. Now you think, well, that's not true. It couldn't be, that's impossible. It's possible, it's real, and you can go and study the details. Now, this is the kind of thing, this is the objective of learning how to do growth stock investing. This is the objective. You want to get skilled enough that once in a while, once every 5 or 10 years, something like this comes along, you can make the most of it. You've got enough experience, cooking that Dramagnier souffle, that even when conditions are lousy, you can do a good job and make the most of it. And this is when conditions were pretty good. Now, the market was decent in this time frame, but it wasn't anything super spectacular. But this stock was super spectacular. And it was soda pop. It wasn't high tech, it wasn't semiconductors, it wasn't biotech, it wasn't rocket science. It was soda pop. And Bill O'Neill likes these consumer product companies, so do I. They're easy for me to understand. Okay, so how does this happen? You can, basically, if this is huge, and how does it happen? Well, here's the spreadsheet. This is the first position that got sold. It was bought on August 23rd. We scaled in with 3, the scale in was 3 buys, not like 1 buy that I do now. 50%, 30%, 20%, and at This is at the pivot point or ideal buy point. Early buy points are used. 2.5% above, 4.5% above. Then there were 2 add-on buys made. This add-on buy took a loss. The others made money, and this initial position made about $2,400. So you had you had a little bit of gain. You took that gain and put it back into the next position that was bought on November 10th, and it was scaled in. And then we had all these add-on buys, 11 of them total, and the whole thing was sold on July 10th, and this whole thing had a profit of value, a profit of $995,000 total. So that's the thing. Now, some notes about this. This is a model stock, not a model portfolio. A stock like this would be part of a portfolio of at least 3 other stocks. A single stock should not become more than about 50% of a portfolio, maybe 65% for a short time if that big stock is going into a climax run. Bill O'Neill at one time had all the firm's money in one stock, Amgen. The people that work down there, his son, like to talk about it. It was very, very exciting. Nobody but Bill O'Neill should try to do anything like that. And he only did it once. So 50% is a big thing. When you got half of your portfolio in one stock, that requires a lot of attention. Initial positions were bought using cash only in this example. We scaled in. B1 was 50%, B2 was 30%, and B3 was 20%. And it was B1 right at the ideal buy point, 2.5% above, 4.5% above, about that. The most amount of margin that was used for this single stock was 50%. Even though margin, the initial position was bought with cash, and margin was used for all those add-on buys. And there were a lot of add-on buys made over the time the stock was sold. The stock value grew so much that it had the buying power. We never needed to use more than 50% margin. And that's about, you're buying half with cash and half with the value of the stock in the portfolio and half with the margin loan. And that 50% occurred on November 9th, 2005. So, about a year into owning the stock is when the highest margin use occurred. In summary, the position started in August 2004. We had to buy and sell the first position. It was bought back in November. We sold everything in July 2006, July 10th. Almost 2 years for this stock. Made numerous add-ons. 11 in the second part, 2 in the first. We started with $20,000 in a margin account. It earned almost $1 million. Half that gain was long-term. So you get the long-term capital gains benefit now you can't do this in a retirement account because you just don't have enough. You need the ability to use margin to do this kind of thing. And so that's a good reason to start. Even if you have most of your money in retirement accounts, you want to get a little margin account going and learn how to do it. Because, you can see if you have a $20,000 margin account, it could get big fast. So margin is very powerful. The 2 original positions were made without any margin. That's a cautious way to use margin. Use cash to buy the initial positions and only use margin for add-on buys. And you only make add-on buys if the position is up and working. So it's a good way to start out to use margin. And 70% of the profits that were made in this stock were made on the add-on buys. So add-on buys are very important to learn how to do. So there's a recorded presentation for Hanson Natural with all the details, the spreadsheet, the slides, and a video presentation. The slides and the spreadsheet are on Google Docs. This was done by one of the members of the Petaluma IBD meetup, Michael Nestler, and he did a really excellent job on this. And it's at this link here. This model was also a Bill O'Neill model in his book on page 104. It's interesting to note that he bought this stock here out of the second base. He didn't buy it here. The model that Michael Nestler did, and I agreed with him. If I modeled it, I would have bought it here. And then Bill O'Neill sold it here. He called this a climax top. And he is better at seeing this stuff than I am. I didn't see a climax top here. And you can't draw an upper trend line that spans bases. So there's no upper trend line here. So Michael Nestler didn't see this climax top here either. He sold it at this base breakout. It's Mox Nix. It's about one and the same. So stocks like Hansen Natural, and I've got the wrong symbol here, or Monster Beverage can be life-changing. And Bill O'Neill talks about that in the Investors Business Daily newspaper in 2010 and 2012. Bill O'Neill put model stocks in every week for about, 14 months or something like that, maybe 18 months. And he annotated them with lots of terrifically good notes. And one of the ones he put in here was Simmons Precision. I put a screenshot of the whole thing, and I zoom in a little bit here. And let's zoom in a little bit more here. You can try to read these notes. If you don't have these, try to get them from somebody. If you're connected with people, somebody might have them, they can share them with you. But this is the note he wrote in here that's important. It says, in the next 20 years, there'll be 200 stocks that will go up 5 times or more. Getting just 2 or 3 of these could change your whole life. That's the type of situation that Monster Beverage is. Simmons Precision was like that too. Now he says, you could do this. Learn to read charts well and do it each week. Learn the individual stock buy and sell rules and follow them. Learn the general market buy and sell rules and don't argue with the general market. Don't be lazy. Believe in yourself and the rules. Develop a few motivated friends who are seriously studying CanSlim rules and are looking for the best stocks. Who cares who comes up with a big winner as long as you get the idea too? Okay, now, if you guys are interested in anything I have to offer, I've started IBD is changing. They're not sponsoring meetups anymore. I've been the co-organizer of the Petaluma IBD meetup for a while. I'm not sure how that's going to shake out, whether I'll still have a meetup group or not. It's still a work in progress. I've started a Google group called Growth Stock Investors One Style. You can find that and join it if you want. You can just join. You don't need any permission. And then I can be in touch with you, or just send me an email. There's my email address. Send me the email. Don't expect an immediate reply because I get an awful lot of emails, and sometimes I'm a little slow about it. Anyway, this concludes my contribution to the TraderLion 2025 conference. Thank you for your courteous attention. My name is Lee Tanner. I'm an amateur volunteer, not a professional, and I'm not recommending anything except learning this. And happy and profitable investing to you all.
Lee, thank you so much. That was really fantastic. Thank you for running through that, especially the examples at the end. I think bring it all together. I do have a few questions. First, I think from the previous video we did and what you reemphasized today, that I think should be a key takeaway for everybody is I think I asked you what in the previous video, what mistake did you recently make that you've worked to build rules around, and you talked about, again, that not being invested enough during a strong trend was the key thing that you focused on more recently to improve on, and you reemphasized that today. And I think that's so true, because once you're caught off sides in an uptrend, you feel like you're underinvested, there's a rush, and you might find, it just causes a cascade of problems down the road that maybe lead to more losses. One thing I did ask you about sizing after a correction, is it your typical sizing that you do, or do you do any test trades and then scale up if those trades end up working out?
I don't do test trades. I just go for it. And I've learned that by post-analysis. It works better for me. You know, but people with experience, they have to figure out what works for them. For me, it just works to go for it. So I size my portfolio based upon, I size my positions based upon the size of my portfolio. And I typically start out with a 7. I have a pretty big portfolio. So I start out with a 7-stock portfolio. So whatever the portfolio size is, if it's $1 million, I just divide by 7. And that includes my intention to use margin. So, it's my buying power. So if I have $1 million buying power, I'm going to divide by 7, and then I'm going to buy that as I start out. And I'm just going to, so if I showed this example here, the first stock I buy, I'm going to buy 1/7 of the intended buying power, and I'm just going to go for it. I'm going to be very careful and watch to monitor for sell rules. I do not want to miss a sell rule. So I don't want to be looking away and suddenly look up and stock's down 10% or something. In fact, if I can't be really diligent about watching, I'll put a broker stop in. I use broker stops. And I don't use a -7% stop because I don't like get shaken out. I use a -9% stop. That's what would have trigger intraday. And then I use a 7% limit on the closing price basis. So I go full position. I don't scale in, and I don't do trial balloons too much.
And if the stock makes progress from the breakout or your buy point, checkout +3, and say you're up 10%, it hasn't yet hit the profit goal or anything like that, are you adjusting your stop loss at all to break even, or are you keeping it at that original 7% or where you placed it?
This is a really good question, and I recently did a presentation on sell rules, which is on the Petaluma IBD Meetup website. Or it's on the file hosting website. As the stock starts to move up from the buy point, I leave the sell point, the sell trigger at the capital protection sell rule -7% until it gets up about 10%. And once it's up about 10%, then I start to follow the stock up with a trailing stop. And I use a decline, and I call that a decline from the peak, or the trailing stop is about 14.5% from the recent high. So I don't want to follow the stock up with a 7% stop. I want to let it get some cushion, some room. Bill O'Neill says room to fluctuate normally. And then once it's up about 10% or so, I start following it up with a trailing stop. And that's what I call the decline from the peak sell trigger.
And one more question on the sell rules. If a stock triggers a profit goal exception, it's shown superior strength, and you're using the 10-day moving average as your sell signal, is it a close and then a close below that low of that first close that triggers the final sell as it breaks below that 10-day moving average?
Yes. Exactly, and that's what I call, that's Dr. Chris Ketcher sell rule. That's his way of triggering it, and that's the way I do it. So if the 10-day line is what I use, it has to close below the 10-day line, and then the low of that day becomes a sell trigger, and I put a broker stop in for that. I'll look at the low of that day, and I'll put a broker stop for maybe 10 cents below that low.
Excellent. And for big cushion sell rules, if you've got a sizable gain, it's enough that you want to hold through another base. At that point, are you switching from looking at a daily chart to a weekly chart to monitor the stock? What are some tips that you give people to try to hold big winners longer to really get the most out of those trends?
Well, the big cushion sell rules are very specific. And yes, it really does turn to a weekly basis. I still look at the daily charts, but the trigger is weekly. So if I own a stock that's up more than 50% from the initial buy point, I have in my rules that I have the option of applying the big cushion sell rules. And the first, and what that is I'm planning to hold a stock through the bigs. What I'm looking for is a significant change in character of the stock from strong to weak. Now, all good stocks, strong stocks go through normal basis, but I'm looking for a change in character. And the first thing is a close below the 10-week line for the first week that it closes below the 10-week line on volume that's plus 40% or more. Mm-hmm. Bill O'Neill was very specific about that rule in some of the workshops I've attended. So, and it's the first week, not the third or second week. You're looking at the first week that the stock starts correcting. If it closes the 10-week line, the first week below, and not just a smidgen below, like 2 or 3%, 4% below on really big volume, that's a significant sell rule. That's when you would sell that. Now, if it closes below the 10-week line and goes, and later has big volume, you don't sell it on that. Another sell rule for that, in that big cushion rule, is if it's just persistently weak for a long time. It just muddles along below the 10-week line for a long time. And then another big cushion sell rule is if it goes into a climax run, of course, you're going to sell it. That's the objective of big cushion sell rules. You want to hold stock that's eventually going to go into a climax run, because then you can make really big money.
Excellent. And I really love the details that you went through with like the hood example of this recent correction. Just some things that you pointed out with regards to helping spot those names that could have the potential if the trend actually gets going, looking at the relative strength line, not, making a new high before price, the stock itself not falling much before that relative low that the market did, the relative strength line making a higher low as the market makes a lower low, not falling as much as the market. I think all these just recommend for everybody to rewatch that section if you missed that and take special note of those details. Is there anything else, Lee, that you really like to look for during a correction that makes the leader stand out, the names that you want to try first if your buy signal turns on? What really makes you focus on a stock after a correction, or in the latter third of a correction as you see it?
The one key thing is, is it on or was it recently on the IBD 50 list? Mm-hmm. That IBD 50 list has a sensitivity for accumulation that I can't duplicate, and I don't know how they do it in there. They have more data they use than Market Surge has for me to use. So I look at that. Is it on or was it recently on? So the market's correcting, and those are the stocks I look for. I look at the chart patterns, but those are the stocks I focus on. The ones that were recently on that had good fundamental characteristics. I also look for the big winners. If there's a big market correction like we recently had, what stocks were doing really well before the correction? And oftentimes when the market starts out of a correction, those will be the stocks that have the biggest gains coming out in the correction. So that's the way I approach that. And then I just, and for example, I looked at Netflix. Well, it just had a remarkable relative strength considering the depth of the correction. So relative strength is another factor that's very important. And so, on Market Surge, they have that blue dot. And if that indicates the relative strength is making a new high before the stock is, that's a key factor. But just look at the relative strength rating. I have a screen I can run, but the Investors Business Daily screen called Sector Leaders, or Stock Spotlight, they put stocks that have strong relative strength get on that screen. And so and the other thing we have at our disposal nowadays too is just the ETFs. Sometimes it's occurred in this last time in my actual portfolio. The first thing I bought was an ETF. Mm-hmm. And I bought the triple Q, but you don't need to be wild and buy the triple Q. Buy the double Q or just the Q. There's you know, if there's no bases and you think the market's going to bounce, just buy the Q, and if it doesn't work, keep a tight leash on it and get rid of it. And if you buy you might even buy a 20% position in the Q or double Q or triple Q if you're really optimistic like I am. And then if you need the cash, if you go on to buy stocks, you can scale out of the index fund. Now, the advantage of buying stocks rather than the index fund is that if the market does correct some more, it's not infrequent that a stock will survive the second or third correction, whereas the index fund won't, obviously, particularly if it's a double or triple, it's going to go down a lot.
Mm-hmm.
Whereas if you bought a really good stock, it might have unusual relative strength and not correct as much if the general market corrects. So I prefer to get my money into stocks if I can, but this particular rally, I still have a big position in the triple Q, at the T triple Q actually, and it's been very, very good.
Excellent. And I really enjoyed the Hansen's Monster Energy example. Looking back on that case study, what were kind of the CanSlim characteristics that stood out that would get it on your radar in the first place? Did it have really strong earnings and revenue growth as well, in addition to just amazing price action? I mean, it pushed so far off those lows even before the bases that you showed. Yeah.
Yes, it did. It had very favorable canceling characteristics when it broke out of the base. And in the presentation that you can get on that link that I gave in the presentation, it shows that stuff.
Mm-hmm.
It shows it. The slideshow has that information in it. What the properties of the stock were at the time. I think it was on the IBD 100 list when it broke out. So at the time, if I recall correctly. So it was a notable stock. It was pretty well known, and it wasn't something you'd overlook.
Gotcha. Lee, this has been really great. It's so cool to see an application of the O'Neill system, to current markets and to have you explain it. So appreciate your time immensely. Any last bits of wisdom that you'd like to pass on to everybody watching, or any key takeaways that you want them to have, especially from this presentation?
The one piece of wisdom that I share with people in my meetup and my email groups is, if you want, there's so many different ways to invest. And there's so many ways to learn it now with the internet, my goodness. If you want to do any particular way, pick it and then stick with it. So in the O'Neill method, I started working with a lot of people. They start out with this. The next thing you know, they're swing trading or they're doing something else. They get distracted. So if you'd like to do the O'Neill method or any other particular method, pick that method and then really learn it and stick with it, and not try to mix and match it with another method of investing. And it's hard not to do that, because there's so much information out there. Even Investors Business Daily now, they've got swing trading and they have their morning talk group, and it's easy to get distracted. The O'Neill method is really pretty straightforward if you stick with it and don't try to mix swing trading into it. And swing trading is actually kind of alluring, because most of us aren't very patient. We don't want to hold that. We don't want to hold that stock while it goes from the pivot point to the plus 25%. We get impatient along the way. But if you want to do this, try to stick with it and give it a chance. And then if you don't like it, try something else.
Excellent. Well, Lee, thank you again so much for your time. Really appreciate it. To everybody watching, I hope you guys enjoyed immensely. Leave a like down below. Subscribe if you're new to the channel if you did. And we'll be right back. Stay tuned. All right, welcome back, everybody. It's my honor to introduce the next speaker of the TraderLion conference, Manas Arora, who will be presenting on trading before the breakout and his special twist on his preferred setup. So Manas, thank you so much for being a part of this today. Appreciate you taking the time and looking forward to this. Welcome.
Thank you so much, Richard, for calling me to this podcast. I'm honored and excited at the same time to share some whatever knowledge that I have.
Yeah, perfect. Yeah, I'm excited for you to run through the presentation, and then I know we'll be covering a lot of examples as well to apply the concepts in real life. So let's go ahead and dive right in.
Yep. All right, so this is the agenda for the day. This is what we're going to cover. Something about me and what my system is and everything that I do just to like make money in this business. So we can start with like 1 second.
Yep, no worries.
Yep.
There we go.
So I am in this industry from around 2006, and I started as a broker, sub-broker in India. And I started at a very early age, and I was finding it very monotonous. There was nothing creative on that side. So I did not want to really continue that for the rest of my life. So the exciting part was like understanding how these stocks move, which led to me, studying how stocks moves. And I went to YouTube and started watching videos on research side, and the easiest part to learn was the technical analysis, because for a person to understand fundamental is like you have to cover so many variables, so naturally the inclination was towards technical analysis. But for first few years I learned from the books and YouTube, but nothing was really working, because in the videos we only learn about the patterns like cup and handle and all these technical side, but I feel that that's a very, very small part of this whole puzzle. So I was not really making any progress until I came across Mark Minervini's books, and which really, when I read the book, I realized that I was doing something very similar, but I was not looking at the risk side. I was not managing the risk. So the one thing that I took away from that book was risk management, and then I realized that I'm not a trader, I'm a risk manager. I have to manage risk and then just be on the crease, survive and stay on the crease, so that you don't die and you don't in one bad phase you don't die and you finish your money, and then you really cannot play this game. So that really got fixed from this book. And then I started reading more, and then basically that's my turnaround point where things started finally working for me after that. And so what exactly I do is, if I explain, I go for like 20 to 40% moves, because in Indian market this is a typical. I'm a swing trader, and you need a swing has a limit. Your stocks cannot go in Indian markets. If I talk about Indian markets, the average movement that you get in one swing is about 20 to 40%. We don't get 100, 200, 300% in few days. This is what we get on an average here. So this is what I target, and I try to allocate about 10 to 30% in that trade, with a stop of 2 to 2.5%, like average stops. Sometimes I have gone as low as 0.5 also, but then my average is about 2.5%. This is something I want to talk about more, because when I started, and in fact everyone, whenever they start with, like I said, technical analysis, and that makes you believe that the answer is in the chart. You buy a cup and handle and you will start making money. You buy a rectangle breakout, you will start making money. You will buy a triangle breakout, you start making money. But that's not really true, because if you're a scared person, if you're scared to lose money, even a cup and handle breakout, when you get a breakout, stocks don't go up in one like straight up manner. They fluctuate, and they sometimes go back under the handle, and then they again make a second attempt. So in that zigzag movement, a lot of people, especially the beginners who are not mature enough, they get thrown out and they're not making any money, even though the book said that cup and handle is a very great, reliable pattern. So what you need to do is you have to first work on your fear, which is 50% or 60% of the times you will not make money in your trade. So how are you going to handle that? So I think everybody who's new here, or even if you're struggling, you have to first address your fear, because here the biggest fear is that you lose money. On every mistake, you're losing money. So the only way to address it is if you're a new person, tell yourself, this is set realistic expectation. The first 1 year, you will not make money. Even if you survive that 1 year, that's a great progress. And if you have the same amount of money, that's great progress. So start small and know what you are going into in the next 1 year. After that, you start making progress. So the first 1 year goes into addressing all these fear. Without that, I don't think you can any trade. I mean, I've seen very clean patterns. They break out and then next day they just fall back in. And then again, in the next 10, they just go 40% up, 50% up. So you have to address that. You have to first fix that. So this is where every book or every like if you learning this art, you have to first address the fear that you have in you. So yeah. And then another thing that the majority they don't do is, like I said, everybody is just finding patterns and everybody is reading charts, spending hours on charts. I rarely see anybody telling me or discussing what environment are we in, what market conditions are we in. Are we early in the trend? Are we late in the trend? Are we above 10 moving average? What the indices are doing, are they above 10 moving average or below 10-day moving average? Like for example, if let me show you the screen 1 second.
And just a clarification question as you bring that up, was those stop loss levels, that was on the position basis, right? Not your portfolio, how much you're risking?
Yes, if I'm buying stock at 100, my stop is about 97.5, 98.
Gotcha. Great.
Yeah. So what kind of market are we in? Are we early in the trend? Are we coming after long correction? And are we 1 second? Yeah. Are we here? Are we early in the trend? Because here things will work very differently. Stocks will explode. Your cup and handle here, if you spot a cup and handle here, it will work very differently versus 1 second.
Yep.
Yes. Versus somewhere here where you've been running from March 23 and this is September 23. 6-7 months rally and now you're extended. You can see the angle changing. So you have to understand the context. All your patterns will work amazingly well early in the trend, and they will not work that well somewhere here. And again, this is the phase where again after a crash, another strong trend. This is where I made about 40% in 2 months in this much rally, because again we're coming out of correction. So you have to understand, you have to do this analysis helps where we are every day. You need to know what kind of market conditions are we in. This can really help you in setting the right expectations. You can go aggressive when you're here. You can be defensive and not take unnecessary risk, or maybe play small or don't play at all when you're super extended, when you've been running from many weeks.
And do you have any recommendations for traders who are just starting out to help with that fear management? I think you emphasized trading smaller on the previous slide. I don't know if you want to elaborate that a little bit, but I think that's good advice there.
I think if you take next 10 trades with the objective that you're taking them to address your fear, not for the profit. You take next 10 trades and tell yourself that I am testing my fear, how my emotions are going to be in the next 10 trades, and I'm going to address them. And I write them down that I was scared to lose money on this trade. How am I going to fix it? Maybe go smaller next time. So if you have a problem, take few trades and address that problem.
Great.
Keep the money part out. Again, it sounds very easy, but in the first 1 year, this is exactly what you have to do. Otherwise, you'll move in circles, and many quit this business because they're not seeing any progress money-wise. All right, so you see my screen now? All right,
Yeah.
yes. So this is my main setup that I trade, wherein I pick stocks which are about 30 to 40% up in the last 3 months, at least. And then they pull back, go like there is a shallow correction, which is not more than like 30% from the highs. And then after the correction is over, price again reclaims the 20-day moving average. So I look for stocks which are up 30 to 40% in the last 3 months, which means they look like this. They're up. You can see that this is about 95% up. Strong uptrend. And then every stock after giving a move like this will correct. You don't have to chase them. They will go down below the 20. This is the 20 moving average. They go down below it, and I'm not interested in this point. I will be interested when they reclaim after going down, when they reclaim that period, this 20 moving average line. And then I look for days when they make a range, a tight range. Some will have a question that the stock reclaimed even this at this point. But there is one thing that you need to understand, that after a move like this, you have to allow your stock to settle down for few weeks. This is, in my opinion, this is something that's a judgment call, which you can understand by looking at the same stock multiple like previous history. They settle down for 20, 30, 40 trading days, and only then they get ready. So I felt that this was a massive shakeout, and then the stock came back up again, and this is where I get interested in. So if I want to draw this, what my setup, bread and butter setup looks like, it looks like this. And I get interested around this part of the trade, which is where I try to position myself, and I will cover in the coming slide how I take a trade. My entry technique is, this is in the public domain already, but I have upgraded it to, I will explain what SVRO is. Before I explain SVRO, let me just talk about strong start. So again, when I started, and majority, when they say breakout, for them breakout is the buy above the highest point that you see in this image. For them, the breakout is this, right? And I feel that this is an obvious breakout point. Plus, it's, if I compare from the current point, it's about 6% away. This is also a cup and handle, and this is a handle path. So if some may even buy above this handle, the highest point in the handle, which is also like what, some 4% away. But my strategy has been to buy, if I see a tight range, then I will buy a stock when I see a strong start. And for me, strong start is, yes, so this, on 28th March, this day was extremely small, narrow, and was completely inside the previous day. And like I said, I am not a person who will buy only above this point or above this point. For me, this was a stock worth trying the next morning only if I get a strong start. For me, strong start is, I want a gap up opening, which means price should open above the previous day close, which is this point, and it should take out the previous day high. And at that point, and it should happen in the first 5 minutes. because you already have, in the first 5 minutes, you have some action. Like you can see the price open way above this line and cross this line. And at this point, it had a great relative volume, which means in the first 5 minutes, it has already done some 7-8% volume. By the end of the day, it is expected, or you can project that it will cross the average line, or it will be a high volume day. That's, for me, that's a strong start. And I will buy that stock immediately. This is what I used to, I've done like all these last years. But recently, I upgraded it to, I added one condition, which is V. So S is strong start, which is the gap up opening. R is a good relative volume. And O is the break of the opening range, which is here. All three are there. What is V? For me, V is, okay, before, there is this concept of market profile where, so I'm interested only in volume and price. I don't really clutter my screen with too many indicators. All I look for is price and volume action. So on the daily chart, these volume bars are like what happened. This is the volume for the day. For 15th March, this is the volume. For 18th March, this is the volume. But it does not tell you that how much volume was done at, let's say, 804, how much was done at 813, how much was done at 819. So what market profile does is, it's a volume profile. It plots the volume on price axis, and then you can, I'm not going deep into it because I don't really follow. I just picked up one criteria from it to improve my strong start success rate, which it has really improved. So what I do is, there is this indicator, session volume profile HT, and you plot it here, and you will get these lines. So what these lines are, it shows the 70% volume was done in this price range. Here the 70% volume was done here. 70% volume of the day, like the majority volume happened here. So for me, V is if the price is also opening above the previous day value area, which is the 70% price action happened here. 70% trading volume happened in this zone. If we are opening above that, for me, that's V. So when all four are there, for me, that's a SVRO trade, and I will buy that trade at 903.55. In this case, it is above this high, which is 904. My bad. Yeah, it's 904. So I will buy this trade at 904, and then it got triggered here. I'm just changing the time interval to show the result. For me, this is a SVRO trade. And to explain you in numbers, if I buy here, I make 14%. But because of that early entry, I bought at 904. I'm making 20% in 3 days. So that's extra, like this is 15 and this is 20. I make extra 5% by not waiting for that obvious zone to trigger, which is this or could be this. Like many people say that why are you not waiting for the resistance to clear out, and why are you buying so early and all that. There is no guarantee that you buy above resistance and you make money. There is no guarantee that you buy above strong start, you make money. You have to find your true sweet spot. And I've taken so many trades like this that I'm so comfortable here buying after a tight range. And then if there is a strong start in the first 5-7 minutes, and you can do this on any time frame. If you're comfortable doing on a 5-minute frame, do it. If you're comfortable on a 15-minute frame, do it. After taking the trade, don't go on those frames and manage it. Just watch the daily frame and then manage my trade with that. I go smaller frame only to see if there is a strong start and it is opening above the previous day value area or no.
And for that
Any
example,
questions?
yeah. For that example, could you touch on where you're placing your stop loss as well to keep it tight? Because that's another benefit of entering early is you could keep your stop loss a little bit tighter. So maybe walk through that and your general process for determining what your stop and position size is going to be.
Yes, so that's exactly why I'm buying early, because if I buy here, then I have to my stops are usually at the low of the day, or like I said, 2%, 2.5%. But if I buy here at 9:43, then my stop at low of the day will be 5.37%. So with that, I only make 3 times my risk, which is only 3-hour trade. If I'm risking 5% and making 15%, I'm making only 3 times my risk. But because I entered early at 9:04, I'm making about 20% with a stop of 2%. So for me, the same trade is 10-hour trade, and for somebody else who bought here, it's a 3-hour trade. Huge difference, and these huge differences will change your there will be a significant difference in your trading performance.
And I also want to walk through in this uptrend. I noticed if you zoom out just a little bit, Manas, the volume. If you could scroll back just a little bit, so you see more of the trend. I love the volume profile in that move higher. Big up volume, all of that. Is that something you consider as well in terms of prioritizing one set versus another, the quality of the trend before the actual base that sets up?
So it's a huge, like I said, I only look for price and volume. For me, if I see a stock with volume, like this is a 22 million movement in this stock, and for Indian markets, that's a huge volume in one stock. If you have a stock which is moving like volume in 40, this is 46 million, then you have 50 million. The volume is here. It's an institutional volume. For me, I am not going to go run scans every day. For me, this is a stock worth going into focus list, and I'll keep a track on it, and I will drop everything for this stock if it is setting up. I remember this happened. This was my trade in last year, 1st April, and in fact, this stock kept going for many days, and then it offered and here also you can see the volume is same, 11 million, 15 million, and few days later here another entry which I can explain. I took with the same concept of strong start.
Mm-hmm.
So
another
they
really
will
tight
keep
day
offering
before
you
the entry too.
Yeah, so these stocks are, they're going to set up again and again. If you go back to the history of this stock, you can see that it was setting up every time it went below the base, came back up, set up again, then again correction, set up again correction. This is where I bought, again a good move. This has been a leader of darling stock of the Indian market in 24. And even now in 25, it started doing some movement. The whole sector is working well. So to answer your question, for me, this volume is everything. If I have a stock which is moving 10 million, 15 million a day, it is going to be in my focus list at the top.
And this one it also had a really tight day the day before the breakout. It seems like that's something that you really focused. Yeah, very tight day.
Yes. So on this day also, again, this was your another entry. You can see that next morning you have it. There was an undercut and immediate reversal and strong. So you have a strong start. You have closing above previous day value. You have relative volume, already 19% in the first 10-15 minutes.
Mm-hmm.
And in the next bar, you have an opening range breakout. For me, this is a perfect SVRO trade.
What relative volume are you looking for in that first 5 to 10 minutes? What's a good value that suggests to you that volume will be above average?
So in the first 3 minutes, I want about 7% volume. So after that, sometimes volume at 9:18 can be 5%, but immediately there is a big order and the volume jumps to 10%. I can consider that. So what I'm looking for is, if in the first 10-15 minutes you already have 10-15% relative volume, then you know that today is going to be a high volume day, and all breakouts. I've started my winning trades multiple times, and for me it's a fact that trades don't move big without big volume. You need institutional volume, which is why these purple dots, it's an indicator that I created. It's already available on TradingView for free. It is nothing but a day with more than 5% movement and more than 500,000 volume. So when you have a stock with multiple purple dots, I don't need to go and look at the number. I know that this stock moves with big volume. It's a fast moving stock, and as a swing trader, that's my dream stock that moves fast and moves in. I can position myself in big quantities.
Yeah, perfect. And going back to the first entry, if you could stay on the chart, sorry about that. Going back to the first entry, that tight day that you talked about right before the day before, it also coincides with the retest of the 20 SMA that you've got there. Is that something you're looking for as well in terms of ideal setup? Would you like to trade them when they're as close to that moving average as possible?
Yes, exactly. So I bought here because it was close to moving average. It came after the correction, after the shakeout, it came back up, settled, and then it immediately ran up. I could not really add more. The way it ran up, I could not add more. So my condition is I'm okay letting the stock go without me, or maybe with small position, but I'm not going to add up in the air. So I let it cool down. Like I said, every stock cools down. They don't keep going up. They have to go through profit booking because there are short-term traders and they will take some profit off. So this stock settled down, and this is where it closed resistance for me. It's a pullback. Now I'm comfortable because the correction is there. It may not correct every time like this because it's still a young stock. It has just come out of the base.
Started.
Not every breakout after breakout, don't expect a base like this. In fact, it's a healthy sign that it's not coming below 20 again. I'm comfortable if it is close to it. And then it went tight again, and then I attempted. This is where I bought more. And later on again there was this is where it undercut 20 again, and on this day also I can again cover this part.
Yeah, that'd be great.
So now for me, this stock has pulled back and just touched 20 for the first time. I'm interested at this point. Next morning I want strong start, SVRO. Next morning we open like this again. You have a gap up opening. You are opened above. You're closed above previous day value, which is the 70% trading activity area. Then you have strong relative volume. You can see it's already 30%. All I want is O, which is the opening range breakout, which happened in this stock. For me, the trade got active at 1278, and after that, again, I'm sorry, I have to change this frame again and again.
No worries.
Yeah. Again went up. I got out. I sold everything somewhere here. This stock has gone up much further up from here. I can cover why I closed here.
Then it got whippier.
Yeah,
but still kept going. Yeah, great
kept
trade.
going up, but I sold everything around this point.
Yeah, before you talk about the selling aspect, the extensions, I want to, if you could walk us through your position sizing in this name. I know you said you added a little bit on the extra bits. Talk about both the risk management and the position sizing. And yeah, this would be great. So walk us through your process for this, because this, obviously, you mentioned this at the very beginning, learning the technicals, all of that. is only a small part of it, and sizing is really the most crucial aspect, both to get a lot out of a trade that works well, but also the risk management aspect. So yeah, walk us through your position sizing strategy and how you typically handle things.
All right, so this trade is up about 167%. Let's say I got out here, somewhere here, so let's say it's 94% up. If you are not positioned good enough, even this kind of move is not going to create any impact. Or if you are fully invested, you may get scared when it pulls and you don't ride the trade. So you have to create a balance. And for me, that balance is I try to, for every entry that I create, my average risk on portfolio is 0.25%. And like I said, my stops are within 2-3%, usually the low of the day. That creates the allocation per trade of 10 to 30%. So that's my position sizing strategy. So on every ad, let's say I bought 10 here, 10 here, and 10 here, and finally sold everything somewhere here. I'm not going to create, like there are people who will do 30% in the on the first trade itself. I'm not that person. I will create and test the position, and if it's acting well, then in the second entry I can be aggressive. I can probably put in another 15% and make it 25. And if it's still setting up, you don't get every stock which gives you 3 entries, but if you are lucky in that stock and if you get another entry, another maybe 5-10% here, and finally I have that 30% allocation, and when it goes parabolic, the distance, like you can see the angle changing, and the distance is also like quite much from the 20 moving average. This is where I sell, which is like selling into strength, and I'm out. Though the stock kept going higher, but the majority in Indian market, the average is that you get 20 to 40% move. But there is one tip that I can give is just study the nature of the stock. This stock historically has been moving like this, for it giving 87% here, 50% here. It's normal for this stock. So the average is 20-40, but if you have a stock which is moving historically like this, then you can probably stretch your expectation and go for the big one.
Yeah, excellent. And how did you arrive at those numbers? Was that just something to learn practice that, over time? I think a big mistake people make early on is they're risking, way too much of their portfolio on any given trade. How did you finally arrive at this kind of process for your position sizing?
So when I read Mark Minervini's book, the stop loss there, I used to take like what's there in the book. I used to take an 8% or 10% stop and 1% risk on on portfolio per trade. But eventually with practice, and I realized that my trades are not going to 10%. If they go to 4%, they end up going to 10% also. But if the stocks which are not going 4%, they are just going higher and higher. So I realized that I don't need to really give that much room. And then I started cutting down my stop loss I raised from 10 to came down to 8, and then came down to 6, and then 4, and then finally I'm very comfortable with 2 and 3. Maybe a new person will really, I get these questions a lot, that how are you taking so tight stops? It sounds so rigid and all that. I get it. I will suggest that you start with 6-7%, and with practice and with with every phase, every 10-15 trades, you study them, and you will realize that you are a better, after every trades you will realize that you're getting better. And with that, you can start cutting down on stops and take bigger position without risking anything extra. Like I said, somebody who bought here is buying at 6% with a 6% stop, but I bought here with a 2% stop and I made more money. But yes, this comes with practice.
Yeah, excellent. Walk us through your selling process. Are you looking for an extension from the moving average, an extension in the overall move, a risk multiple? How do you typically like to handle things?
All right. So for me, my major, I'm sure you know that selling is the trickiest part of this business. And because when you buy, you know that your stop loss is There's no confusion. You buy at 100, your stop is at 98. There's no confusion there, and it hits your stop and you're out. But when you buy at 100, it goes to 104, it comes down to 102, then goes to 106. And the upside is unlimited. So you confuse, should you stay, should you book? And these zigzag movements really create the confusion. So for me, my first rule is when you take a trade, you have to follow this rule. Either it hits your stop or it goes super extended. So in this case, this is just day one of the move. I bought here, this is just day one. Now at 968, I'm making some, let's say 8% on my trade. Now should I hold, should I sell? To kill all the confusion, I just follow this rule that I'm not going to interfere. Tomorrow it can come down and take all the gains away. But if I keep interfering like this, I'm never going to land a trade like this in my life. And I can tell you with my experience, and I can guarantee that you just need 5-6 trades in a year with a great allocation to really make your year. So when it gets extended, like I said, this is your, after the base breakout, this is your first base, this is the second base, a reset, and finally after this, when it got super extended, when you can see the angle has changed. Mm-hmm. This whole angle has changed.
Yep.
You have the largest bar and almost like very high volume. I started offloading everything. And this is, for me, this is the super extended. The distance from 20 moving average is also very high historically. And if you study the history, like I just said, 87% is very normal for the stock. So for me, it had already done that. It's already 100%. So I was like, maybe this is the top, and I got out. I started offloading in this zone. So for me, I followed the rule here. Sell only when it hits your stop or it goes super extended. And when I bought here, my stop was the initial stop, but when it started going higher, I am trailing it with this 20 moving average line on a closing basis. So when I say closing basis, you have to see the closing for a day or two. Like for example, many would say that this stock closed here below 20 on this day. This is where your stop is hit. What I want to, let's say this is today. I want to see how this stock is going to react around 20. So for that, I have to give some leeway, some room, I have to basically, to see the reaction, I have to be flexible enough. So I will not really trail with 12-1-1. I will just give some room so that I can see the reaction. I have that flexibility I have to allow. So maybe I call it emergency stop. I will, let's say, probably give an emergency stop somewhere here, that if this level hits while I'm checking the reaction, then I'm definitely out. Then I'm not going to wait for anything. I'm going to be out. And 2 days later, the reaction was, it closed below 20, but within the next day, I got not only the price reclaimed, I got another entry on this day. So this is why I follow it on a closing basis. And this is my emergency stop. And as it kept going higher, I will raise my emergency stop like this. Mm-hmm. And finally, it got extended and I sold everything. This is where you don't trail, because the stock has done historically what it usually does. It is 80%, 90% up. It's super extended. The angle has changed. Volumes are very high. This is where you don't trail anymore. This is where you sell at least 80, 90% of your stock and maybe try on the 10%. You can try your luck. In this case, it worked. Many cases, even in that last 10%, it does not work and it hits your trailing stop.
Yeah, perfect.
Any other question you have?
Yeah. Do you have a recent example of a base breakout that didn't work, just to show what a stop out looks like. Because like you said, 50-60% of the time we're managing risk and making sure, that we don't let our risk get too far ahead of us. So is there a recent example that comes to mind of a stop out hit on a potential base breakout that looks fine, but we never know if it's going to be a winner or a loser, and that's why, of course, we manage risk?
Like you can take this example itself at this point, though it's a pullback, you have a strong opening, you have closing above previous day value, and then you have strong relative volume, and the next bar there is ORB, so it's a valid SVRO trade, but nothing is guaranteed. It just improves your odds, and the next day, so my stop would be the low of the day. My entry is at high of this bar, which is 653, and my stop loss is 636, which is about less than 3%. And I think the next day it hits your stop, and if you don't close here, because you have a tight stop 2%, that extra 2% fall is you just lost twice as much if you don't close your trade here. So this is how it looks the advantage of small stops is that you can create bigger position with less risk, but you also get stopped out often, which is why I said to come to this part of the trade, you have to start with, let's say, 5-6%, and with confidence and with practice, you will know that you can manage with that, like 2-3% stops also.
Yeah. I also want to ask, especially for this trade in particular, obviously we focus on the technicals here, the strong trend prior to the base, the tight areas, the tight entry, all that. Do you care beyond the technical analysis, what the company does, what theme it's a part of? Does that factor into your analysis at all, or it's purely just the chart and supply and demand?
All right. So like I said, I am only going for like 20-40% moves, and I've seen that. I agree that earnings move, like stocks move, explode because when they have good earnings. But there are many stories, there are many reasons why stocks can go up even without earnings, and which is why I don't actually look at numbers. But there was a point I used to look, but I noticed that every trade I'm taking, 70-80% already have good fundamentals. So I stopped making it as a condition, because even now, if I bought Cochin on last year, you can go and check the fundamentals are great there. So I don't really anymore verify it, because I know that already 70-80% cases are good on fundamentals, but the remaining 20% I can still go and take if the price action is good. See, if the volume is 10 million, 15 million, something is happening there. It's not going to go up with this volume if numbers are not good, if the story in the future is not good. In most cases, this does not happen. So if for me, price action is way supreme over like numbers. They follow. In fact, I'm not saying that without numbers stocks can go up always, but the news will follow the price action if you have a stock which is moving like 30, 40, 50 million and the whole group is moving.
And are there any other factors like the size of the company or the price of the stock itself that helps filter out down your universe of potential trade targets?
Yeah, so another interesting thing that I learned from Mark Minervini was the float. I never knew the float concept, which is the free float, and which basically means that what is the size of shares available in the market. And obviously, if you have small supply and huge demand, the price will explode compared to something which is huge in supply. Then it will take a lot of money to move that stock. So I started trading only low float stocks wherein the supply is less. But with time, I created this purple dot. Like I said, it shows that this stock moves fast and moves like with big volume. Now, again, I don't necessarily go and check the float, because I can see that more dots means it's moving fast. And as a swing trader, that's what I want. I want a faster moving stock. Like, for example, if I'll show you a mega cap of India, there are no dots here, not even one. So clearly, I don't need to trade Reliance. I'm comfortable trading there because I can expect big moves here. So now I don't go and check the size because I want these dots to be like frequent.
Yeah, excellent. What's your process for identifying trades? Is there any screens that you go through, or do you just go through a lot of charts each day, looking for the setups, looking to see how things are shaping up, and then obviously diving deeper into, is it a stock that's setting up a pivot? Does the base look good? All of that. What's your general process for screening for ideas?
I don't really run screens every day. I have my focus list. I keep updating my focus list with stocks that I like, and the criteria is, like I said, I want a stock. Like if somebody is new and wants to set up a screen, the one screen that I will suggest, where you will not miss any stock which is exploding, is check the volume burst. Where is the biggest volume? Like for example, if the stock is this is today, and you ran a volume scan, you know that the stock exploded with 23 million volume and 11% up. Now I will put it in my focus list, and in the coming days, if it sets up, I know that I have to keep my priority here and I don't need to run scan every day. So volume scan is something that you can really that's one single scan that anyone can have, or maybe a top gainer scan. What is the top gainer for the day? And just select the one which is young, which is moving. This is young, like this is coming after a massive correction. And you have a huge base breakout. So this goes into focus list. And once you have a focus list of some 30-40 names, you don't need to run scans, and just look for an entry point in those names. And whenever the market crashes, those 30-40 names will the setup will look really bad in them. And then again, in that correction, look for stocks which are showing relative strength, which are showing volume. Update your focus list again. So volume scan I can suggest, but I will advise you to not run after scans, because you lose focus there. Every day you run a scan and then you ignore the previous result and you go after the new name.
Yep, great. Let's see. Are there any other nuances with regards to trading the Indian markets that you picked up versus, what somebody might learn reading Mark's books, which is much more US centric? Are there any differences or key things that you look for that you've tweaked, that you found helpful that, might be worthwhile to anybody who's trading the India markets?
Yeah, like I said, your markets are blessed with, you get stocks which are exploding 100%, 200%, 300% intraday. And for us, the maximum movement that we get is 20%. So you have to keep in mind that in a day, the stock cannot go, and again, not every stock can go 20%, only few stocks can go maximum 20%. So that's the major difference. When you swing trading in India, the average is, most stocks give you 20-30% average. Some are outliers. They move 70-80%. Like probably I can show another stock that the best move that it gave was 60%. This is 85%. On an average, so in an Indian market, this is the best that you get. So you have to keep that in mind. And when you know the limit, you know that this is your target area, this is your target zone, and you cannot be expecting a 200-300% move and then keep trailing. Because if the stock is already 60% up and if you still trail it, your stop is going to get hit. Your moving average, the price will close below moving average, and you will lose all your paper gains.
Yeah, great. And I'm interested in hearing the story behind how you developed the setup. Obviously, it's similar to Mark's, but it's your own spin on things. What was your process for studying winners, developing your process, and making it your own as well? So how did you go and develop the strong start technique and, this kind of evolution, the SRVO?
So Mark's is famous for VCP, volatility contraction pattern. I follow the same foundation. It's just that for me, contraction is not just like majority Let me just draw one. All right, so VCP is this, and you have a breakout here. That's what I learned from his books. And great concept. I follow the same concept, but for me, this is also VCP. It's a 3% white day, and now the volatility is down to 1.27%. That's also contraction of volatility. The price, sellers managed to crack the price 3% from the high. Here, they only could manage 1.27%. Clearly, sellers are not in control anymore. And because the prior uptrend is there, next day, buyers regain control. And you can see it's a strong start trade also. There is a gap up opening. This is your gap up opening. High of the day crossed. And I can tell you it had a strong relative volume also because the purple dot appeared at the end of the day. So I am looking at VCP from this point of view also, which I learned, like I said, I learned from that book. But everything is VCP, even a cup and handle is VCP. All the patterns are nothing but volatility contracting, and you timing your entry when the contraction is so tight that the odds are good that the stock will explode from there.
Yeah, great. I think you had a slide as well on general advice. Do you want to flip back to that one? Yeah, go for it.
Yep. All right, so I will divide this into two parts. And if you're a beginner, absolute beginners, if you're starting out, my advice to you, I've said this many times, that change your objective from making money to staying alive. Your account should not really, you should not blow your account and stay on the crease, so that you can see the second year and you can use the confidence and the experience of first year and start making some progress. Because usually people start with expectation that they will start making money immediately, and then they just get disappointed, and then for majority the game is over, the career is over in the first year itself. So change your objective if you're absolutely new. And if you're somebody who's been in this business for many months or years but still not making any progress, then I will advise you to just talk to yourself and find out what kind of trader are you. There are two situations, like same coaching trade. You bought it, I bought it here. It goes up and it pulls back. This is where some will start worrying and they will get disappointed that why did they not sell here. So are you this type of a person? What troubles you more? Seeing your open gains go to zero, or seeing your trade, you exiting a trade early and then it goes higher, much higher without you? What troubles you more? If you are this person, then when you're here, protect your gains, maybe raise your stop to this level so that tomorrow if it stops you out, you have made some money. But if you're this person where it stops you out, let's say this was your stop, and if it stops you and if it goes higher and this is troubling you more, then you need to follow your system and be true to it and not really interfere with your trade. You just follow with your moving average and let the market kick you out. If the trade has no more momentum left, it will trigger your trailing moving average stop, and you have to be okay with it, because this is what you chose. This is what you studied about yourself, that this is the type of trader you are. You don't want to interfere and you want to catch the full move. Then you have to let the market kick you out and be okay with the outcome. So I've seen a lot of people just struggle between, they say that they are this, but they're not okay with this also. So you have to pick your side and then set the sell rules accordingly. That's the advice that I have for people if you're struggling and already in this business for many years.
Excellent. And do you have any? Do you have a list of books that you would recommend for newer traders as well? likely Mark Minervini's books are in there. Are there any others that really stand out as being helpful to traders out there as they're developing their processes, or looking to unlock that next level of performance?
Yeah, so another book that I'd read is William O'Neill's book, and Trading the Zone. That's the main book if you really want to master your mind and have a strong mindset. Again, after reading it, you're not going to have a strong mindset. You will have to reread it read it once, take few trades, then reread again, and then again take few trades after after you have read it 2-3 times. You will have a stronger mindset, and that I can tell you with experience. And a lot of people I have advised this book, they say that they have now started seeing the difference for mindset, trading in the zone. And if you really want to improve your understanding how the patterns look like, read Mark Minervini's book and William O'Neill's How to Make Money from Stocks.
Yeah, I think I'd echo what you just said there. These books are fantastic. They're great resources, but you have to experience the stuff for yourself almost to fully grasp what they tell you. So, that makes a big difference.
Yes, completely. I mean, like I said, I changed my game when I read the Mark Minervini book. Before that, I was just doing everything. I would buy large names without stop loss, and I would expect big moves from them, but never happened.
Yeah, excellent. Well, Manas, thank you so much for your time in putting this together. Any last bit of advice or words for traders out there who that you basically want to leave them with today? Any key takeaways that you hope that people had from your presentation?
Just believe that you can also do it. The ones who are doing it are humans. They're not robots. It's possible. It will take time. Like I said, give your first year, change your objective, so you can be that person who's good at this business, but with the right expectation in the first few, make your foundations very strong so that you can see your third, fourth year, and that's when it's your breakout happens after 2-3 years.
Yeah, excellent. Well, Manas, thank you so much again for your time. Appreciate it. To everybody watching, hope you enjoyed as well. Leave a like if you did, and we'll be right back with the next guest. Cheers. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Don Vandenbord, who is the Chief Investment Officer and Senior Portfolio Manager over at Revere Asset Management. Really interested in the topic he has today. Don is an extremely experienced growth stock trader who has been trading since the 90s, and hopefully will share a lot of great experience and wisdom here with us today. So, Don, first of all, thank you so much for taking the time, and great to have you.
Rich, it's great to be here. I think you mentioned trading at the beginning, and being a portfolio manager for, we have over 900 accounts now and hit $300 million recently. There's a lot of difference between managing an individual account versus managing accounts for hundreds of people, but there are a lot of parallels as well, and hopefully I can share some of them and everybody will benefit.
For sure. Let's go ahead and dive right in. Let's get started.
All right. Well, let's start with what we do at Revere. And I'm going to go through a couple of points because there's a lot of we get questions all the time about people that maybe see our videos and they say, how can I get into your hedge fund, or is this a mutual fund? But what we are is an SEC registered investment advisor. We're fee-based, fully transparent, no conflicts of interest. We're a fiduciary. Everybody has their individual accounts, and they're all held at Charles Schwab. You can log into your account at any time, see what we're doing. And our flagship portfolio is named Growtection, and it's designed to do two different things: grow assets during uptrends and protect them during downtrends. For people who really don't know me, I'm passionate about this because 25 years ago, my father-in-law was dying of cancer, and he had his nest egg with one of the big brokerage houses, and they had no sell discipline in place whatsoever. The tech bubble burst, and he lost half of his retirement. I watched it happen. It was a terrible experience. At the same time, a lot of the money that I made in the late 90s, I lost as well. So they were as dumb as I was. There had to be a better way. So I started on a path to learn how to keep the gains that I made during the uptrends. It just doesn't make sense to give them back. But Wall Street has a conflict of interest. They need you to buy their products in order for them to make money. They don't ever, and they're too big, so they never want you to sell. It's like trying to turn a cruise ship around. So the individual investor has a lot of advantages like that. And I had this long-term vision of I was in IT. I wasn't passionate about it. I hoped to get out of it someday. And when I did, I wanted to somehow get into investing and helping people with the whole process of making money when the market's good and understanding when they can pull the plug and not give away their nest egg, which is especially critical when you're approaching retirement. So that's where Growtection came from. We're actively managing portfolios. We're trend followers. We look at 3 time frames and the action of leading stocks, and we update. We do videos every night. Myself and my coworkers, Ted Zhang, Connor Bates, and Todd Thomas. And Revere's been growing very well. When people hear about us, they like the idea of being able to sleep well at night because we can provide the returns to them and are completely transparent on what we do every night. So what they're seeing in their account is exactly what we're doing in our accounts because we've got all our money in the same strategy. So there's no conflict there. They benefit when we benefit. All the trades are made. There's something called block level trades. We don't have to go into individual accounts and buy them, obviously. We just know, like if we wanted to buy a 5% position in Apple, we just know how large our client base is. We buy that number of shares, and then the Schwab software puts it out into each individual's accounts. So basically, we're looking at what the trend of the market is first. In an ideal market, we'll be near fully invested. This is the major indexes all in an uptrend, just like they are currently, and growth stocks acting well. If the market starts to cool, we've been going up. It's almost historically the number of days that we've been above the 21-day moving average now, 58 days, I believe it is, which is just incredible. But At the same time, from a sentiment standpoint, the AAII survey has the same number of bulls as they do bears. So sentiment's very important. It's one of the secondary indicators that we watch. So half the people are still keeping the money on their sidelines if you go by that. So the market is set up to go higher. I mean, it's a bull market until it isn't, and what we're doing right now is riding the wave. And if the market goes from strong to neutral and then to absolute downtrending, the moving averages will roll over, will significantly reduce exposure. The worst case scenario is when the indexes break the 200-day moving average. That's where all bear markets occur, and that is where you've got to be able to willing to get out of the way, because a bear market, normally when you break the 200-day and stay under there for a little while, you're about 12% off of the highs. But we know, and I'm going to show a slide momentarily, we know how bad these bear markets can get, 30, 40, 50%. So the 200-day moving average is key in our process, and risk management is our number one priority. If you minimize the drawdowns, the gains will take care of themselves when the market rights itself. So we've got a bunch of rules for getting out. We've also got rules for getting back in when the market improves. So that's a little overview of what we do at Revere. This is that slide of those bull markets, or bear markets I was talking about, Richard. I actually, in the middle of, you interviewed me on your for your YouTube channel in, I think it was the late summer of 2022 when we were in a bear market where we were in the process of dropping 27.5% because of the inflation scare. So here we are 3 years later. Now we're right on the complete opposite end of the spectrum. But since then, we also had this severe, some people say it wasn't a bear market because we technically didn't close 20% below on the S&P, but we know what happened with some of the other indexes and with individual names. But this was recently added to here, and everything that we do is designed to avoid these. These are killers, and killers to your portfolio, especially if you're approaching retirement. If you're young, you have time to recover, but really, is there any reason to ever give up 30 or 40, 50% of your money to the market? There's not, if you follow some simple rules, and I know that's you've made your life's work into introducing people that can train you and instruct you on how to do that. So I've made every mistake under the sun, and anything that I can learn to reduce the learning curve for anybody, I'm very glad to be able to do it. And I think one of the main issues for people just getting exposed to the market, why do they get frustrated and why do they underperform? There's four major categories that I think I've identified. And with my IT background, we're trained to solve problems in IT, and the market is one big mystery that's wanting to be solved every day. So here are some of the different solutions that we've came up with. The first one is cash drag. So if you have a sell strategy and you're out of the market goes down. In this most recent tariff tantrum bear market, we dropped quickly, we recovered quickly. If you were all out, suppose you sold at the bottom and then there was that 11% up slingshot day on the S&P 500. Now you're behind the eight ball. So you're in cash, but that's a big cash drag. How do you solve that problem? I'm going to talk about something called rare rules, which is this came about at the end of 2022. I thought we could improve getting back into the market quicker than we could while leading stocks were setting up. So rare stands for Revere Aggressive Index Reentry. I'm going to talk about some of those rules and some guidelines that we have to get your money into the index with some reasonable stops, allow leaders time to set up before you start digging into them. So the second solution to cash drag is something called RVAB, which is Revere Volatility Adjusted Beta. This is a calculation that we came up with. Everything that we own, we look at two parameters. Every stock that's out there. What is the stock's beta? What is the stock's ATR, average true range, over the last 21 days, and compare that to the average true range of the S&P 500. That gives every ticker a score, and based on that score, it allows us to decide what the position sizing is going to be to reduce risk, because there's nothing worse than a sold out bull. People always say, well, what is the proper position size? The proper position size is one that you can stay in without getting shaken out by a normal correction because you panic. And that's honestly one of the holy grails if you're going to be a trader, is being able to withstand those times when they came up. So that gets to number 2, which is improper entries, either buying extended or buying too large a position. 2 solutions for that is, anybody that's a trader, I'm sure, is familiar with their R size. Your R is how much am I willing to risk on an individual trade. Well, we're going to add this volatility adjusted beta into that calculation to help you be able to stay in. And another solution for not buying extended stocks is to use a 60-minute stochastic when you're wanting to add. This does not apply to like a gap up or a breakout, because you generally are at the top of the basin, sort of above the 60-minute stochastic, but I'm going to show a couple of examples on that for how to get in. The other one, like I mentioned, shakeouts. How can we avoid these? We came up with something called RPRP, which stands for Revere Positional Risk Parity, and it's a way to you often hear people say, well, I need something slower for my portfolio because I've got all these faster moving stocks. Well, we created a calculation so that you have the same amount of risk for each stock by adjusting it for this, so we can smooth the risk across every position by doing proper sizing based on the score that we gave it for its volatility adjusted beta. And the second solution for shakeouts is overshooting obvious stocks. I see people all the time saying, I'm long with a stop below yesterday's low. Well, my first question is, are you really going to put a stop 1 penny below yesterday's low? Because that's where everybody else's stops are, and that's where the algos are going stop hunting. You better move that down 1% or 2% to allow for those algos to go and collect all those other stocks, and you survive that shakeout by not getting stopped along with everybody else. And the fourth one is not taking profits on the way up. William O'Neill, the legend, one of his key rules is buying at 20 to 25% above a proper pivot. And I think a lot of people fall into the, I bought this stock, this is going to be the next big thing. They fall in love with the story and they just think that they're never really going to sell it. People say ride your winners, sell your losers. Well, at some point you've got to start taking some money off of the table, or when you get one of these days like the DeepSeek day, or we had one 2 weeks ago where all growth stocks got hit really hard. All of the gains that you accumulated over the last couple of weeks are just going to go bye-bye, and then you're going to get frustrated, and nobody wants to be in that situation. So one of the solutions is offensive selling. If you're 4 ATR away from the 21-day moving average, you're historically extended. Sometimes the odds are, and trading is just an odds favor. There are no absolutes, obviously, but odds favor you're going to have a pullback. Take some off if you're ridiculously extended to the upside. The second one is this easy 8E system, and I'm going to show a chart a little bit later. The best stocks in the strongest markets seem to just ride their 8-day exponential moving average. Some people use the 10 simple, and they're almost interchangeable, but not always. They just seem to ride that 8 EMA higher for weeks at a time, but that first break after that, you better be ready to pull the trigger, because that's a change in character when something has been obeying a moving average for a long period of time. And taking profits, everybody has experienced getting completely sold out of a stock and then watching it double after you got out of it. The solution to that is always leave a run, or make that last sell a defensive sell, meaning it broke a key average, instead of just saying, well, this is up so high, I'm going to blow it all out. It can't go any higher, and then obviously it can go higher because we've all seen that. So those are four problems that I've experienced in my career. I know a lot of traders experience them too, and some solutions for addressing them. And one point I want to make as part of this as part of this presentation. It really goes to the heart of one of the reasons why you do what you do, which is you're a trader. You want to be in the best stocks and the best markets and know when to sit out. That is a form of alpha if you acquire that skill, and that's why you've got so many people and you've become as popular as you are, and the guests that you have are as popular. Knowing how to properly vary your beta is a form of alpha. Everybody says, you've got to trade your system, but you have to make sure that your system has a statistical advantage over just haphazardly entering and exiting. So until you know that your system has a positive expectancy, don't say, well, this is what feels right for me and my system, until you're assured that you have the stats to back up and you're making progress, consistent progress over years in your account. Otherwise, you're still learning, and you better be open to all outcomes as you do things. I'm reading, I just read a book where the guy talked, he had some stats from over in Europe. I can't remember the name of the book. I finished it about 2 months ago. It has a white cover on it. I don't have it right here in front of me. Anyway, the point is over in Europe, they had a rule that if you are allowing people to trade on your platform, you have to present statistics for how many are successful or not. And he poured through millions of trades, and 90% of traders lost money. I guess those 10% are all on Twitter, because it doesn't seem like anybody experiences something like that. Like I said, I've made all the mistakes, and I want to go through some of the rules. I offered some possible solutions here. I'm going to dive into them a little bit more now, with the goal of properly varying your beta as a form of alpha. If you're a trader and you're not beating the market, you're not being successful. If you're being honest with yourself, you could just put the money in the S&P 500 and ride the market higher. The trend is to the upside in the U.S. markets. We're very fortunate to have that. But that long-term trend comes with a lot of short-term and intermediate-term pain, as we've seen over the last number of years. Yeah. So some of the tools that we use a trend gauge in our video every night. This is tracking the trend. It seems rudimentary, but it really is that simple. Look at the trend over multiple time frames, and then ask the question, how are leading stocks doing? This most recent uptrend started in late April 2025, and I'm going to go through 10 steps, that checklist that I created, as you transition from a bottom in a bear market to what seems to be a bullish market. You never know for sure, but here we are 3 months later, and it's been a pretty good opportunity to make money. I'm going to talk then about position sizing, that volatility adjusted beta, and positional risk parity. A lot of traders probably don't care about this, but these are, or they'll say it's too complicated. And if you're successful, don't use it. You don't have to use it. These are tools that have improved the returns for Revere Asset clients, and thereby my returns over the years. So every time we find a weakness in our process, we try to adjust it. And these are, again, some of the solutions that I've come up with to various problems. Critical is knowing your open heat, or your balance at risk. This is a calculation that we can provide to our clients at any time. Try to find another advisor that's going to do that. Most of them just say, think long term, hang in there regardless of what the market's doing. But we think we're pretty good at determining a healthy market from a risky market, and we're glad to be able to provide that. And if you don't know what your open heat is at any time, you're introducing the possibility of your emotions are going to have you bail on all your positions. If you don't know, okay, if all my stops got hit, I know I'm going to be down 4.5%. If you've accepted that going into the trading day, then there's no reason to panic during the trading day. And I'm also going to talk about index positioning, because we're a very strong proponent of this. Talking about those aggressive index reentry rules and maintaining a core position in the S&P, and I'll talk about that a little bit. Why? One of the reasons why is because you can't trade a small account or even if you're an advisor, you can't trade 20 million the same way you trade 300 million. We're seeing a lot of stocks that 10 years ago we would have been very easily been able to get in and out of them, and we're just not right now. That actually has been that was a problem that we needed to solve. The way we solved it is Ted and Connor. We created a portfolio called TurboTection. Same rules as Grotection, except it can be more aggressive, own more crypto, and own some of these smaller names that we can't get into anymore in Grotection. Stock selection, that Easy 8, riding the ADMA. I'm going to talk a little bit more about that. And basically, the go-to rules that we use at Revere is buying on strength using volume breakouts or episodic pivots or monster earnings gaps. Could be on news, but most often it's on earnings. And then adding to positions on weakness when the strongest stocks pull back. So we're going to use that 60-minute stochastic cross and pulling back to the 8-day exponential moving average, sizing appropriately, and then the traditional pullbacks to the 21 or the 10-week moving average / 50-day moving average. We're going to combine those buy rules with some sell rules. I talked about the main offensive sell rule that we use, 3 to 4 ATR extended above the 21-day moving average. And then defensive sell rules, your initial R stop. We use 0.2% of the total AUM. That's on the tight side, but we're looking to get in. We want it to be acting well and then pyramid into it as quick as possible. And then once you're trailing things up, a break of the 8-day moving average in a bull market is critical because you have I can show multiple examples of how these leading stocks tend to ride the 8 EMA up. And then after you're making progress using a break of the 21-day or the 10-week / 50-day to get out of the rest of your position. So that's, again, using trailing a defensive sell for the last portion of what you're holding. So I talked about the trend gauge. This was the trend gauge on the left over here in late March. This was during the tariff tantrum that the market was throwing. There were no leaders. They all had broken down. All the major indexes were below their short-term 21-day moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. This is the time to get the heck out of the way and let the market sort itself out because better days are going to be ahead. This is an example of what the trend gauge looks like right now. All market leaders are acting well. All the major indexes are above their short-term, medium-term, and long-term moving averages. So we've got the green arrows there. However, they're a little bit extended. This was, I produced this slide last week, and we had just put on this yellow caution because historically you get a percentage above the 21-day or the 50-day, and you almost know you're going to have a pullback. So that's why we introduced these. Basically, that's saying, look, the market's extended. Now is not the time if you have a bunch of cash to pile in. The market went sideways for 2.5 weeks, and we busted out of that range today. So much for my warning. But anyway, we took this one off yesterday. We're still having the medium-term one on the warning because we are still historically extended above the 50-day moving average on the NASDAQ 100 and the S&P 500. Here's that 10-step checklist coming off the bottom so I titled this 10 Steps from the Bottom to a Bull. And this mostly applies to the indexes. We use the S&P 500 as money managers as our baseline. And the first thing you want to do is regain the 8-day moving average. You could be very stretched to the downside, but you want to get the indexes regaining that downtrending 8 EMA. And then the next step is the 21-day. And around this time, you'll be 4 more days off of the low. We'll look for the classic O'Neill follow-through day. And then we don't want any distribution days to pop up after that follow-through day. So little by little, we started checking these off back in April 23rd, 24th, 22nd, 23rd for the follow-through days. Then you want the 8 to cross up through the 50, and these are all just guideposts of strength. And if they're not happening, the rally is not as strong as you maybe would have hoped it to be. Fortunately, we ended up getting all 10 of these The last one just on July 1st, the 50-day crossed up through the 200-day. That put all the moving averages in the preferred shorter term, above medium term, above long term setup, and it was confirmed by good action in leading stocks. And I'll show a slide later how we've managed this over the last 3 months at Revere. So diving a little bit deeper now. This is the calculation that we have a data scientist who's going to come on board full-time in September, but we gave him a task as he was working part-time for us to do a bunch of back testing and determine how does the volatility of an individual name impact its, let's say, its holdability. How difficult can a stock get to hold based on its volatility and its beta? So a bunch of back tests we ran. This may look overly complicated, but it's really not. All you need is the ATR of the S&P 500, and then for any ticker, its beta and its ATR. You take 76% of the beta, 74% of the beta, 26% of the ATR, and that just gives you a number. That number is called the volatility factor, and then you divide that by the ATR of the S&P 500. So you can baseline everything against the S&P 500. The ATR, and this is kind of amazing, the ATR of the S&P 500 during this most recent bear market that we had with the tariff tantrum got up to 3.5%. Right now, it's down to 0.82%. That's also another secondary indicator that we use in our nightly videos. You want to see the ATR of the S&P ideally below a 1. That equates with a VIX of 16 or below. That's a healthy environment for the overall indexes anyway. And as we know, 75% of stocks will do what the overall market is going to be doing. So we certainly want that in our favor. So basically, that's the calculation. You get it for every individual name. You add them up, and this gives you a score for your overall portfolio. So that if you had a portfolio that was just 100% in the S&P 500, your score would be 1.00. If you had a portfolio that's 100% in the SSO ticker, that's 2 times the S&P, your score would be 2.00. So this is a way to compare the score of your portfolio versus the risk in the overall market. And typically, like right now, Turbotection is more aggressive than Grotection. They're around a 2. Grotection right now is around a 1.3. And it's just a matter of how aggressive you want to be with individual names, and then also the crypto-related names have a higher volatility, so they've got a higher score. That translates over into your score for the overall portfolio. So this is how this is the calculation to normalize the volatility and the beta of every individual ticker. This is very similar to the prior slide where we're just showing this is a sample portfolio. This isn't our current holding, but it's the adjusted beta of each name times the size gives you the weight of the overall portfolio, or the score for the overall portfolio. Then the next question is, how volatile is the stock, and how does a position size in not so volatile stock X translate and give me the same risk to a very volatile stock Y? And we'll talk about 2 things that we have in the portfolio right now. Apple has a 1.4 volatility score. Coinbase has a 3.8 volatility score. So if you are, the way we manage portfolios, we normally have, we're kind of in here, 7 to 12 names. And if you want to balance the risk across all of the names, let's use this column here for 7 to 10. This says that a 10.71 size in Apple is equated to the same risk as a 3.95% size in Coin. So this allows you to smooth your risk across all of your individual names if you wanted to have the same risk for each individual name. Are you following me? Does it make sense the way I'm explaining it?
Yeah, can you show one more example just to really cement it?
Sure. Uber, something we just got stopped out of, has a score of a 1.8. So an 8.3% size in Uber, something else. Let's suppose you own the triple Q. That's the equivalent of owning a 3.57% size in TQQQ. In other words, over an extended period of time, the risk on a daily basis is the same for those different position sizes when you're comparing two different tickers with massively different volatilities.
Perfect.
Okay. So that's positional risk parity. The next thing is balance at risk. This is critical from where I sit to reducing panic during the day. And basically, what we do is we take our stop for each individual position that we have, and this is actually our current portfolio, or it was as of last Friday. We determine where our stop is. So in some cases, we're using a 10-week moving average, sometimes the 21-day, sometimes the 8-day, sometimes the 50-day. We're taking our stop, adding a little bit of a factor to it of 2 to 3%, depending on the volatility of the individual holding. So if all of our stops would get hit tomorrow, this is what the drawdown for the portfolio would be, 5.08%. Going into the trading day knowing that you can live with that certainly presents the opportunity for you not to panic when the market is plunging, because you already know, all right, if my stops get taken out, they're well thought through. I know why I put them where I put them. If they get taken out, they get taken out. That's just part of trading. So this is a snapshot on a daily basis, and then we track it, because what you want to see is as you're making progress. This starts back in June and goes through day by day up to 7/15. As you're making progress in your portfolio and you've got your balance at risk, how much money can you consider to be banked, right? What's the floor for what you've gained? So as of 7/15, gaining 13.97, you have a balance at risk of 5.48. You're going to make, since this rally started, if all your stops get hit, 8.5%. The smoke clears, you wait for the next rally, and now you're compounding your capital from a higher base than if you rode it all the way down through the bear market. So tracking those on a daily basis, and you can seeing the floor rise as your returns rise. I don't know how you could not get a good feeling out of knowing that, hey, I've locked this gain in, I've accepted the risk of what I'm holding right now. Whatever happens in the market, I know what my numbers are going to be.
It's such a huge mental shift too. It gives you confidence because you know you're going to put a higher low in your equity curve. You're not going to round trip it and give it back. And that's confidence is huge when you're trading or investing. And this puts you in a win-win position, basically.
Absolutely right. That's the whole point behind it. I'm trying to take as much emotion out of the process as I can and just be mechanical. Emotions are always going to come into it. I'm a naturally conservative person. Every rule that I've made up over the years, more of them were to keep me in the market than get out of the market. You know, once you discover that you've got a sell strategy, a sell discipline, that's a good feeling. But then sometimes that can be a nail, and you use that as a hammer to hit everything. And you say, look how smart I am. I'm out of the market. Well, the market just rebounded 6% yesterday. So overusing stops is as bad as not being long enough in the market.
Yeah, and sorry, I've got one more question. I see, in some days, it looks like your rebar was over 6%, and it's highlighted in yellow. What's kind of the range that you guys are shooting for at Grotection and Turbo as well?
What we found is, for Grotection anyway, once I'm over 6%, the market is historically extended. So that's just a warning side to me that everything that I own is pretty far away from its stop on the upside. Our goal is to not draw down more than 10% from the high when we go from bull market to full-blown bear market. And this is once we get to 6%. Now you say, well, this says 6%. Well, what about if it gets to 10%? Well, if you pull back in the market and then stop going down, you're going to re-enter and you're going to take on more risk. So you could give some back. You start a new upcycle in the market. Suppose that rally fails right away. So being at 6%, if you go from bull straight to bear, that's great. but 10% is the guidepost that we use. We would love to stay within 10% of our equity curve at all times.
Great.
Okay, so I mentioned after 2022, looking at our results versus what the market was doing, I don't think that we got back in quick enough in a lot of circumstances, a lot of different situations. So this Revere Aggressive Index Reentry, this was, we worked with our data scientist on this too, and what we want to determine is when should we start getting back into the market, and to what degree on the S&P do we want to get back into the market? At Revere, we use half of the portfolio for index ETFs, either 1 time, 2 times, or 3 times, and half of the portfolio for growth names. It helps smooth the equity curve substantially. I'm going to talk a little bit about how leveraged ETFs are very often a better option than individual stocks if you want to pick them, because you're spreading the risk across the index, as opposed to a stock that you're in doing a massive secondary offering overnight and you wake up and it's down 8%. So these are the rules that we settled on after some back testing. As soon as if you're under the 8-day moving average, the most you want to be in the market is 20%. If you're under the 200-day moving average, we could go as much as 20% short. So suppose we bottom, we start to turn back up. As soon as we get back above that 8-day moving average, we want to start getting back into the market. And this is what we use. Our core position is 30% in the S&P 500 for 2 reasons. 1, smoothing of the equity curve. 2, on those days when all growth stocks get hit, and we've seen those days over and over and over again, what you frequently see is that's not a market sell-off, it's a market rotation. The money is coming all out of growth names and it's going into value names. If you look at the value half of the S&P 500, it's not uncommon to see it up 1% on the day, while the growth side is down 1% on the day. So being in the S&P 500 catches all of that rotation and can certainly help you to maintain your sanity, as opposed to being 100% in growth names that are all getting hit. And I bring up DeepSeek, but that was something that was out of the blue. Everything involved in AI data center names that day got clobbered, and us having half of our portfolio in the S&P 500 certainly dampened the volatility on that day, although we still got hit pretty hard. So, and then we just establish ceilings and floors as we make progress. Again, going back to that 10-step. We get back above the 21-day moving average. We want to have a maximum of 30%, a minimum of 20%. If the 8-day exponential moving average gets above the 21-day, we want to take it up to 40% with a 30% floor. If you get above the 50-day moving average, but the slope is still negative, you get the picture. Establishing ceilings and floors. This is aggressive re-entry off the bottom when you're under the 200-day moving average, and you're looking for a market rally, and then to determine if it's going to go from a bear market to something where you can actually make money. So those are the. Go ahead.
Sorry. Yeah, just a clarification question. So 50% here would be fully invested in that part of the position. Is that correct?
That is correct.
Gotcha.
On the index side.
Yep,
but
exactly.
what we would be using is there's multiple ways of doing it, but that would be with a 30% one time and a 10% SSO that gets you to 50, but not using up all of your capital on that side. You still have 10% left, and if the market starts acting very well, you can put that 10% in a triple leveraged and get your S&P exposure up to 0.8, which is somewhere where we would like to be under ideal situations, when you're above the 8, you're above the 21, you're above the 50, and you're above the 200. And speaking of exposure rules, this is the rule on the S&P 500 in a healthy market. And again, this is something that we've back tested, and a correction in a bull market typically stops around the 20-week or the 100-day moving average. So the situation, it happened a couple of times during the last uptrend before this prior bear market. If you look at a weekly chart of the S&P, you see it bouncing between the 100 and the 150 day, actually on a weekly chart, the 20 or the 30 week. So we don't want to bail on the market. We want to maintain this core exposure unless the market really starts breaking down. And by breaking down, we're going to break the 200-day moving average and then actually more than 2 ATR below the 200-day moving average. Usually, if a correction is going to be short-lived, sometimes you hang around that 200-day moving average. It's when you get the hard break below the 2 to 3 ATR that you really want to be out of the way and considering shorting any bounces into moving averages. But that's a whole separate discussion. Now, the Easy 8 system that I talked about. This is Hood. This is a current chart of Hood from January to August. We've been fortunate enough to be in this. Most of the time we got into it back around here. But this light purple line is an example of how these leading stocks, this is, if you said, I want to get a leading stock, what's the textbook picture of it? It would look something like this, where they just continue to ride the 8-day exponential moving average up higher. Eventually, it'll break the 8 EMA, and when it does, that's a change in character for the stock, and you should act accordingly. That's the time to lock in profits and maybe leave a runner if it goes down to the 21 or the 50-day. So this is, the holy grail of strong stocks in an uptrend during a bull market. This is what we're looking for on a chart for them to act like. This is an example of, not an example, these are the actual trades that we made in our portfolio in Growtection, starting with, you can see that here's the tariff tantrum. So I talked about how we want to get out of the market, right? Breaking the 200-day moving average. That's the black line on here. This is the overshoot area. And it also corresponded with a big support level at 5,500 at the time. So we bounced off that level. We came up to the 200-day and failed. We were still maintaining that 20% core in the S&P 500 out of all of our individual names. And then we broke this level. This was the tariff tantrum, the double gap down, hit minus 20% on back-to-back days. This was our exposure right here. And a point I want to make here, you frequently hear people say, well, how much cash do you have in your portfolio? We never say that at Revere. What we want to know is what our portfolio exposure is on a volatility-adjusted basis compared to the S&P 500. So I put this on here for comparison because we monitor our cash. Obviously, we have to know how much we have available to buy. But this is a week-by-week description of what our exposure was to the market as we bought and or sold these different tickers as we starting with the follow-through day, the week of 4/22 and 23, and then the next day, the next week. These are grouped by week. It's just impossible to do it on a day-by-day basis. But the box pretty much lines up with the week down here. So this box, for example, is the week of 5/2. This is the week of 5/16, etc. And if anybody wants to review this later, just some of the symbols that we use, these minus O's, that means we sold some offensive selling. Okay, using that +4 ATR rule that I talked about. This is an example of us cashing out some of those profits when we're extended. If it has an X after it, that means we got stopped out completely on something or closed the position. A plus sign means we bought it or we owned it and we added to it. I think that's basically it. So the biggest mistake in this uptrend was getting stopped at Credo on a shakeout and then after its gap up and then not re-entering the position. But again, that's a psychology standpoint. We're not going to get every trade right, but that's probably the biggest one that I regret from out of this recent move. So this is how we've traded the rally. And this is a discussion for are you better off using ETFs versus individual stocks? If you're just starting out, I would recommend a beginner split their portfolio in half every time they make a buy an equal amount in the S&P 500. If the S&P 500 portion of your portfolio is growing and your individual stock portion is not, you're not beating the market. Very obvious to say. So we make big use of these leveraged index ETFs, SSO, UPRO, SPXL. Sometimes we use the inverse ones to hedge. But I went back through the 55 trades that we did in Grotection during this bull market, and I wanted to compare. I'm also going to recommend to every trader, this is something that I do meticulously. As soon as I buy something, I record where is the S&P 500 at that time. And I keep it in a spreadsheet, and I want to know if the S&P 500 is up 2%. My stock ideally should be up 4 to 6% because we're only looking for stocks. The goal of the stocks that we buy is that we only want to target stocks that provide the opportunity to return a minimum of 2 to 3 times what the S&P 500 is doing during the holding period. So the point being, why be in an individual name when you can make more money in the index ETF? Okay. So out of 55 trades, 35 winners, 11 losers, 9 break even, meaning plus or minus 1%. No impact to the equity curve, basically. So out of those 30, let's talk about the losers first. Out of those break-even trades, I broke even in the portfolio, but the S&P 500 made more money. So that means that my trade did worse than what the S&P 500 did. Okay, I actually lost a slight amount of money, or made a very small amount of money, but the S&P made more. The next category is 0 to 1 time the S&P 500. One break-even trade fell into that category. Now let's talk about the losers. All 11 of the losers, I lost more than the S&P 500 did during the time. And again, this is why I think it's so key to track what the S&P is doing while you're in a position from when you started to when you sell it. So out of those 55 trades, 35 of them were winners. 4 of those winners were actually, by the definition of we want 2 to 3 times the S&P, and this also allows you to focus on just the more aggressive names. There's no reason to buy something if it's got a relative strength line that's flatlined, right? That means that it's doing what the S&P 500 does, but you're taking on the single stock risk. What's the point in doing that when all it's going to do is give you the market index returns? So by definition of less than 1% and 1 to 2%, 13 of these trades were winners, but by our criteria, we didn't meet our goal because we want to do 2 to 3 times what the S&P is doing during the holding period. 7 of the trade made between 2 and 3 times. So in other words, everything over here beat our goal. 7 plus 5 plus 6 plus 4, 22 of the trades beat the S&P 500 by a factor of 2 to 3, 3 to 5, 5 to 10, or 10 or more. So what this tells me is it's a bull market. We're doing well. We're making progress, but only 20 of our 55 trades outdid the S&P 500 by a factor of 2 to 3 or more, which is the goal that we're trying to accomplish. And that's why it's so critical to also not only have a price stop, but a time stop. If you're in something for two weeks and you're up 1.2% on it, is that good or bad? Well, you don't know unless you know what the S&P 500 did. If the S&P is up 5% during that period, you're making money, but you're losing an opportunity cost because there's other stocks that are moving better. So that sums up our approach to why we want to just be in the best stocks. The money that isn't in the best stocks, in a good market, we want to have it in the S&P 500, either in 1 time, 2 times, or 3 times leveraged. And that's the way we run things in the Grotection portfolio at Revere.
Excellent. Don, thank you so much for this presentation. I've definitely got some questions to expand on things further. First, I want to say, it's interesting. I think this is such a great exercise to do. And I know the person who I first learned trading from, Dr. Eric Wish, he does a similar thing for each of the trends where he looks at how many of the stocks in the NASDAQ 100 beat the TQQs during that period. And he defines like an uptrend or downtrend slightly different than you, but it's looking at the same period basically. And basically the TQQs outperforms about 80% on average
absolutely.
Yep. So I've started using TQQs more as a tool to gain exposure quickly when everything's correlated at the very beginning, and then similar to what you guys then looking for as the growth names set up that are showing relative trends, showing the characteristics we look for. You can either sell some of that to finance it or just keep that as a core position, similar to what you guys. One question I did have is how do you put on the exposure of the SSO and I guess just the SPY? Is it on an end of day basis when it starts ticking, meeting the requirements? You guys put it on end of day, or is it more discretionary during the day as things progress?
It's discretionary. Normally, if we decide that, okay, we close the prior day above the 21, above the 50, we're still below the 8. It calls for an increase in exposure. We'll buy it in kind of dollar cost average throughout the day. We'll break it into 5 or 6 buys at different times once we make the decision to go ahead and pull the trigger on that. So it's not an end of day thing. We also allow for false breakdowns or something. It doesn't mean if you close 1 point below the 100-day moving average that you need to make a change in your portfolio. We're somewhat flexible with this. And you want to give things a chance to work unless the market is telling you otherwise.
Exactly. And forgive me if you showed this already. How many growth names, so individual stocks, are you guys typically in when fully invested? I believe you may have showed it in the table, but I don't quite know if I saw. Yeah, go ahead, please.
Yeah, it's usually around here, no more than 12. I hate owning more than 12 names. Ideally, I'm in between 6 to 8. But if I'm 10 on the high side, I'm comfortable with 10. But it's somewhere around this level here. Let's just say 8 to 10 ideally. 12 on a stretch to the upside. But if we're in 12, we're really looking at cutting too and trying to get that money into some that are working better. If I'm in 6, I'm looking to add some to get into that 8 to 10 range.
Excellent. So even with a fund as large as you guys, that's staying pretty concentrated and trying to focus on the best of the best names during that cycle.
Right. We don't want to get in some and the best and most liquid names as well. The worst feeling for a portfolio manager is trying to get out of a stock that's illiquid. So we just do the best that we can to just completely take that off the table. We're using a minimum of 250 million in average daily dollar volume right now for Grotection. For Turbotection, a minimum of 60 million. So they're able to catch the smaller names. I'll focus on the big liquids.
Excellent. Yeah, that was going to be my follow-up question. If you guys had a threshold that you look for, a question I think a lot of folks might have, and I know we've talked about it before, but what's your general process for identifying those 6 to, depending on the market, 10, 12 names to really focus on? Hood, I think, is a great example, showing relative strength during the correction, holding the 200-day moving average. Is it the classic CAN-SLIM criteria, or you've tweaked it a little bit for your process?
We've tweaked it. Like, for example, we'll buy something that doesn't have earnings if it has massively growing sales. But we maintain in our videos every night a 21 over 21 list. This is 21 leading stocks above the 21-day moving average, and we make sure that there's at least 10 different diverse sectors in there. As O'Neill said, you get your diversification from sectors. You don't have to own emerging markets and international names. So 90% of our buys in Grotection come off of that 21 over 21 leaders list. Every once in a while, you'll get something that's not in there that gets an earnings gap up that we want to take a position in. But the 21-21 is updated and published every night on a Monday. And we also have a new list, the Turbo 12. Those are 12 that Ted and Connor pick that are on their watch list that they could, the pond that they can fish in. So every Monday we present 33 stocks, 12 of them between 60 with a minimum of 60 million in daily dollar volume, and 21 with at least 200 in daily dollar volume. I mainly stick with 250 and above, but that's then we go into the week with those 33 names. We update the performance of them every night in our videos, and it's also a good way to keep your finger on the pulse of what's actually happening in leading stocks.
Yep.
2 Tuesdays ago, when the leaders got smacked, all 33 of our names were red on the day. So that told you what was going on in Leaderville. It ended up being a one-day event, right? You look for follow-up selling. There was some, but now we're at all-time highs. We closed today 717.25 at all-time highs in the NASDAQ 100 and the S&P 500. So the names are working. Some fall by the wayside and get cut, but there's been an infinite, not an infinite number, but
a healthy amount.
A healthy amount, yeah. Like I think I said in Monday's video, we cut 7 from last week, but there were easily 30 that I was trying to pick between to fill out that 21 for the video.
And for those ones that you pick, are they still earlier in their trend starting things, or can they? Because some, there's leaders, but just are trending extended. Like Hood right now, might not be buyable. It's trending. If you have it, there's no real reason to sell all of your position, but it's not necessarily buyable from a risk reward perspective at this point, for sure.
Yeah, something that has run like this, it's kind of late, it's stale, I guess you could say. We try not to put those in there unless there's been some kind of catalyst that really makes it an attractive stock.
Excellent. And yeah, I was gonna follow up and ask, does that 21 over 21 factor into the gauge that you include with the trend about what the direction of the leaders is? That's
what we go by, basically. Our portfolio, the ones we own of that 21 over 21 or the Turbo 12, and how the rest of them are acting, as well as ones that are on the outside looking in, so kind of like a focus list and a leaders list. Additionally, we created something called an RG8 index, which is 8 growth ETFs. We also report on this every night in our videos. We want to see those 8 ETFs acting great too, because they're made up of the stocks that are in the pond that we fish in. So it's 8 growth ETFs, and FFTY is one of them. The IBD 50, ARK is another one. Mm-hmm. The growth half of the Russell 2000, S&P 500, mid cap, S&P 400 mid cap. So a bunch of growth ETFs that we're trying to keep our finger on the pulse in growth land, because as we know, the market could be going up based on rotation into value names, not necessarily in growth names. But that's another reason to have the S&P 500 as a core, because you get the gains in those type stocks, and you don't get those nasty down days that can be soul killing. Yep, and the ones that you need to know your open heat to be aware of that, so you're ready. Right. For again, focusing a little bit on how you find these names, do you have go-to screens that you like to use, and what would be a setup or a chart pattern that you would say, okay, this will be one that to focus on next week? We're always looking at the relative strength line. We that is that, and it being above the moving averages or approaching or clustered by the moving averages. That's something that is prime for inclusion in the list and or being bought. But no, I like to say no chart is complete without a relative strength line on it. Like for example, let's take a look at Hood, since we're talking about it. Actually, here I want to talk about a different one. Let's talk about Netflix. This was a quote unquote successful trade that didn't fall into the successful category for me, because while it was doing, we bought it right, we wrote it up into the profit target area, but look at the relative strength line while this was happening. It was flatlined. So we would have gotten the same gains by being in the S&P 500. So if you look at this chart, it says, oh man, that's a great stock, I wish I was in that one. Well, not really, because all you did is get a little bit better than the index returns while you were holding, and you had the single stock risk while you were doing it. So no chart is complete without a relative strength line on there. We look at that all the time as a way to eliminate stocks, as well as the ones that we're wanting to include. So you can see the relative strength line on Netflix. Compare that to the relative strength line on Hood, where while it's going up, the relative strength line is increasing as well. This is really what you want to see. That's the perfect example of what you want to get into. GEV is another one. This rode the 8 for a good period of time, went sideways a little bit, had a shakeout last week. We trimmed some, and but we're still in it and riding that last part of it as it goes to the 8E, as it rides the 80MA higher. And this is another one where the relative strength line is also confirming what's going on in the stock.
And for Netflix, what was the volatility factor, if you remember offhand, when you guys picked that up? Because it seems like it just didn't have enough ATR compared to SPY when they're both in uptrends, but Netflix didn't quite manage to outperform.
Yeah, I can look it up for you if you give me a second.
Yep, no rush. And while he's doing that, let us know your favorite takeaways so far. I think the volatility factor and calculating that for your portfolio so you know what to expect in addition to the portfolio heat, definitely a key concept to internalize if you haven't already. But let us know in the chat what's been your favorite key takeaway so far.
Yeah, and I'll be on when you're presenting this on Saturday to answer any questions that people might have. Okay, so Netflix, when it was in the portfolio, had a 1.35, very much on the low side, adjusted beta. So compare that to Hood right now has a 3.79. So, you could literally take a 3-time size position in Netflix as in Hood and get the same risk.
Or maybe Netflix probably has one of those 2x ETFs like a Tesla. Tesla's got so many stuff like that. Is that something you guys are they liquid enough for you guys to get involved in?
We really don't use those. We want to stick with the big liquid, the name itself.
Yeah. It'd be interesting to see what the relation, if there's a relationship, a correlation between the volatility factor when you guys purchase it and which bucket it falls into of a successful trade that meets your target goals of 2, 3x, something like that. Because it feels like personally for my trading, I am shooting more for the higher ATR names, the ones that are still liquid and act well, but the ones that can make a nice move if you catch them right from a trend.
Yeah, often what we see is, they're moving quick out of a base or an earnings gap up, and that's going to pop their ATR. But as they make progress, you tend to see the score come down a little bit because the daily ranges just aren't as great. Circle is the exception that proves that rule. That stock is just crazy. I think it has like a 16 ATR, 16% ATR right now, which is just crazy.
Yep. And for maybe either GV or Hood, outside of buying earnings gaps, episodic pivots, that type of setup, what's your typical process for buying a breakout? Because at your guys' size, do you guys have to work your way in throughout the day, or are you guys able to make single buys and then add maybe the next day as it falls through even more?
The very liquid ones, we usually do 2 or 3 buys stretched over a course of like 1 to 3 hours maybe if we're looking to get into it. If it's something that's extremely liquid, we could do it in 2 buys or maybe even 1, but we never want liquidity to be an issue. I have enough things to worry about with the market. I don't want liquidity to be one of them.
Yep. And then on a purchase like that, where are you guys typically placing your stop? You mentioned, of course, how the low of the day is typically, if there's going to be a shakeout and recovery, it's often through the low of the day. How do you guys typically manage risk when you're entering a name?
The initial buy, we want the R to be 0.20 of overall portfolio heat. So we back into it that way. And I want to make sure that I can buy a decent enough size that 1 to 2% below the 8-day. So I very often, if it's still in a base like this, I will size it, my initial buy, against the 8-day moving average minus 2%. And if I get stopped out the next 2 days, I don't want to lose more than 0.20 of the overall portfolio. So we kind of back into it using a combination of R and the volatility.
Perfect. And I want to take a little bit of a step back here and just, I'd love to hear your thoughts really on what's the benefit of having a trend model like you guys have to make sure you're eliminating those drawdowns that you went over. There's a lot of statistics out there that are put out by industry research where, the best days happen below the moving averages. So you don't want to sell because you're going to miss those best days, and then that hurts your performance. But as I'm sure you've observed, the best days and the worst days they both happen during a correction. So
exactly.
Yeah.
Exactly. That's propaganda. That's industry propaganda. And that 12% up day in the S&P 500, they'll mention that without mentioning the two prior gap downs and the fact that you're 27% off of the highs. It's
Right.
It's disingenuous to mention one without the other.
Yeah. And, my personal cycle is more in tune with the 21 EMA. And if you're just using the 21 EMA, you exited, obviously you're never going to sell the top, but you protect the majority of your portfolio, and you do miss that huge day in the markets, but you get in, a week later as the market's proved itself a little bit more. There's more setups, all of that. So I think a key takeaway for me and just something that's support for everybody out there, have a system similar to what Don presented today. It could be as simple as the 21 EMA, the 50 SMA. That's a little bit lagging for me, for my style, but find something that works for you that keeps you in the heart of the uptrends, but gets you out and protects you during the drawdowns that you mentioned.
Yeah, the 50 is a little too slow for me as well. Sometimes you'll get an opportunity to add to a position, like, for example, Palantir lagged a little bit 2 weeks ago, but all it did was it did its pivot plus 20%, and it pulled back to the 10-week moving average before resuming the uptrend. And that's kind of textbook. We got stopped out of part of the position, but still held. We're holding that runner right now, and we're looking for. Let me talk about that 60-minute stochastic now.
Yeah, please.
That I talked about. So this is an example where it's 80 and above is overbought, 20 and below is oversold. We use this all the time to get into a position if I don't want to pyramid into something if it's overbought, okay? Because you're setting yourself up for a pullback if it's stale above the 80 level or the overbought level. So this is an example of where you could get some additional shares. Now, here's an example of one where it just didn't work. The cross up, ideally you want it to trend like this and then stay there for a while. But if it's not working, if it doesn't happen, your stop is so much quicker because it should have happened. And if it didn't happen, it means it's either something wrong with that stock. In this case, the spikes were on some congressional Republicans or Democrats questioning Palantir's access to data for the government, and they got some bad press. It took a little bit of shakeouts. This was actually, I think, where it bounced off the 10-week, but good low-risk entry for getting in, and your stop is tight if you're looking to establish a position.
And yeah, can you just point out for folks, just to be clear, where that was on the daily as well? So this is the 60-minute here.
Yeah, so this was on the 27th of June. So there's that big spike down, and that was on a report that, so it broke the 21. We did get stopped out of some on this day, and in fact, we haven't added it back as well. But all it did, and this is why it's so key to have a weekly chart and a daily chart. It never touched the 50-day moving average, but the 10-week is typically higher. Not typically. It's a rare instance when it's not, and that's because in a bull market, you're only looking at 10 closes. Typically, you close toward the top end of the week, and that's why the 10-week is always so much closer to price than the 50-day is. Never touched the 50-day, but it sure as heck did come into the 10-week. And if you look at that and you're using weekly charts like O'Neill did, you'd say there's absolutely nothing wrong with that stock. It's a normal pullback to the 10-week. In fact, it's an opportunity to get back in.
And if you go back to that weekly, what a perfect model stock in the making, and still present right now, starting from that a monster earnings gap in June of 23 with a nice earnings beat and surprise all the way there. So
Yep, all the way back there. Yep. Let's quickly show that I mentioned that corrections typically in uptrends are typically held by the 20-week or the 30-week. You can see during this uptrend here, the green line is the 20-week, the light purple line is the 30-week. So pulling back to that is normal. You will usually find yourself getting stopped out of some things unless you give them a very wide berth, but the market should right itself around the 20 to 30 week moving average and continue the uptrend. And if it doesn't, then you're looking at the 200 day, and then we know what happens. Nothing good happens below the 200 day, as Paul Tudor Jones likes to say.
what are you guys looking at in the moment during the start of a correction? Is there anything that can indicate whether it's just going to be a more short-term pullback that recovers versus something more significant that slices below the 200 and can cause a lot more devastation? And, this one was a quick snapback, but in 2022, it took a lot longer to get back to the previous highs. So what are you guys looking at in real time during the correction to make sure you guys are protected and preserving as much capital as possible?
Yeah, it's the action of growth versus the value names. If both growth and value are selling off, that's money leaving the market. If it's just growth and the S&P is flat or just down a little bit, and you look at the value half of the index and it's up on the day, that's just telling you that it's healthy rotation. Rotation is the lifeblood of bull markets, is a Wall Street saying, and there's nothing to be concerned about at that point. If you get heavy selling in leaders for 2 to 3 consecutive days, and that's showing up in the indexes as well, that's certainly a red flag.
Yeah, I think both you and I were both watching that day recently where all the growth names were down and it was rotating, but that didn't last. They snapped back quickly, and
Yep.
that was on the positive side what you're looking for to say this trend still has legs, and we are longer in this trend, but we're still above the moving averages, and so many names like Hood, Roblox, like you said, just trending above the 80 EMAs, even not even really testing the 21 EMAs. There's a lot of strong stocks, strong trends for now, and we'll see if there's a character change coming up, but no sign yet.
A good example
Mm-hmm.
to compare and contrast what we've just seen the last week and a half with what we saw back in February, the 19th, the 20th, and the 21st. Leaders were hit on the 19th. They were also hit on the 20th. But look at the indexes. That's just holding up. Then the third day, the 21st, they got hit as well. And then the next day, the indexes broke the 50-day moving average, and that was the beginning of the correction. So monitoring the leaders up there, we knew one day is nothing to be concerned about. But if you see it for 2 or 3 consecutive days, you're going to start seeing a correction, and that's exactly what laid out here in late February of this year.
Yeah, and if you could bring up Palantir, that was one of the last growth names acting well there, and you can see it break. It had that nice earnings gap, push higher, and then that day, which I think was a little bit earlier than the market broke, that's just a change in character bar, biggest one-day change in quite some time, and complete expectation breaker from the prior day where you're expecting it to trend and continue going, and instead it reversed hard and on big volume.
Yep. Big volume, big cluster there of distribution days in that name. Was a leader, breaks the 8, breaks the 21, and just going back here from that gap up in November of 2024, you can see how it rode the 8, a couple of undercuts of the 8, but still held the 21. But then when it broke the 8 and then broke the 21, the meat of the move was done. You're correcting down to the 50-day in this case before starting again in that next gap up on earnings.
Excellent. Don, were there any other names you wanted to cover that are either good examples of finding, entering, or managing some of the names you guys have been focused on recently?
AVAV is one of the most recent ones that we've gotten into, and that had a big earnings gap. 4 days in a row to the upside. They did a secondary offering, which took the wind out of the sails, but all it did was pull back to the 21-day moving average. And then 4 days ago, reclaiming the 8-day, we got into it in this period right here. And watching it go higher now. You can also see the volume on that move up. That's a lower volume. Volume started to taper off, still above average. That was the hangover left over from that secondary offering, but it completely changed on the 11th, and it's followed through over the last couple of days as well. NVIDIA has been our largest position, and this is another one that's just riding the 8-day exponential moving average higher. From all the way back here in the beginning of May. It was under the 200-day at the time. A lot of people were calling that this was this was rolling over, it's going lower, and it was until it wasn't.
Yep.
Money came back into it.
And now it's been basing for it kind of based for a year almost, and now pushing into new highs. So we'll see if it's gotten more legs. Going back to AVAV, did you guys use the stochastic at all to for the entries there? Because you had a gap up through the 80 EMA and 21 EMA potentially. So
no, this was an example of buying the strength and the gap, but also knowing how oversold it was on that 60 stochastic for those 4 or 5 days. We were on the lookout for it. It was in the 21/21 list, and then after that tight action there, it just gapped up, pulled back those days, and then reasserted itself.
Yeah, so basically
started with the earnings gap.
So basically, that low stochastic is like a spring being coiled, where you're stalking it at that point.
Exactly, and if you see it for 4 or 5 days like this, it's absolutely a spring being coiled up. And then conversely, on the other side, if it's above it, these usually doesn't. 3 to 4 days is usually about the maximum that it'll either stay below or above the 60.
Excellent. And so on that gap up, just to clarify for folks, what are you looking for an ideal gap up in terms of volume, in terms of the catalyst? What are the characteristics that you look at to say, okay, this is an earnings gap that I either want to potentially enter, or I want to be watching for an entry later on?
The key is how it acts against the close of that day and the low of that day. They very seldom ones that end up being big winners undercut the low of the gap up day. People get afraid to buying gaps, but we know with Reg FD, Wall Street is offsides all the time, and it's to our benefit when we see gaps and heavy volume coming into that. This is a situation where we really wouldn't take the biggest position on a full position on the same day. We would start it. We didn't start this one. We didn't get back into it until here, but it was definitely on our radar as something that could set up, especially after the secondary. Once you get back above the secondary price, and we saw that today with MP, which is just amazing. We're not in this, but rarely do you see a stock price an offering and on the same day take out the $55, in this case, offering price. We are really absolutely looking for a way to get into this, because you had the dual gap up. The first one was with the government, then they signed with Apple and they're the rare earth metal processor. So we'll use the 60-day as a possibility to get a starter position in this if it pulls back. The 60 versus the 8, we'll size it versus the 8 on the first buy, and we'll have a tight stop if it doesn't work. And then if it just continues to ride the 80 MA higher, you can see that for sometimes 8, 10, 12 weeks, and that's the meat of the move, and that's what we're looking to take advantage of.
How does this look on the weekly? I haven't looked at it recently. Yeah, so just moving out the right hand side of a pretty big base after years of decline. So potential change in character here.
And a spot here where it may pause going back to 2022.
Yep. Excellent. Were there any other names you wanted to cover, or is that pretty much it?
No, I think that's it. We're playing the TurboTaxon is playing the Bitcoin, Ethereum, and the stocks around that pretty well, but we've got positions in Hood and Coin and IBIT in Growtection too. That's certainly a spot where money is flowing into. You can see Coin also riding that 8 EMA higher.
Yep, and that was such a great breakout from the tight inside day back June. Yep, exactly, right there at that spot. Yep. Excellent.
Yep.
Perfect. Well, Don, this has been great. Any last key takeaways that you want people to have from today's session? What would be some important messages that you want to pass on to everybody watching today relate to what you presented?
If you're starting out and you're struggling, split your portfolio in half with the S&P and the names you want to buy. Buy half in each instead of the full amount in the growth name. Monitor the two trades. See which half of the portfolio is growing better. You'll get better. You'll find insights into any trading errors that you're making. Are you buying extended? Are you buying too large? Then you'll also see how the overall trend is of the indexes is impacting the individual names. But that's the biggest piece of advice I would give to a beginning trader is you got to get profitable beating the S&P 500 before you can really start swinging for the fences.
Perfect. Don, thank you again for your time. Where would you point people to if they want to get in touch or learn more about your guys' process?
RevereAsset.com and a Revere Asset on YouTube. Like I said, we post videos every night giving, we think we're the most transparent advisor in the country. Every portfolio trade that we make, we discuss that night. We give our stats. We give our daily returns. We share our leaders lists. We talk about secondary indicators. We have keys for each day going into it, what we're looking for. Something, in other words, what would need to change? What key would we look for that would cause a change in our current outlook for the market? And all the videos are there on revereasset.com and out on YouTube.
Excellent. Don, thank you again so much for your time. To everybody watching, I hope you guys enjoyed. Leave a like down below. Thank Don in the chat if you enjoyed. And make sure you subscribe to the channel if you haven't already. And we'll be right back with the next presenter. Stay tuned. All right, welcome back, everybody. It's my honor to introduce someone who you probably already know, Nick Schmidt, who is known for being a longer-term position trader using a lot of weekly charts. He's also, of course, a co-founder of Deepvue and TraderLion. Today, he'll be discussing kind of his perspective in terms of chart analysis and really diving deeper into alternative entry techniques and building confidence with pullbacks and bases. Nick, this is one that I've really been looking forward to. I'm always trying to hold my winners longer, and I think, that will be a key goal of this presentation that I think will help out a lot of people out there. So Nick, thank you so much for being here and looking forward to this.
Absolutely. Thanks, Richard. Yeah, I was really looking forward to putting this presentation together because I always hear a lot of people are interested in buying, whether it's like weakness, a pullback, or an earlier entry prior to a breakout, but there's no, they lack the confidence behind it. And, there's ways I've now become more confident with buying either weakness or prior to a breakout than I actually do buying a breakout. And so the goal of this presentation is I want to kind of share why and how I made that shift so that you can expand your arsenal of entry techniques beyond just the breakout and see pullbacks and bases as an entry opportunity.
Awesome.
So the agenda today is we'll cover why I look for early entries, the benefit of buying weakness or when it's quiet, how to do it with confidence, and then the characteristics that stocks share before they break out. So this one I will spend the most time on, but I think a lot of people study breakouts and the characteristics behind successful breakouts, but there's not a lot of focus on breakouts aren't random, which we will cover later in this presentation, but there's not a lot of focus on the characteristics that happen before a breakout even occurs. So that's really what I kind of want to touch on in this presentation. So before we get started, I want to just touch on why I love the TraderLion conference. So it embraces diversity. You're exposed to a variety of approaches, and everybody, is successful in their own way. And that is super important because there's a lot of ways to make money in the market. There's also a lot of ways to lose money in the market, but there's a lot of ways to make money. And at the end of the day, however you decide to approach the markets, it has to, be compatible with who you are. So I am not a day trader because that's a little stressful for me. I would rather, I find it easier to wait and do nothing, where there's a lot of people who find it hard to wait and do nothing. And so you have to have compatibility with your approach. It has to align with your personality and your beliefs. And also, I believe in avoiding just replicating something black and white. So instead of copying someone's strategy specifically, you adapt elements that resonate with you. And that's how I've came to my specific, the way that I approach the markets now too. I'll be watching all these great traders and something really stands out that I kind of take and make my own, or I'll adapt to my strategy. And so I'm not following just one person's blueprint to a T. I'm kind of, some things resonate with me, some things don't. And at the end of the day, it becomes my own strategy. So I love the TraderLion conference because it showcases just so many different ways that people approach the market. So to start this presentation, breakouts have a lot of eyes. So the more traders that are watching a level, the more likely that it will pull everybody in, stop them out, and then move higher without them. Some people, I hear a lot of frustration with breakouts that people get stopped out. They're failing, like this market's not good for breakouts anymore. And that's not true. Breakouts are definitely still valid, 100%. They always will be. It's just, how the market works. But there is a bit of that frustration I've felt myself, where a lot of times I will enter on a breakout and then I have less cushion, which we'll get into in a second in this presentation, but I have to kind of react a little bit faster, and a lot of times when a stock does break out, unless it's really, really strong, it doesn't follow through right away, and you'll see it retest a lot of times, which is perfectly healthy, but it can mess with you mentally a little bit. And so there's a lot of people that I've noticed they're frustrated because maybe the breakouts have become a little harder, it feels like, and they want to buy weakness, or they want to learn alternative entries, but they just don't have the confidence, which I think is totally normal, because everybody says when a stock pulls back to this level, I want to buy it, but then when it actually does and everything's red and the market's down, you don't have that confidence to actually buy it, the confidence that you need. And so I want to just show you how I gain that confidence, and I think it'll resonate, and you'll be able to expand your entry tactics. So why alternative entries? For me, the three biggest things are superior risk reward, buying on weakness, or just prior to a breakout has helped me keep risk tighter. Especially if you're unfamiliar with me or how I trade, Richard did introduce me as a position trader, a longer term trader. That's all very true. The biggest thing I would say that stands out about me is I only use weekly charts. So sometimes I'll buy something on a weekly chart and it will not be a position trade. Not because I was trying to swing trade it, but because maybe it just didn't pan out, it didn't follow through. But the one thing unique about me is I just focus on weekly charts. For me, it just keeps a lot of clarity. And so when you're looking at weekly charts, I get asked a lot about how do you keep your risk tight, and buying when it's either quiet and off people's radar, or when there's weakness is how I do that. 2, avoiding shakeouts. Getting in at less busy areas reduces the chances of getting stopped out. And then 3, easier to hold winners. So when you have an average cost below an official breakout level, it just makes it easier to sit tight, because like I said, when you do have a breakout, if it does pull back and it retests, you're sitting there with a little bit of a cushion, and you have some clarity, and you can, when you're thinking clear, you make better decisions, and it makes a world of a difference. So this is why I want to cover alternative entry techniques. Now, gaining confidence. How do you gain confidence buying weakness, or basically not buying a breakout? So a lot of times I see people have confidence buying breakouts because if you buy a stock that's breaking out right now and it's strong and it follows through, you kind of see immediate traction. So when you buy, if a stock's breaking out on high volume and it follows through, like you get that feeling where it works right away, where I think people don't assume that is replicable in any other training style with entry style, which I found to be false. So the biggest thing when it comes to buying weakness, or if it's quiet, is weekly charts. I think are super helpful. Now, I use them all the time for everything. You don't have to do that, but I highly recommend that you at least check them to find certain levels. So what makes weekly charts super powerful is the support levels are super clear that you might miss on a daily chart, and the structure of the stock is super clear. So whether we're making higher lows, or you're looking to the left of the chart and you're seeing the personality, or even retest of major levels, which on a daily chart maybe you might not you might not see right away that a level is significant, but when you're on a weekly chart and you look left, you see that, okay, we're at a major level. And so weekly charts are not for everybody to focus on as the dominant time frame, but I definitely think that to get used to alternative entry techniques besides breakouts, you should at least check them and notice certain levels or structural characteristics on these charts. So one thing that I kind of do when I'm thinking of buying weakness or pullback, so for me, I prefer to buy weakness or when it's quiet before a breakout. I still buy breakouts. If a stock is breaking out, and I'm not in it and it's one that I wanted, I consider myself late for my strategy, but I will always still buy it just because, I'm not, like, that it's a textbook breakout. I'm not going to miss that. But what I find a lot of people struggle with pullbacks is every time there's a pullback and you're kind of zoomed in on a time frame, it feels like the end of the world. Like every time that if the market has 3 days red back to back and it's selling off, it kind of feels like the end of the world. And that's why people always say like, oh, if it comes to this level, I want to buy it, but then it does, and you don't buy it because you're just too nervous. And so I like to think of the rubber band effect, which isn't real, but this is how I view things. But what definitely is real is 75% of stocks follow the general market. So 3 out of 4 stocks are going to follow the trend of the general market, and pullbacks are healthy, even though they might be scary when it's happening. Pullbacks are definitely healthy, and they keep the uptrend sustainable. So when a stock pulls back, the way that I view it is it's likely going to snap back with the trend. Now, this is where the weekly charts come in. You don't want to just buy a random pullback. You want to identify key levels and stuff like that so that you can manage your risk and you're not just trying to buy something that's falling. But turning points in the market are less frequent. They're more rare, and trends are the way that we spend most of the time in the market, especially an uptrend. So if we've identified that the market is in an uptrend and the stock you're looking at is in an uptrend, and you get a healthy pullback, which most pullbacks are, if it comes back to a level that you've identified you can manage risk and make sense, then it's highly likely, it's almost, I view it as, like I say, as a rubber band, that it's going to snap back with the trend. So I think something that a lot of people like with breakouts is you kind of get that immediate feedback, and a lot of people say that they like their stocks to work right away, and if it doesn't work right away, it's not a winner. But the immediate feedback, I think, is important, and I think I definitely see that I get that immediate feedback when I'm buying a pullback, just the same way as I buy a breakout, because it might not be as exaggerated where you buy something and a ton of people are buying after you and it's going higher. But when you buy weakness at a logical level, when the market is done pulling back within a day or two, you're going to see things return back to the uptrend. The momentum is going to turn back to the upside, and you're going to get this immediate cushion that a lot of people overlook because it's not a breakout, but you do definitely get a cushion right away, and it might not be something that stands out. However, that feedback is definitely real, and the immediate progress still happens when you're buying weakness. So breakouts are not random. I think that there's a lot of focus on buying breakouts and textbook breakouts and the characteristics of a breakout, and they're not random. So a lot of people study, you want your breakout to be on at least 1.5 times relative volume. You want this, and this, and there's a lot of focus on the breakout, but there's not a lot of focus on what leads up to the breakout. And breakouts don't just happen. They they're very it's how stocks behave. So during every strong trend, stocks cannot keep just going up sustainably unless they rest and they consolidate and build up that pressure to continue going. And so during strong trends, a stock's going to consolidate and build a base multiple times. And most people, as I mentioned, they're focusing on the characteristics of, okay, after the stock's done basing and it breaks out, what are the characteristics of that breakout so I can know to buy it. But there's characteristics before it that also tip you in the right direction that this stock is likely to break out. So the two different things really that we'll focus on this presentation is volume during these consolidations. They help us determine if it's more likely being accumulated or distributed. And the characteristics of these consolidations can also help us determine if a breakout is likely near. So this, when we're looking at a base, there are certain characteristics that give us, that tell us that there's a high probability that we're coming up the right side of the base and a breakout is likely near. And so there's definitely characteristics, whether it's a base or a pullback, that I study and see play out over and over again, that I think a lot of people can benefit from studying the same way that they would a breakout. So when we're looking at what we're going to approach the first part, the volume during the consolidations first. When you're consolidating, you're either, and so we're talking about building a base, right? Moving sideways, price gets tight, we're not trending. When that happens and you have big volume, this is most likely not good, or at least it provides no edge. So volume is essentially the force behind price. So if you have a base where price is moving sideways and you have heavy volume, it's most likely distribution. And if it's not, it's just not an edge for you to focus on. So if you're a breakout trader, which most people are, you know that you want heavy volume when the stock does break out. And it's because when the stock is breaking out and moving higher, that heavy volume shows a lot of buying pressure for that breakout. So if you have heavy volume, but the stock is not breaking out and it's moving sideways, that's a red flag. And this is something that I've learned from William O'Neill. It's not something I've developed on my own. This is something that one of the main things that stuck out for me from William O'Neill. So if you had big volume and it was overwhelming buying pressure, the stock would move higher. But since it's not moving higher, it means that all of the volume that is being bought, you're also being met with a lot of selling. And so if you had big volume and the demand was clearly everybody's buying this, like I said, it's going to go higher. And so when you kind of are paused and you're not moving higher, it's essentially what William O'Neill calls churning, and you have a lot of shares trading hands, but no price progress. And it's usually because funds are quietly selling into the demand. And so big institutions, whether they're buying or selling, they're the ones that move stocks, not us. And they want to do it usually as under the radar as possible. And so one of the best ways to do that is if a stock has moved up quite a bit and now it's basing, one of the best ways to do that is if there's a lot of demand by the stock, it's near highs, it's now basing, people think it's setting up for another move higher, they're going to kind of use that to their advantage. And anyone who's buying, anticipating that, they're going to just slowly kind of, sell into it. And so that's why you have no price progress higher. And you also don't have price, coming lower. So it doesn't clearly look like they're selling, but, there's definitely distribution going on. Now, what we like to see is if you consolidate with light volume. So light volume, when you're moving sideways, it indicates there's a lack of sellers and stealthy accumulation, likely. It doesn't always mean that there's accumulation, and just like this, it doesn't always mean there's distribution, but when there's heavy volume and no price progress, it's definitely a warning sign, a red flag. And when there's a lack of volume, it's definitely a green flag and a reason to pay attention. So the first part is that we'll dive deeper in is using volume to determine accumulation or distribution during these periods. So the first example that I have here is QUBT, which is a quantum stock. It's a more speculative quantum name, but this is something that if you look at the chart now, you'll see how it has played out. This was a markup I made at the time that I was buying it, but you'll see how it's played out since. And this is one of the best examples of the volume situation that we're talking about. So you could see right here, basically the first thing that happens is volume. If you look to the left, when price was kind of moving sideways over here in QUBT, there was no eyes on it. There was no move. It's just kind of doing nothing. And you could see volume is non-existent. And then all of a sudden, it starts to move higher, like a lot higher. And there's humongous volume coming in. And so this is not me or, you. Like, this is not a retail trader. This is somebody with big money accumulating. And if they're buying and driving the stock up this much, you can imagine if they're selling, they're going to move the stock down that much just the same. So when you have like funds accumulating, they're not day traders. That's something I like to point out and make clear. Like trading gets a lot harder when you're managing more money. So if you're buying a stock and you're moving it from, this was at $1 and they moved it to around $7 here, then obviously, if they're to sell this the next day to try to profit, it's not going to happen because they're going to sell it and it's going to go from $7 to back to $1. So when you have a lot of money and you're moving stocks such a large amount, you cannot get in and out quick, and it gets a lot harder. So when you do see accumulation kind of like this, it doesn't guarantee that a stock is going to hold and go up, because just because you have a lot of money doesn't mean you're right at the end of the day. But what this does tell us is that someone with a lot of money is definitely accumulating very quickly, and if they were to get out, it would collapse the stock. So they're, at least right here when they're buying, they're doing it with the thought of, they're thinking a bit longer term, right? So once they start doing that, it becomes on everybody's radar. They start buying, it starts pushing the stock up, and now it's on everyone's screens, it's on everyone's radar, and it causes a chain reaction. And so once that happens, if you're buying something and now, like, you started buying at $1 or whatever, and then $5, and now the stock's at $7 or $8, and because it's on everybody's radar, and then it even goes up to, it hits a high of like $25. You don't want to just you're thinking longer term, and so you don't want to keep buying when it's everybody else is now chasing it and buying, because all you're doing is just you're just raising your average cost. And so you kind of do your little bit of buying, and then you want to leave it alone so price can kind of stabilize. So what's happening is a lot of people are kind of now chasing it. It's becoming on everybody's radar. Momentum traders are looking to cash in, And then once there's no more accumulating and they kind of just let it go, you kind of get this pullback that we see here. And this is essentially just people who are chasing for momentum, shorter term traders. They're exiting because there's no more momentum, right? Like a lot of momentum traders that helped push it a little bit higher are getting their profits. They're taking profits, and the big funds are just not driving price higher anymore. And so if you're a momentum trader, there's no reason to be paying attention anymore, and it's kind of now becomes a rush to get out. And so the biggest thing that I want to point out here is the difference in volume. So if you're unfamiliar, I basically have the volume blue if it's above average volume and positive, and then I kind of make everything else gray, and this just helps me like see accumulation a little bit easier. But you can see that we have no volume over here, huge volume on this move up, and then as we're selling off here, look, again, the volume is just dried up. It's completely dried up. So essentially on the way up, the volume's massive, and then on the way down, the volume is completely dried up. And so this indicates that there's no big sellers. People who were trading momentum are getting out, and it just keeps going as anybody who's still inside and was chasing the momentum is getting out, and so price is just kind of declining. But the lack of volume indicates that nobody big is trying to get out. It's kind of just people who, like I said, were chasing the momentum. So eventually, when you have dried up volume and prices declining, this is what you want to see, but eventually there's not going to be sellers left. And the whole thing that we were discussing previously was that you don't want to keep buying when it's on everyone's radar, and if you're a fund, keep accumulating at $25 when you know that if you're very patient, price is going to come back and you can get you can add at a lower cost. And so volume dries up and pulls back, and eventually they're going to step in again. So you kind of get that right here. You have another big push that comes in around this price here, and it's essentially just, let's try to accumulate quietly. Price is probably not going to come down much more, but let's try to not cause a chain reaction. And that's kind of what happens here. Price then moves sideways a little bit, makes a higher low, and you can see again there's no volume, which indicates that it's still off a lot of people's radar. So if they were to, if a big fund right here on this one accumulation week was to just keep accumulating, we'd see something very similar to what we saw over here, where price just keeps going and causes a chain reaction again. But the goal is for that not to happen. So again, price kind of is off everybody's radar, makes a higher low though, volume is very, very light, and it's still off everyone's radar. Volume comes back in, and then we kind of have these 2 weeks tight over here, and volume dried up. And so this was my actually biggest position, not biggest position, but quickest position of the year. And it's definitely a more speculative name, but this volume pattern was seen across all quantum names, and which is good. That's kind of off topic for this presentation, but if you see one stock that looks great, but then there's no other stocks in the group that looks great, that's not great, or that's not good for the probability of that stock moving. But when you have a bunch of stocks that look similar and showing signs of accumulation with that in the same group, and you have the group strength behind it, it adds a lot of it increases your odds of the stock actually going. So this is essentially just one of the best examples that I've found, especially this year, of how clear the volume being high on up weeks, or whether you're looking at a daily chart or weekly chart, it's all the same. When price is going up, you want big volume, and when price is going down or moving sideways, you want light volume. And so the dry up when you're moving sideways is essentially the biggest thing. Now, I bought QUBT over here, even though it would have been much better to buy within this little area right here because volume dried up a ton and we're moving sideways, but it wasn't on my radar at that point. But when you have dried up volume on a sell-off and then you have a week that pushes higher and then again a higher and lows put in sideways and volume dried up, it's basically the main thing I want to take away is that there's no real sellers. Like, there's just no one really watching it. There's no real sellers to get price lower. And so that volume dry up to me indicates that, all right, now we're just waiting for somebody with money to come in and accumulate and kind of push this thing higher. Any questions, by the way, Richard, or is that?
No, just I know you like to look for character changes in the stock. So I don't know if this is a good chart to show an example of that. Is it basically the first high or low, or is it more related to the volume signature that you're talking about here?
Yeah, this is totally just the volume signature, really. And I think my next example will kind of show a character change. Yeah, it will. So there's really no character change here because character changes from I mean, it's a broad term, but the specific character change that I look for, it's a subtle change in character that tips you off that a new uptrend might be beginning. And so this wouldn't be considered essentially a character change just because, I mean, we moved sideways and then it ripped higher. And so, there's no subtle characteristics about that. It's kind of just like, this is what's happening. And this I wouldn't consider a character change. It's just, this is, clearly accumulation with the big volume up weeks and the low volume down weeks.
Yeah.
So
one last thing on that chart. Sorry, Nick.
Yeah.
It's interesting to me that even before the huge volume spikes that you pointed out there, the volume before that looks small, but actually, if you look at the chart, it's massive compared to the entire volume during that consolidation, during that kind of neglect period. So, but the volume you pointed out even stands out even more. So it's crazy to think, how far this went. This is a powerful move and definitely a theme, and all these names should be studied from this year because they've made some spectacular moves and catalyst driven, all of that. So yeah, definitely a great chart to review.
Yeah, absolutely. And themes are super important because about 50% of a stock's move is related to its group. So, which Richard, but 50% of a stock's move is related to its group. So if you have two stocks, and this is what Stan Weinstein has said, if you have two stocks that look identical, one has other stocks in the group that look good and one doesn't, your chances of success are way, way, way higher if you buy the one that has the group strength behind it as well. Now, a firm was a character change, and this is one that I'm kind of just pointing out the volume characteristics and the change as well. But this was a character change, which is a little out of the scope of this presentation. But I will, the character changes you're kind of looking for what subtle cues that indicate the character, literally the character of the stock has changed. And so the first thing here is, a firm in 2022 clear downtrend. And so basically the biggest thing with what I call the character change is the high or low. And after you have this sell off in a firm, you have a big rally here, but then you don't put in the high or low. And so that just means that sellers are still dominant. And then again, we rally, a big rally, and it goes through both the 10 and 30 week moving average. So it looks convincing, but unless you have that high or low, the trend for me is still down. So even if this were to just rally, I personally do not get involved until eventually you're going to see some profit taking at least, and you're going to put in a high or low, and that's going to tell you that the trend is likely shifted. So throughout 2022, you kind of just have these rallies that keep getting followed up by higher lows. Early 2023, we have another rally. It's rejected. It looks kind of just like the previous ones, except this time we put in a higher low. And from here, we move higher. And you could see that this move higher is on very big volume. And then when we pull back, we make a higher low, and you could see that it's on below average volume again. And then we push higher, pull back, below average volume. This whole move right here is below average volume, and then push off the lows, big volume. And so we're kind of getting big volume push higher, lighter, this isn't like dried up in volume like the previous example, but it's below average. And so the biggest thing to take away from this is big volume higher, the volume is below average on the way down. And so now what's different in 2023 for a firm versus prior is we're making higher lows, which is a trend change, right? In a downtrend, you make lower lows. In an uptrend, you make higher lows. And so associated with these higher lows is also the volume characteristics that we want to see, which gives a really good opportunity to get involved. So each of these kind of pullbacks, offer really good opportunities to get involved in the stock, and buy a little, get involved on weakness instead of a breakout. And so one thing that I just want to point out here on a firm is if you were kind of looking at this base right here and you buy this breakout level, you could see that a few weeks later or like 2 months later, we pull back and it's going, like, we make a higher low, but that's now below the entry. And so you're likely going to be stopped out, or you're at least under a little bit of pressure to make a decision before it then does move higher again. And so what I love about taking advantage of these weakness buys is that, if you were to buy on one of these weakness days or weeks, when it does pull back here, you're still well above your cost. And so these pullbacks, if you buy a pullback, it makes sitting through a pullback usually a little bit easier. And so it just lets you be able to, as we mentioned in one of the beginning slides, sit a little bit tighter and think a little bit more clearly instead of being stressed, essentially. So the second part, we discussed up here kind of the volume characteristics of, you want to see a light volume on the move down, or when you're moving sideways, big volume on the move up. The second part here that we're going to touch base on, which is my favorite, is watching a base to determine if a breakout is likely to be coming. And so the three things that we'll be kind of focusing on here is shakeouts, tightening, price tightening or contracting, and then higher lows. I wrote high lows, but higher lows. So one of the first examples, so shakeouts, I should have put a quote here, but Richard Wyckoff, Richard, or
Wyckoff, I think.
Wyckoff?
Yeah.
Sorry. Yeah, Richard Wyckoff.
He's not around to correct you, so it works.
Yeah. He's got amazing quotes. I actually was not too familiar with him until I realized that a lot of the people that I looked up to him. And so I started looking into him a little bit more, and he's got a lot of, really good stuff. And one of the things that he taught me about shakeouts is that shakeouts are generally not random. They're used to scoop up shares before a breakout. And so it's not always the case, but it was one of the biggest lessons for me, because a lot of times I would buy a stock, I would get shaken out, and then the stock would just go higher without me. And that was something that played out over and over and over again, and was extremely frustrating. And I I could not understand. Like, I felt like the market was out to get me. Like, the market saw my stop loss and was watching everything I do. But then I kind of learned that, okay, these shakeouts are not a bug. They're not as random as I think they are. And the market is definitely not out to get me. But if I look at them a different way, these shakeouts generally occur before a move is about to happen. And so if we look at Fiverr here, Fiverr IPO'd in 2019, kind of just had this base, and then it attempted to break out from its IPO base, but failed. And so not only did it fail, like sometimes you'll break out and retest, but this was something that you could not hold on to if you're managing your risk correctly. You break out if you buy this breakout. The pullback is super aggressive, and so the aggressiveness of this failed breakout created a higher low. So you could see that each of these lows are getting higher, which is something that we'll touch on a little more in one of the next slides. But the higher low and the aggressiveness of the failed breakout it indicates there's likely a move coming, and this is the shakeout before the move. So we tried to move here, but then the stock aggressively stops most people out, and then comes back and makes this gigantic move. And so previously, I would buy this, I would get stopped out, and then I would put it off my radar. Now, I would notice, and it's something that the weekly charts help notice a lot more, is, okay, might get stopped out if I bought this breakout, but we pulled back and aggressively, like indicating a shakeout, and also put in a higher low. So within this area here, you're putting in a higher low, which tells you that the trend is up, and the aggressiveness of the shakeout indicates that, okay, this first breakout might have failed, but it's still likely going to break out. And so by understanding and becoming more familiar and studying shakeouts, you kind of see that after these shakeouts happen, there's a lot of opportunity to get back in. And so shakeouts now I don't view as a bad thing. Now I view them as, all right, let's pay attention, because a move is likely to be coming. MicroStrategy was another good example of a shakeout prior to a move. So for years, MSTR just moved sideways, and there really was nothing to look at here, or nothing going on. And you'll notice two things, even though this looks completely different from Fiverr, you'll notice two things that are kind of similar. One is you could see we did break out above this base and then failed right before price aggressively shook out. Same thing here, right? Price breaks out above the level and then aggressively shakes out. And this is, typical. You get people to buy, you get them, a failed breakout, and then you make it almost impossible to hold. And if you're a trader and you're managing risk and you bought this breakout, there's no way that you can hold through this. So sometimes you'll get stopped out of this and you consider, okay, this breakout failed, I'm not going to pay attention. But what I've learned, and that I want for anybody listening to this to take away, is if you get shaken out of a stock, don't take it off your radar, don't take it personally. Pay more attention and focus and understand that the shakeout isn't looking at your stops. It's just telling you that there is likely the move that you were originally waiting for is likely very, very close. So you have the aggressive shakeout, and then it kind of reclaims the base. And again, this is a weekly chart. So even after the shakeout, price just moved sideways and didn't do anything. So just because a shakeout happened doesn't mean that it's a buy. Or just because a shakeout happens doesn't mean that we're going to move up, maybe as quickly as we did here with Fiverr. But if you at least take into context the size of the base, how long we have moved sideways, and that the shakeout, even though we had a few months that nothing happened, this shakeout was on the right side of this base, that's something you're going to see play across all shakeouts. There may still be weeks left. It could be 1 week left until the stock actually moves. It could be 3-4 months until the stock moves. But the shakeouts are a key sign that tells you whatever base we're looking at, we're coming up the right side. And so we kind of get this shakeout and this reclaim of this base. And then one of the key signs that we'll touch on in the next example is price contracts a little bit and tightens up. And you could see here that after we kind of did nothing and reclaimed the base, we pushed higher and then consolidated right under highs. And this little consolidation here is this is something you'll see if you look at charts play out over and over again. You have a base, and here, we have the shakeout, but something that's really telling you we're likely coming up the right side of the base is price starts to consolidate right under highs or make higher lows or tighten up, and it's indicating that a breakout is likely coming. Now, Cloudflare is another example, and this one kind of looks similar to Fiverr, but Cloudflare is another example, and we kind of have this base here. It IPOs and it just kind of does nothing, moves sideways. It does break out, but anybody that bought that breakout did get stopped. You could see that we had this big shakeout right here. And one of the key things about this shakeout is we opened low and closed near the highs very aggressively. So this aggressive shakeout indicates that, just like the other ones, there's likely a move that is coming around the corner. So what I want to just stress here again is what I used to do is I would buy this breakout over here, and then I would get stopped out in a situation like this, and I just would not pay attention to it anymore. And that could not be farther from the truth. If you buy a breakout and then get stopped out on something aggressive like a shakeout like this, don't take it off your radar. Don't hold it either. You want to get stopped out. You have to manage your risk, because you don't know it's a shakeout until it reclaims and successfully, is afterwards. But when you kind of have this aggressive shakeout, pay attention. Put it back. Don't be afraid to buy back. Some of my best trades, I've had to buy 2-3 times before it actually worked. And so, do not, if you get stopped out on a shakeout like this, don't get frustrated and take it off your radar. You understand that it's likely about time that the original move you're looking for is about to happen, and stalk it for another entry. The last shakeout example here is EAT, and something that I love about weekly charts again is it shows you key levels that you may not see by looking when you're a little bit more zoomed in. And so this level here, we built a little handle from this base, and this handle is super significant when you zoom out and realize that, okay, the 2021 highs, we're kind of coming back, and we failed at here, and now we're building this little handle. And so instead of this just being, if you're zoomed in, like a 2-month base that is breaking out, now it becomes more significant, because this is, we've consolidated for like 2 months, and we're about to break out likely, but we're coming up to a very significant level, which just makes this more important. And you could see that right before it breaks out, it does not make it easy. So we come up the right side, And, you know, a lot of people probably got involved over here, and they make it almost impossible to hold on to. They don't make it easy. So we come back up where it looks like we're about to break out, but it fails. And instead of just consolidating a little bit and then having the big breakout, there's an aggressive shakeout. We open the week at $54-ish and then close the week at, you know, almost $70. And so this is something that is very hard to sit through in real time, and it's by design. It's on purpose. And so this, if you can see this level here, and you see the aggressive shakeout and reclaim, it becomes a focus, and should take a lot of, you know, you want to focus on it. Don't the biggest takeaway is don't take it personal. Don't think, I stink, I got shaken out. Look at it the other way. Pay attention. This shakeout occurred near prior highs during what's clearly an uptrend. Obviously, 2021 to 2023, right? We're in a downtrend, but over here, by the time we break out, this is clearly, we've been making higher lows for over 2 years, and so the trend is up. The shakeout happens, and then you could see that, you know, we just break higher, and this is a sign to pay attention. Now, APP, this is one that, you know, this was one of my best trades, and I talk about it a lot. This is one of the other things that I wanted to cover about bases specifically. So when what a lot of people do is they pay attention when a stock has momentum, and they don't pay attention when it doesn't have momentum, which makes sense, right? If a stock's not going anywhere for months, it's boring. You don't want to pay attention to it. But if consolidating and basing is part of an uptrend, and so bases are healthy, and if a stock has moved higher and then is consolidating, it's likely going to, at some point, continue its move higher as long as the general market is supportive. And so APP, we had this gigantic kind of move higher, and then it's resting. It has to rest. Resting helps it build up, you know, the pressure that it needs to have another leg up sustainably. And something that you'll notice if you study bases the same way that you study breakouts is they have characteristics, and one of those characteristics is higher lows and price contracting. So you could see here that APP, you know, a lot of people were focused on it, and then it started basing and sold off, and you know, nobody cares about it anymore. But if you're watching this, we make this low here in the base in whatever month this was, and then we look like we're about to break out. This breakout fails, but we make a higher low within the base, and then again we have a strong move up within the base, and then you pull back and you make another higher low. So now within this base, we've made 2 higher lows, and this indicates that, all right, it's the same as if you're looking at higher lows in a trend. The higher lows are a sign that you're coming up the right side of a base, and a breakout is likely near. Nothing's black and white in the market. It doesn't mean that a breakout is near, but anytime that I see higher lows within a base, to me it always pay attention, because we're likely coming up the right side, and you know, a move is probable. And so this big move here on APP was an earnings gap, and if you were looking at this base and trying to buy the move out of it, like one of these weeks here, you wouldn't have the cushion to hold this before earnings. So the way that I look at things is, if I don't have a cushion for earnings, I'm not going to hold, because then if we have a bad reaction, it's going to cut into my profits, or not my profits. It's going to cut into my, it's going to be a loss. Versus if you're up 10-15% on a stock, and they report earnings and they gap down 15%, at least you're not taking a major loss. You're just giving up your profits, and that's how I look at things. And this is one of the biggest advantages that I see to alternative entries that aren't breakouts, because if you were to wait for a breakout here, there's really no time to be able to get involved in this move. And a big misconception that I hear all the time about buying weakness or buying a base is that you don't get that immediate feedback that a breakout does give you, but you kind of do. It's just not as dramatic, because if you bought these higher lows, I mean, by the time earnings comes here, it might not look like much because this is a weekly chart, but if you bought these, if you kind of notice these higher lows and you bought right here, by the time that earnings were reported, you had a 30% cushion. So that gives you the ability to sit and hold through earnings and, take advantage of the much larger move that followed. Same thing you'll see in SMCI. So SMCI is on everybody's radar, moving higher, and then you kind of have this big trend stopper bar here where, funds over, the trend's done, momentum's done, and it starts building a base. And this is where most people just stop paying attention. But if you just keep it on I have a watch list specifically called basing, and I just check up on stocks that are basing. And if you just pay attention to them, you'll notice things. Again, we made a low this week, and then we made a higher low here, a higher low here, and then a higher low here before we officially we moved. And this was a crazy move. And so if you look at these two side by side, they're almost identical. You have the higher lows within the base, indicating that the move is coming soon, likely. And it's a way to not just buy a random stock that's basing and sitting in it for a long time without it going anywhere. By noticing some of these characteristics, like the tightening and the higher lows, you can get these entries that are earlier than a breakout, while also likely close to the breakout, so you're not just sitting there, the stock's not moving or doing anything. And then the last one for this is Dave, which I unfortunately never had a position in, even though I watched it the whole time. But this is almost identical to APP and SMCI. You have the big uptrend, and then you have this very tight and controlled base, and you have two higher lows before you move higher. And these organized bases, you'll just kind of notice these everywhere, where a sign that the breakout is near is just price is tightening and you're making higher lows, and it's a sign that, all right, we're coming up the right side. Any questions, Richard, on this, by the way?
I've got some, but I wanna come back to it. So yeah, I wanna hear your key takeaways first, I think.
Cool. So again, the last thing I'll say with Dave is earnings. I believe this week here were earnings, and so if you were to wait for this breakout week right here to buy, you wouldn't again have the cushion to hold for this move. And then even if you bought after earnings, after this move, this week here, you could see that it makes holding it longer term difficult, because price pulls back in and kind of comes back to your entry level before it does move back higher. And so by noticing and getting involved when it's a little bit quiet over here, you can kind of build that cushion that helps you sit through it clearly. So key takeaways from this presentation that I want to get across are buy during quiet periods. So you can enter positions when stocks are not on everybody's radar and they're basing. And to familiarize yourself with characteristics of bases, the same way that you do with breakouts. You study breakouts and what makes a breakout successful. You can also study a base and what indicates a base is, one, being accumulated versus distributed, and two, coming up the right side and likely going to return to its uptrend. Two, use weekly charts. You don't have to use them for everything like I do, but use them, at least check them to identify major levels, so that you can have more confidence when a stock does pull back. Three, create your cushion. So these alternative entries really do help build a cushion and let you think more clearly later on if you are interested in sitting and holding a position and letting it kind of work over time. This helps build that cushion, and it helps you think clearly and make better decisions, throughout the run of the stock. And then finally, have confidence. So turning points in the market are more rare than people think. Every time the market pulls back, everyone thinks, it's the end. And every time it goes up, people think, this is like they just want to chase it. It's going to go so much higher. And turning points, like major turning points in the market, they're rare. Well, not rare, but they're a lot more rare than a trend. Trends make up the bulk of the market, especially obviously an uptrend. And so when there's a trend, when the trend is up, 3 out of 4 stocks, 75% of those stocks are going to follow the trend. So at the end of the day, if you get a pullback, and even though things might look pretty ugly, things are red, if the trend is up in the market and the trend is up for that stock, and you've checked the weekly chart and identified a significant level that we're pulling back to, have a little confidence, because the trend on everything is pointing up. It could be, a top and we're heading into a bear market, but the odds is that if everything is trending up, the trend is going to most of the time continue. And so those opportunities are opportunities. They're not something to be as afraid of as as they feel in the moment. So these are the takeaways that I hope to get across, and I hope that from this presentation you'll see more opportunity in the market outside of just buying breakouts, and build a little bit more confidence, when a stock pulls back, because what I see all the time is people say, I want to buy this if it pulls back to here, and then it does. And when it actually happens, you're nervous to do so. And so hopefully this presentation will help you do it with a little bit more confidence going forward.
Yeah, great. Thanks, Nick. To start with, I just want to kind of maybe take a step back here and just, you mentioned at the very beginning, influences and developing your own style. Who would you say have been your biggest trading influences with regards to, how you trade today? Obviously, you're more weekly chart dependent than most traders out there. But who have been kind of the biggest help for you, or people who you've gotten the most out of, how they trade and how they trade?
Yeah, that's a great question. I would say William O'Neill was a huge impact. I think just one of the biggest wake-up calls for me to focus on weekly charts, or why I focus on weekly charts, was I would always have such a hard time holding winners. I would sell things when the market's strong. I would sell too soon. But whenever I would read William O'Neill's book, it just looked so obvious that these are holds. And I know it's hindsight bias, and everything in hindsight is, way easier. But what clicked for me was that his charts were weekly charts, and then I kind of just noticed that no matter how strong a move higher is in the market, no matter how strong the uptrend is, about 50% or more of the days are going to be red days. And so you just have to deal with that. And weekly charts, what he taught me, helped me deal with that, because you've got to sit through a ton of red days no matter what if you want to hold a winner. And the weekly charts kind of just help me mute that, essentially. So William O'Neill, for sure. Ross Haber, he was like my personal William O'Neill that I had. Oliver Kell, I took some stuff from as well. Stan Weinstein, my character change. If anyone's familiar with it, the setup that I call the character change is very similar and essentially a stock going from a stage 1 to a stage 2 uptrend. And so I would say that all of these guys were kind of my main influences. And that's kind of what I pointed out in the beginning too. Why I love the conference is because you see a lot of different approaches. And if I just tried to follow any one of the guys that I mentioned to a T, I wouldn't have as much success in the market. The biggest thing is you learn from all of them, and you take what resonates with you yourself and kind of make it your own, and that's what makes a lot of the difference.
Great. And then maybe you scroll up to one of the charts, maybe the app example, because I think there's some things I'd love to ask you. First, could you clarify a little bit about, I guess, when you're buying the pullback? Are you waiting towards the end of the week when it's pulling back and looks to be tightening up, or are you waiting for the week where it pushes higher off the higher low that's forming? How do you typically like to do it?
Yeah, so something I get asked a lot is like, if I look at weekly charts, do I only buy at like one certain time, or like when do I make my decisions? And when it comes to selling decisions, I try to always wait until the end
Friday.
of a day.
Yeah.
Not a Friday, but the end of a day. I mean, if I can Friday, but sometimes, if things are pretty bad during the day, I at least always want to give myself until the close, because the close is what's most important. And that's helped me sit through a lot of intraday shakeouts. But when it comes to making my decisions, even though I'm looking at weekly charts, for the most part, I will buy anytime there's something at a level, any time of any day. So when if I'm looking at this APP here, this kind of muted week here is the first sign that, okay, this might be a higher low. And keep in mind this APP example, I was buying APP since the character change over here. And so this is a stock that I was watching. I was watching this every day for months, like over a year. So I was very familiar with it. But yeah, like it's not so much about waiting for anything specifically, but when you kind of have, if you're watching this base and you pull back and it seems like, we're making a higher low, you have the 30-week moving average catching up a little bit too. So you can, I hate to say anticipate, because it's kind of, you don't want to anticipate something, but I mean, it's true a little bit how I do things. Like if you kind of get this muted week here, you could anticipate that we'll put in a higher low, because at this point, if we don't put in a higher low and your stops are below the actual low, your risk is managed. The percentage is not much. So if it does not put in that higher low, you're still managing your risk, and that's all that matters at the end of the day. But at the very least, the following week, when it starts to come back up and move above that and indicate that, okay, this actually is the higher low, then that's when you would put on some as well, if that answers your question.
Yeah, so moving above that prior week's high, that tight week's high. Yeah. And then for your stop loss and how you manage risk, is it typically at the low of the week that you enter, or is it, in this case, it might make sense to put your stop at the low of the prior week, which is kind of the turning point, the actual higher low itself?
Yeah, so I can't remember, exactly how I manage this one in here, but a lot of times, like I like to say that you just have to make sure your risk is managed, and it's also logical. So if I was not involved in APP at all, and I was just looking at it kind of right in this area here, and we start to push above.
Maybe
this
zoom in
week,
if you can, Nick, to make it really clear. Yeah, that's better. There we go.
Nice. So, if you kind of see that, all right, like this could be a higher low, and then we have this week here start to show a little strength, and it's a little more indicating that this actually might be a higher low. If this was on my radar for the first time here, I would just put my stops at the low of the week. Putting stops at the low of the week is kind of one of the ways that I get involved and I'm able to manage risk quite a bit, but that's essentially what I would do because we obviously, sorry, it zoomed out. We obviously opened lower this week than the prior week. And so if I set my stops at the low of the week, if we closed below that, then my thesis for getting involved, the higher low, is invalidated because now we're undercutting and we're closing lower. So if I would use the low of the week essentially to get involved and manage the risk.
Excellent. And then you kind of said this in your key takeaways, but it's a really good point to reiterate. A lot of traders watching this probably primarily use daily charts, maybe even intraday charts to execute. What would be the biggest things that you'd recommend them pay attention to on the weekly chart if they're always going to look at a weekly chart as they're finding ideas or right before they're about to place a trade or to find trades? What would be some of the key things for them to look for on a weekly to suggest that they're buying at a proper moment, they're buying a stock with potential? And yeah, I think the EAT chart is actually a good example of this as well. You pointed out the big level that you might not be aware of if you're focused on just the daily chart in the last 100, even 150 days of price action. But yeah, what would be the most important things for traders who primarily look at dailies to pay attention to on weeklies?
Just take note. When I look at charts, I like to look pretty far to the left, and also it just makes it easier to kind of see patterns and personality a lot. So like you said, this EAT example, this is a really good example because if you're zoomed in here and you're only looking at 2024, by the time this situation over here happens, the stock's already up quite a bit. It's almost doubled, and it bases a little bit, and so you have a stock that's in a strong uptrend. It's basing a little, and it's about to probably break out higher, which is significant. But when you're zoomed out and you look at the weekly chart and you see that, okay, not only is all that valid, just like you've identified, but we're coming back up to prior all-time highs, which is a major level. And then, that just makes it all the more significant. So what would just be a strong trending stock about to make just a breakout and move higher now becomes a little bit more of a focus because, okay, when you zoom out, this is, instead of this being a 2 or 3 month base here, which it is, we're kind of working on like a 3-year base, which the longer the base, the bigger the potential breakout. So it would become a lot more of a focus for me, understanding that, okay, this isn't just a little base in a strong stock. This is a major level, and it also increases the probability. So you're not just having people that are looking here to kind of break out of this. You're having a longer term view, like anyone who's watching this consolidation and people who are watching this prior high. It all converges and just, it's a trifecta, and just increases the odds of the breakout sticking, and also the power potentially behind it, and the size of the breakout that it could sustain.
And Nick, I want to ask you a question about patience because like you've mentioned, William, big influence. A lot of the best market leaders, they move for maybe 18 months during their great trends. So there's patience with holding a stock. There's also patience with actually entering a position, stalking it, finding the proper entry. what recommendations you have for traders, to improve that skill, because I think it is a skill that you actively have to work on. So yeah, any thoughts there, either for improving your patience with finding trades, looking for the greatest opportunities, and then also once you're in a stock, actually holding it for the meaningful move?
Yeah, definitely. I would say the easiest advice and the easiest thing to do for stalking trades and being patient with entries is just if a stock is trending higher and then has like a sell-off, or just stops moving higher, maybe just moving sideways, don't take it off your radar. Pay attention to it. I like I mentioned, I have a watch list that's just for basing, and I'm just kind of monitoring stocks that are basing for characteristics that we mentioned previously, to indicate maybe it's a time to start looking for an entry, get involved. That's kind of the easy part. I would say is just make a watch list, kind of monitor stocks that may not have momentum if they have a prior uptrend and now they're just consolidating. That's the easy part. The hard part is the waiting once you're excuse me, once you're in the position. That's a difficult part, and that is why now I only use weekly charts myself, just because the more that you watch, and the more that you watch, the more reactive you're going to be. And so earlier I mentioned that even in the strongest uptrends, 50% or so or more of the days are going to be down days. That for me was one of the biggest wake-up calls, because if even if the market is trending higher, but half the days are going to be red and down, that's just something that I have to deal with. So each one of these candles that you see on the chart represent a week. Obviously, it's a weekly chart, and so you can already see that even just looking at the weekly chart, holding, like if you, let's just say you bought here, sitting through these down weeks is tough. It's and in some cases you'd be stopped out, but that's tough enough. So now to know that, okay, if you go to a daily chart, each one of these candles is now 5 separate candles, and so instead of having one candle, and I don't check the market once a week. Like, I watch throughout the day, but I'm looking at weekly charts, and it just mutes the moves,
calms it down
quite a bit.
Yeah.
Yeah, so it's like I'm seeing all the same levels as I would on a daily chart. It's just they're way less drastic. You're kind of just over a week seeing one candle move up and down and form a little bit, and the structure of everything else is in place, versus when I would be on a daily chart. There are, like, there's benefits to daily charts that you will miss on weekly charts, especially if you are trying to be a little more active and capture maybe only the momentum. But the downside of that is just that you're seeing a lot more movement, and it causes you to think a lot more, and it causes you to react a lot more. And the weekly charts just help keep the big picture and the overall structure like top of mind and in focus, and it just helps reduce the amount of movement that you see. I think that like something I mentioned previously was that I will try to wait, as long as I have a cushion, I will try to wait until the close to make a sell decision, because a lot of times you'll have intraday shakeouts and the market closes strong. And, if you're sitting there and kind of just, it's just like, if you're watching the market, it's always going to give you a reason to react. And so the biggest takeaway is just, I found weekly charts, I can kind of watch the market and it helps me be less reactive and just like I said, keep the bigger picture in mind. And so I would say, you know, identify if you want to hold winners longer and you struggle with that, identify why, and it's likely because you're overthinking moves, or you're just reacting too much. And so do what you need to do to reduce that reaction. Yeah, basically.
Yeah, I think that's really true. We often as traders work so hard to enter a position at the precise moment, but then we don't let the asymmetry of a trend work in our favor and let it actually play out. And I think something that's helped me with that in developing my sell rules, and I'm definitely a faster trader than you, but my objective is to hold base to base versus maybe trade the entire longer term trend. You're comfortable sitting through a base. I get bored, I guess. I don't know, or I just can't handle the pullback to the 50-day or below the 50-day. So I like using the 21 EMA, which gets me out earlier, but I won't hold for that major move all the time. But one thing that's helped me is kind of like what you've done here, markup charts of great winners from the past. And I know with the Trader's Handbook, we just marked up a lot of weekly charts. I don't know if you want to share that, but this process of building model books and studying great winners really reinforces the need of, not just finding entry points where you can manage risk properly, but, letting that trend work. And I know you put a lot of work into the weekly chart version. This is a quick glimpse if you want to show it, and maybe run through maybe one of these charts and then, flip through a bunch. But yeah, we marked up a bunch of the greatest, AMD is such a great one when Lisa Su took over, led to that character change. Here's AMD more. Anything you want to share about this weekly chart model book, or just, key takeaways that you had, working on this and building this resource?
Yeah, this you could see there's over 100 charts here, and everybody who purchased the Trader's Handbook gets this is one of the one of the multiple model books that you get for free, and this is one that I spent a lot of time putting together, and it reminded me. One of the big things that we talk about in the Trader's Handbook is building a model book, and building this model book for people who get the Trader's Handbook reminded me how important that is, because even though part of this presentation was on one of the characteristics that a move is likely near is a shakeout, that's something that I've known for years, but I've still I still happen to fall victim to it sometimes, and I'll get shaken out and I get frustrated, and then I'll miss a move, and I fall victim to it, and you learn a lot and you forget a lot. And building the model book, there's so many like aha moments where you're reminded what's important, or even if you're not being reminded and this is your first model book, it makes it very clear what's important. The building a model book and seeing certain things play out over and over and over again in winning stocks is the quickest way to build your confidence. Because without that, you're just going off something that you study or that you've heard. And when you learn something or you study something or you hear something, if you then, let's now compile hundreds of examples and look at them, all of them, and when you see things kind of play out over and over and over again, it's one of the best ways to get that confidence for when it happens in real time. It's super important. So one of the examples, I'll go over Tesla in here. So Tesla in 2020 was a monster, an absolutely monster stock, and the longer the base, as we mentioned, the bigger the move higher likely. Or the bases are essentially consolidations. They're resting periods. They allow for the longer the base, the more sustainable of an uptrend that could likely follow. And so one of the biggest things is outside of the length of the base is also the size of the uptrend previous to the base. So bases are pauses in uptrends most of the time, and that is one of the biggest characteristics. So Tesla had a 900% uptrend in 2013, and then it was off everybody's radar for about 7 years. Like, it just didn't do anything. And obviously, like, you don't want to buy in here randomly, because you don't want to be sitting in a stock that's doing nothing for forever. And this base, you could see the top of the base is over here that I highlighted. But until we got to this in 2017, obviously the top of the base would have been over here. So this would have been a breakout that, if I was watching at the time, I probably would have bought, and then it would have went nowhere, and I would have been stopped out. But when it did finally break out, you'll notice a few things. So we pushed up off over here. We pushed up, and then let me zoom in. Hold on.
Yeah, perfect.
So we make a low again and touch the bottom of the base, and this just reiterates structure. So it just reiterates, okay, it bounced again at this same low that it kind of has for 7 years, and so it just reiterates the base's structure. And then you kind of have it tightens up a little bit, and then you have a big volume push higher over here, and then a few weeks just sideways trading tight as the 10-week moving average catches up. And consolidating, this is the key here. Like, throughout the base, where there's a lot of up and down days, but the biggest sign here in Tesla was we have a big week that pushes up drastically on big volume. If we go down here, big week that pushes up on big volume, and then consolidates right under the top of the base and gets extremely tight, and just waits for the 10-week to catch up. And so the big surge in price and volume indicates, okay, so right here, the lows of the base were respected. It just reiterates the structure of the base. Now all of a sudden, okay, it's perking up. There's a little interest coming into the stock. And then after you have a big move like this, it stays and consolidates very tightly near the highs, which, if you have a big move like this and it's not being accumulated, you're going to see anyone who's involved in it kind of rush for the exit, and price is going to pull back and just fall apart. And so the fact that we have a big push higher and then price just kind of goes sideways tightly at the highs just indicates that, okay, no one is trying to sell this. It's getting super quiet right under highs. A breakout, it is likely near, and then we break out of it. And you could see obviously that before this move actually happened, we pulled back hard quite a bit. And so this, I was not holding this at this moment. And so if I wouldn't have been able to sit through this. I wouldn't recommend that anyone does. But the biggest takeaway here is like, look where it fell to. It pulled back, and the low was the top of this base. And this is what weekly charts help so much with. If you're zoomed in, maybe this pullback, these 4 or 5 weeks here, look kind of random. It might look like this was just a failed move, but the fact that the low of this pullback ends up being what was resistance for 7 years, that tells you that something in this stock has changed structurally. Resistance has now become support, and so even if you didn't get involved here, after it retests over here and kind of confirms that the structure has completely changed, you want to pay attention. because the character has definitely changed at that point. So
Yeah,
this is one.
And
Yeah.
just to add context, obviously that's during the March 2020 correction, that severe drop to that prior base. So it was market dependent. And you mentioned earlier, the trend of the market is the most important force, but completely agree. That respect for that level shows that institutions were holding it there. They were supporting it there. And that's what led to that amazing move thereafter. So yeah, really good example to study. Did you have another slide of Tesla that you want to show? Yeah, you zoom in. Yeah, this is perfect. Yeah, so this showed exactly what you're talking about, the tight area, and that big move was on an earnings gap. I think it was their first profitability, or where they basically proved profitability. I think they were also ahead of schedule on different catalysts, like their factories being created, and it was just a lot of good news, and just flipped the script about, the big question with Tesla was, can it be profitable? And it proved it during that point, and that showed up in price and volume action and led to that big move. Yeah, anything you want to add on Tesla, Nick?
No, that's I mean, if you want to dive deeper in this, obviously, get the Trader's Handbook. You'll get this and a couple other model books, and this is an extensive resource. So I don't want to spend too much time on this, but yeah, I zoom in here and, kind of zoom in on the characteristics that I mentioned of, this is the type of action that you see when you're coming up the right side of the base. You kind of hold tight near highs, and then the fact that we retest the prior breakout level is, if I always say that a stock breaking above a significant level, like breaking out of this multi-year base, that's a good sign. A stock pulling back and then retesting that level, successfully using it as support, that is a great sign. So if breaking above a level is confirmation, then coming back and retesting that level is double confirmation. And so if you had confidence buying here, you should have double confidence, buying here. And that's just structure that the weekly charts help make super easy.
Or if you're a daily trader or a faster trader, that respect for that level that you'd only see really on a weekly chart should add confirmation to, hey, focus on Tesla, look for a spot relevant to your style, your time frame, and look for an entry point, because institutions held it there. So yeah, that's perfect. And I think maybe some good work for folks is to study Tesla, because I think just going through the chart of Tesla, whether it's on a weekly or daily chart, can teach you so much about how big moves form, the weekly formations, all of that. So I think that's some good homework for folks. And again, yeah, if you're interested in this weekly charts model book, it's one of, I think, the 6 bonus model books that we included with the Trader's Handbook, in addition to exclusive webinars, additional articles, resources, all of that. But yeah, the link to that will be in the description. I definitely recommend it. But Nick, anything else you want to close with? Any last takeaways that you want to share with everybody regarding using weekly charts or alternative entries?
I'll just say that the motivation for this presentation was that I just always, it's a repeated thing that I hear people get nervous when a stock is pulling back to buy, even though you may have planned to buy that pullback, but when it happens, you get nervous. And so uptrends, pullbacks and uptrends are healthy. They're what is able to keep the uptrend sustained and moving. And so even if you're a shorter term trader and you don't want to really use weekly charts, just check the weekly chart at least, to identify a level, because the rubber band analogy that I mentioned previously, a lot of the times any pullback is going to snap back with the trend, for the most part, right? As long as it's a healthy pullback, which is most, it's just unless you have something that gaps down and everyone's running for the exit, but most pullbacks are going to snap back with the overall trend. So when you're in a strong uptrend, and so it really just the same way with a breakout. If you buy a breakout, you have to set a stop to manage your risk. If you get a pullback, you're doing the same thing. You're just setting your stop to manage risk. And so there's really no difference at all, and you should have confidence in I have more confidence personally buying weakness in an uptrend than strength in an uptrend, just because The wind is at your back to the upside, and so the weakness is generally a rubber band and short-lived and snaps back. So have a little confidence, because most of the time the market is in a strong trend.
Yeah, great. Well, Nick, thank you so much for your time. To everybody watching, hope you enjoyed. Let us know in the chat right now what your key takeaways were. And if you're enjoying this, please go ahead and leave a like down below. It supports us immensely. And subscribe if you haven't yet. And we'll be right back with the next presenter. Cheers. All right, welcome back, everybody. It's my pleasure to introduce the closer of today's TraderLion conference session. We've got Jared Tendler. Jared is a mental game and performance coach. He is the author of several fantastic books on the mental game of various disciplines, including the mental game of poker and, of course, the mental game of trading. He is also the lead educator of the Trading Psychology Masterclass that we worked with him on to create that resource a few years ago. And he is also the founder of the Mental Game of Trading Live. Jared, thank you so much for taking the time to speak with us today, and really looking forward to this topic. I think it's very timely and really important as well. So thanks so much for your time.
Absolutely, Richard. Great to be here as always. And again, kudos to you guys for doing so much for St. Jude's. It's a great charity, and happy to be supporting both it and this conference and what we're trying to do to improve the performance of traders. And in this case, I would say help to avoid some of the bigger calamities that can ensue. So, yeah, happy to be here. And again, for those of you who are perhaps familiar with my work, know that I try to talk about overconfidence on a regular basis. Those of you who are new, if there's any reticence at this point that this topic is not relevant to you, that's exactly how you know that it is, because overconfidence is a very sneaky little sucker. And if you're not careful, right, it can be a cause of some significant pullbacks in your performance. Maybe you have gone through those kind of boom and bust cycles earlier in your career. You certainly don't want them to occur, but those big ups and downs in your P&L, sometimes it's overconfidence that is preceding the big drop-off. And that's kind of it in its biggest form. So if you're going to kind of prevent those, you got to really be able to be sophisticated in your understanding of this problem. And so, yeah, it's a big one, even though it's not always talked about. I'd say, in general, it's rare that clients come to me saying like, "Hey, I'm overconfident, help me," and it's not usually until after the problems ensue that they come. So before we kind of got too deep, I know Richard kind of gave a great overview. The only thing I'd kind of add here is I've been doing this work for over 20 years, and specifically I've been working with traders for over a decade, including fund managers, institutional traders, and many retail traders, right? So kind of running the gamut from 9-figure traders all the way down to those just getting started, trying to pass funded challenges and kind of get their feet wet in this game. So I have experience of what overconfidence looks like, and ironically, it looks very, very similar, regardless of where you are as a trader. I've had conversations after 2020 with some big institutional firms that had a number of traders who were just struggling to deal with the scale of the wins that they had in 2020, and so that you think would look a little bit different than the newer trader who is just kind of beginning to see some success, and yet it actually doesn't. The markers are very, very similar. So if we were to kind of encapsulate overconfidence in a single picture, it would be this. The cartoon character that does not know that they have run off a cliff, only to soon discover that they have. And if you kind of think about like your P&L kind of steadily rising, sometimes your confidence goes right along with it. And if you assume that all of that, all the wins are, solely as a result of your competence, solely as a result of your genius stock picks or positional moves, it's easy for you to start to think that you're a little bit better than you are. Easy to start to project the future. Easy to start to think that you're actually on solid ground when the ground is actually shrinking beneath your feet. And that's oftentimes where the shock comes from. I would argue that in many cases, like revenge trading comes on the heels of that shock, right? When the bubble bursts, not necessarily a stock market bubble, but your own overconfident bubble bursts, you're very rapidly going to kind of crash. It's met with a lot of anger, and you're instantaneously trying to get yourself back up to where you were before. So yeah, here we are, Wile E. Coyote, one of my favorite cartoons growing up, just before the crash. So if we're going to do our job well today, I'm going to help you to avoid the crash. All right. Another way to think about overconfidence, it's very simply is believing a lie. Right? You're believing something that is untrue about the market, about yourself, about your strategy, about your proficiency as a trader, about your emotional control, about the value of your preparation. I mean, there's a large swath of stuff that you can be overconfident about, but it basically can come down to just believing something that is not true. And so before we kind of dive too deep into overconfidence, let's make sure we're all on solid ground with regards to like what confidence is, because a lot of people get this wrong. Okay, confidence is an emotion, and just in case you had any hesitation about that as a truth, Daniel Kahneman, right, the founder of cognitive bias, is one of the most renowned behavioral psychologists ever, said the same thing, right? Confidence is an emotion. Right? Now, confidence is an emotion that reflects the beliefs that you have about your skills, your experience, your wisdom, your strategy, right, and the value therein. And so it's obviously very easy to have that belief, have that perspective, have the perception of all of those things be altered. And if it's altered in the negative way, where you're kind of thinking too lowly of it, well, then that's where a lack of confidence is going to take hold. And then, of course, overconfidence is believing too highly in the value of all those things. So we're going to talk later about like what's going to provoke that, what's going to cause you to have your vision be warped, right? But the simple answer is that trading does a lot to help you. Okay? The false feedback that you get in the short term can very easily be the fuel for it. But you kind of have to want to be deluded, right? You want to have to be swept up in the illusion, and understanding what those flaws are that are going to make you vulnerable to that is what we're going to talk a bit about today. Okay, so it's really, really important that you have an understanding of the situations where overconfidence is most likely to occur for you. If you're going to have any chance of stopping it, we've got to create the vision for yourself in those moments. It's sneaky. It's overconfidence feels good, right? You're excited. You're euphoric. There's kind of a bit more adrenaline kind of coursing through your veins. You end the week happy. They're like, why would anybody not want to experience those things, right? You're in this business to make money. You're excited for a variety of reasons. Like, why would you want to take that away from you? Well, the reason is because you don't want to get carried away with it. Too much emotion, any emotion, including overconfidence, starts to be blinding, starts to shrink that higher brain function, and reduces your ability to have the kind of clarity and proficiency that we want here. So look, string of wins, right? Your best day, best week, best month, best year, right? You all kind of have your own threshold for what's going to provoke the overconfidence. Even just a string of wins and the consistency of it can do it, right? Because sometimes it's the time frame. I've heard so often it's like, I do great for 3 weeks, and then all of a sudden I give back a chunk of profit. And it's probably not just because of what's going on in the market. It's probably because something has begun to deviate, right? You're no longer on that solid ground. Your mind is beginning to get kind of swept up in the lie, and we'll talk more about those lies. but something that's going to produce that overconfidence. But as I said, right, for some of those institutional traders, it wasn't like best days, weeks, or months. It was like an entire year where they're getting, 3-4x their normal payouts for the year, and now all of a sudden they think everything they touch is going to turn to gold. So you kind of, again, figure out kind of where that threshold is for you, where it's going to tend to occur. And look, for some of you, it's one single trade, right? Newer traders have a big trade, and all of a sudden now, intraday mistakes are going to start to occur. All right, next one here. Your hard work is beginning to pay off. When you've been struggling for a while, right? Trading is challenging. We know that. Sometimes it takes years. Very often it takes years to really start to feel like your hard work is paying off. And when it does, man, like it feels good and it's exciting. And now all of a sudden you kind of start to get ahead of yourself. Thinking that you've kind of cracked the code, thinking that you figured it out, thinking that you're never going to go back to situations that you were before. All of which are not like so wrong, but you can't know what's going to happen in the future. So the idea that it's directionally correct to think about what's going to happen in the future is not accurate, right? Like when your hard work is paying off, it really is just confirmation of everything that's come before. It's not giving you any predictive ability about what's going to come. Solid progress with your mental game. Okay, so here, you've worked hard on technical and strategic skills, but now you can become overconfident with any aspect of your mental game, including fixing overconfidence. So I'd argue, make sure that you come back and revisit this presentation a month to 2 months after you've begun really working diligently on your overconfidence. Because you can very easily start to get ahead of yourself thinking, now I got this thing licked, I'm never going to become overconfident again, making the exact same mistakes that you would make from a technical and strategic side. And it doesn't have to just be overconfidence, it can be any aspect, right? You're making significant progress with fear, with FOMO, with anger or revenge trading. You're no longer lacking confidence, right? And this is, again, a classic example of where this presentation is relevant for all of you. Those of you who may have, or traders that you know who only really experience a lack of confidence, right? It's so common that after you kind of climb your way out of that kind of doldrum, now all of a sudden you flip to the other side, right? And now you're more at risk of becoming overconfident. And I should say too, being overconfident does not mean that you're an a-hole. Does not mean you're arrogant. Does not mean you're a boisterous, blusterous, kind of personality. Right? I have clients who would never see themselves in that light, and in fact are fairly shy. They're introverted. It's not even about the overconfidence in relation to other people or related to your personality. It again goes back to just that believing in a lie. So yeah, those people who tend to be introverted and had dealt with more lacking of confidence, they find themselves having to deal with this problem. And it's confusing because they never would have kind of put themselves in that way or in that place. All right. Pre-market prep gives a directional bias. Kind of seeing things very clearly. You've been in a groove, you've been making money recently, and yeah, just like feels like another day that things are just gonna kind of line up and click in place. And what's the lie here? It's very subtle. It's just that change from a probabilistic style of thinking to one that is more predictive, right? And just that small deviation, right? You go from believing that your strategy has a 99% chance of paying out today. Again, pretty damn high, but a little bit of openness, a little bit of room for error here versus like, no, I'm going to make a killing today. New setup quickly delivers. You've done a bunch of work, backtesting, researching, looking for some new tactics, some new strategies, some new setups, maybe even some new signals, new symbols, and like immediate results. Like feels so good. All that work immediately paying off, right? Same thing. And yeah, it just creates that kind of that spark, that excitement, that euphoria. And again, what happens? It no longer becomes that confirmation of what has come. It becomes predictive about the future. All right, let's talk about some of the bigger signs of confidence. right? So situationally, right, just give you a handful, but there are plenty of others. The signals of overconfidence is really, really important to distinguish, as I said, because if you can't see this problem, you can't stop it. And by and large, many of you don't see it, which means that your skill here, your vision here, is weak. So don't, again, make the faulty expectation, faulty assumption, right? Believe the lie that you are capable of recognizing all of the signals of your overconfidence right now, because I promise you, you are not. Right? You can know a lot, but you can always know a little bit more. So use the next couple minutes here as an opportunity to, I'm going to talk about a handful of signs and signals, but I want you to be thinking for yourself, right? What is happening in those situations, right? How is my mentality changing? What's going on with my emotional state? What's changing with my focus, with my decision making, with my perception of the market? Maybe just physical state, right? What are those signals? Because it is vital that you are able to recognize that deviation where that overconfidence has started to take hold. All right, so raise a profit target because you're convinced it's going higher. Again, objectively speaking, this may not be wrong if you are a discretionary style trader, but if you're one that's very systematic and this is clearly a rule that you're breaking, well then that's a problem. Okay? I am totally fine with you in the future, like recognizing that a handful of trades, given the market conditions, had a little bit more room to run, right? And so you really examine those and try to figure out what might be some distinguishing qualifications, distinguishing factors or criteria that might give certain trades a little bit more room to run. When you make these types of decisions on the fly, spontaneously in the moment, they seem genius to you. They seem like the right thing to do. It feels right. But is that intuition? Okay? Intuition is your highest level of decision making, but it's one that is very balanced and clear-minded, one that is absorbing market-based data, interpreting it, and making some of those discretionary decisions, making some of those adaptations. You're not doing it because you're convinced it's going higher. You're doing it because there's something that you're sensing here that may not be entirely conscious, but there's a qualitative difference, right? There's a qualitative distinct difference between experiencing real intuition versus overconfidence that is now manipulating your mind into believing that you have something when you actually don't. That's why it's so vital, because these two, like intuition and overconfidence, can really be kind of close at times. It's like, oh, it feels like it's the right thing to do to raise this profit target here. How do you know that, right? Well, you know that if you can distinguish intuition from overconfidence. You can do that and have those qualitative differences. Feeling invincible, like you figured it all out, right? Obviously a more extreme version of this. Objectively speaking, you might read this and think, oh no, I never think that way. I never have that feeling. A lot of you do. And you only kind of sense it and recognize it in retrospect after you begin examining more closely like the nature of the feeling, right? You've had a couple great winning trades. You top tick the market, like, I'm a genius, right? And then how do you start, like, then now all of a sudden it's like things start to feel like they clicked, like you figured it all out. Like now you've, I'm not saying you feel like you've solved trading, but there's a party that thinks maybe you won't lose again. Maybe you won't have losing weeks, losing months anymore. Again, you might be right, but you can't know, and that's the problem. Profits make you feel like you're playing with house money. I mean, come on. How many of you, get stuck in this spot, right? You're having a great day, you're having a great week. All of a sudden now, it just gives you permission to get a little bit loose with your risk management. You jump in a little bit prematurely. You know which direction the market's going to go, so obviously it makes sense for you to just get in, right? Doesn't matter that things haven't quite lined up to you. Things ripping up or ripping down, whatever direction you're thinking here. So, and it's not that big a deal because you're still up money. So, take a couple paper cuts, not the end of the world. Except what happens, right? Once you do, maybe take that loss, maybe some frustration creeps in here. a little bit of annoyance, and now you're convinced you're still right, so you try again, right? So it's like, okay, you're playing with house money, you got a little room for error, but that first domino falls, and now you've left yourself open for a lot of other mistakes, right? And things can get quite bad. And I would say for the newer traders, this is obviously more important, because this is like the first thing that oftentimes leads to those busted accounts, right? Especially in those kind of prop firm challenges, or even if you're funding yourself with some small accounts, right? You're up money and you got room to breathe. It's not your money that you'd be losing back. In your head, you're thinking that, like, well, I mean, how ridiculous is that, right? You did all this work to earn and make some positive P&L, and now you're just going to kind of play with it, let it ride up. Overconfident. Imagining what you're going to do with all the money you make, right? Obviously, this is the dream, the Lambos, the being able to quit your job, buying houses, like whatever the stuff you want with it. But frankly, it can even be more practical, right? Just having some utility, like, oh, like I could use a new set of tires here in my car, right? This is going to be able to help me to pay the mortgage here for the next couple months. Again, you start kind of changing the nature of the game. Like, I mean, if a basketball player makes a bunch of baskets, obviously they're not exactly good parallel here, but like they make a bunch of baskets. Like, they're not thinking about the utility of that outside of basketball. And yet, right, the money that you're accruing in your account, right, needs to stay there in your mind, because that's the scoreboard. That's the game that you're playing there. You start thinking about the utility of it. You're at minimum just now distracted, but at worst, now there's some overconfidence here, and so you begin to think it's yours, right? But if you're still trading that week, you haven't actually pulled the money out to use it in some utilitarian fashion, like that, then it's not actually there yet, right? The overconfidence is kind of playing around with that money prematurely. You're just getting ahead of yourself. Wanting to always be in a position. It's oftentimes described as just a lack of discipline, right? The lack of patience, the impatience. But I would argue, if you knew the pain that would ensue, you're just not going to want to get in as quick, right? It kind of sobers you up pretty quickly, right? But the wanting to always be in a position sometimes can be an indicator that you're just too confident about your strategy, too confident in yourself to be able to navigate various market conditions and just kind of figure out how to scale in, scale out, whatever, to assure that you can make money. And yes, like, we're plenty of traders who are able to do that, right? But they're not always wanting to be in a position. They're wanting to be in positions that they know they have the ability to navigate. Refusal to admit a mistake, and this can come both from an intraday time frame of refusing to admit that a particular trade was a mistake, right? You get it in the wrong spot, and then you're kind of convincing yourself that it's okay, right? You can kind of get away with it in the spot. But it also can be more of a bigger kind of macro piece, right? Here you are, like, learning from some of the best traders in the world. Maybe you're in a trading group, working with other, more experienced traders. You got a mentor, and you're convinced that you know better than them. Maybe you do, right? But if you're like defensive and denying your own fallibility here, that's different from being open-minded and learning and having a good argument as to why what you did was correct and formulating a strong argument. But if you're just kind of being a bit defensive and denying the reality of a mistake or refusing to admit one, well, that to me is overconfident, right? You're thinking that you are right. And again, you might be, but the lie is that you can be that way without having a bit more evidence. So I'd say these are some of the more dramatic, more common signs, but precision matters a lot, right? You have to be able to catch that earliest warning sign. Otherwise, you're at risk. So here are a few more of the subtle signs of overconfidence. Okay, increasing position size indiscriminately. Again, there's not clear rationale for it. It's an on-the-fly adaptation that could be intuitive. So again, for you have to make those that distinguishing, find those distinguishing characteristics between intuition and overconfidence. Careless. You can be careless in a lot of different ways, But I think a very, very subtle one is the belief that you don't have to work as hard pre-market, right? You've been in a groove, positions are all working, you're a swing trader, right? Everything's kind of moving in the right direction. Like there's kind of nothing to do. Really? I mean, you're not still going to check some levels. You're still not going to make sure that you're kind of tighten on, the range of outcomes that could still happen here, and, ensure that you're, I would say sometimes managing the emotional EV of some situations. Again, when you had some significant mental game issues in the past, you made some progress with them, like you don't want to take some bigger steps backwards. So if you come into a day where you're a little bit careless because things are all working and you're not really aware of, okay, well, what actually happens if, there's a 10% drop in the overall P&L today? How will I react to that? If you're not ready to know that you're going to handle that well, or you're just assuming that you will, then you might get steamrolled in that moment, all right, and make some of the mistakes that have been maybe, kind of classically characteristic for you before, where maybe you remove some stop losses, right? Trying to hold out hope that those positions are going to reverse and get back in your favor. So, look, carelessness can happen in many places, but I think sometimes the pre-market prep one is the one that gets missed frequently. Overstimulated watching the charts, kind of that itchy impatience, excited. So again, I mentioned before, just that impatience is there, but sometimes just getting too glued in, too much of that tunnel vision. It's that overconfidence, believing that you can kind of make something happen, like really wanting to push the action, wanting to make something happen, looking for, the smallest indication that you have something viable here. Come on. Confident that you can make back earlier losses. Again, it's not wrong to think that way for some of you. It's wrong to think that way if your confidence starts to make you take positions that are not within your strategy or system. And especially after you take some earlier losses. It's just easy for B and C level trades to look like A game or A level trades, fat pitches that you can hit, and they're ones that you have to really step back and pass on. So the conviction there, right, can easily get a little excessive. Checking open P&L more. Again, I think that's getting a little bit more towards that utility of the money, getting a little bit kind of jacked up, excited by how much you're making. Hindsight bias. So I know those of you who follow my work, I've talked about this as an underlying flaw, but I wanted to kind of characterize it here because it actually can be viewed also as a signal of overconfidence too. And so hindsight bias basically means that you believe that your ability to kind of know what you should have done means that you're going to be able to now have some predictive powers. The hindsight bias is really subtly dangerous because you're not really doing any work. You're not really making any changes to your strategy. You're basically just saying, oh, that's what I should have done. And the assumption is that that's what I will do in the future. Right? So the next time a position sets up this way, I'm going to take it. The next time, because it obviously just ripped, even though it's slightly outside your system, or I'm going to hold on to this trade a little bit longer, or I'm going to cut it off a little bit earlier. Like whatever it is that you could have done better in this individual trade or on this day or in this week, if you're not actually adapting your strategy, in some cases you really shouldn't, because sometimes you're doing this to try to retrofit and find a way to make money regardless. But the assumption is that you can now have some predictive powers when you don't. So the hindsight bias is by its nature overconfident because you're making determinations about what you would have done afterwards when you have all the information. I mean, frankly, if that was the case, like, we'd all be, billionaires, right? So it's not really how it works. All right.
Sorry, Jared, to jump in, could I add a few more that maybe I've experienced myself and
Sure, yeah.
and I've noticed for sure. First, I want to double click on the position sizing because I think that's a big one that can have a really negative impact on your account too. So I think that's one to really look out for, especially going back to a previous slide where trying new setups that maybe you don't have the experience with, but you watched a webinar where they walk through the setup, it works perfectly in the examples that they show there, and I'm gonna make 10% in my account, try that new setup tomorrow. You want to go for it. Then I think also one thing that I've experienced myself, and I know others have, is it's a little bit where I forget exactly what you said, but it goes along with like over trading and believing that the setup that's evolving and that you're stalking is 100% going to work. And so you enter prior to what your rules say is the proper entry point where you can risk management. You enter before the pivot point is what we call it, where you want to enter before the pivotal moment. And you're believing that's going to work, so you're trying to get ahead of the crowd, get ahead of and force things. And that can cause a lot of issues, especially when the market's been trending well. You're feeling good. You've had a lot of good trades. You feel like you can make, you can do no wrong. And then you're entering, you're trying to get in ahead of the crowd and just force things to work for you. Then I want to mention there's a little bit of there's a joke here, but there's some truth to it too. We have something that goes along with checking open P&L more, called the significant other indicator, and this was developed by he coined the term Leif Sorede. He's a trading champion. He's on Twitter. He's also a presenter at the conference. And what the significant other indicator is basically when you feel the need to talk to your spouse or partner about how well you're doing, and I'm really trading well at this moment. We're making a lot of money. We're doing well. We can go on that vacation. When you start to get that feeling that you need to tell your spouse, your significant other, about your performance, maybe it's time to again think about whether you're being overconfident, check yourself, and revisit your rules, or otherwise try to prevent that emotion of overconfidence from negatively impacting your account. So it's a joke, because we joke around, don't tell your partner about how well you're doing, but there's a grain of truth to it for sure. So I just thought I'd add a few of those that I know people watching have experienced. And let us know in the chat right now, which one of these do you most relate to? Which one do you think impacts you the most? Because I'm sure some people it might show up more in position sizing, some more in forcing trades, or some of the others that Jared mentioned. So just thought I'd add a few of those.
No, that's great, Richard. I actually had the spouse one in here, but I took it out at some point. So no, it is super common. And again, I think it's important in trading because you just don't know what's going to happen in the next days or weeks or months. And so unless you have a spouse that really understands the nature of this industry, the nature of this environment, it's overconfident because you can very easily kind of front run yourself in a sense. All right. So Richard just alluded to it, right? Want to know what those overconfident indicators are for you? Really, really vital that you begin to start to detail, right, the version of overconfidence that you are in particular struggling with. And in particular, what is that first signal that indicates you've become overconfident, right? And I would argue that those of you who haven't really examined this before, right, you probably have some ideas now. And, it's great to see a bunch of them, kind of thrown here in the chat. But I would argue that this is not the first signal. Right, you're going to have the ability to get more subtle, find those earlier signs that you may not see right now, and it's just going to take a little bit of time to uncover what they are. Right, so you have a starting point today, right? Hopefully, some of the things we've talked about so far have kind of triggered your memory, jogged the memory a little bit here, and given an indication of what you might struggle with. But then pay attention over the next few weeks and write down on a piece of paper, any instance where you start to deviate with your strategy, where your emotions start to really get kind of jacked up a little bit, where you're feeling really happy, feeling really good. And just check yourself, right? Just take a few notes down about kind of what's going through your mind, right? Are there any indications of some excessiveness here? Because I don't want you to question the solid confidence. But if you're not really sure where the overconfidence starts to occur, you do in the short term just have to be a little bit self-reflective and check yourself. Check whether or not you have that solid, stable confidence, or whether you've deviated into excessive confidence, which in its earliest stages may not be that problematic. It might actually make you more money, but certainly can accelerate into some bigger problems, as we've seen. Okay, and once you've done that, I think you've done enough to protect yourself. You can always do more, and the more includes this. Okay, those of you who know my work understand kind of the mapping process that I go through. Talk about this in detail in the Mental Game of Trading. Walk you through it in the Trading Psychology Masterclass and how to actually create the map for yourself. But this map right here, right, it's kind of scaling in the deviation between that optimal or ideal confidence, and then beginning to see the escalation of overconfidence. Takes some time to work through, right? I think with this particular client, it was about a month to really nail down, because you're not experiencing overconfidence every day, right? Sometimes some of the issues like FOMO or revenge trading happen more frequently, right? And again, this is not true for everybody, but my point is, like, sometimes these issues don't occur on such regular frequency where you can really get a good sense of the patterning that exists, in a couple days or a couple weeks. You might have to go through maybe a full quarter. Maybe it's not until 6 months or, towards the end of a year where you're going to have a full understanding of the scale and the intensity of the overconfidence that you'll experience. Okay, so I'm just going to go through a couple of these, but the overall idea here is you want to have a clear description of what that ideal confidence looks like for you, right? And what that does is it gives you a reference point. Like anything that deviates, in this case from an overconfidence standpoint, but look, we talked earlier about lacking confidence, both of which are going to become more obvious to you when you clearly know what real solid ideal confidence looks like. All right. So first signal for this client was some impatience or just a little bit of excitement here, right? I know my plan is good and jump the gun. So exactly what we were just talking about. Right, now level 2 here is that kind of can't lose mentality starts to take hold a little bit more. I would argue the can't lose mentality is present at level 1, right? You're jumping the gun because a part of you believes you can't lose, right? You wouldn't jump if you knew the trade was going to lose. You are certainly not going to jump the gun. So here, that can't lose mentality starts to become more obvious, and there might be some specific thoughts that are evidence of that, right? But there's a bit more, again, convincing of where the market's going. Believe I have the skills to take a trade and win without adhering to my process. So just now an even bigger, kind of deviation. It's not necessarily directionally kind of within it, but now it's like, all right, you're in this suboptimal trade. Now maybe you're trying to squeeze more out. Mistakes kind of start to multiply. And again, if the trade wins, right, and this is a kind of prime example of kind of being off that cliff, thinking you're on solid ground, right? You're making mistakes that aren't getting punished. Thinking it's more about you than it is about the market rewarding you in a unfair way, right? You're unfairly getting rewarded, right? It's too much luck. So, all right, believe I have the skills developed will allow me to trade out of any trouble, right? So very, very common. And then, of course, assume any trade I take is going to be a home run. And when a couple of them, land that way, and all of it kind of gets reinforced. Now, what we deal with on the left-hand side here is more of the mental, emotional, kind of physical signals. The technical changes, right? And it's not. This is not a technical change you're trying to make. These are the ways in which it just shows up exactly, right? The way in which your strategy, your decision making, your perception alters. So get in a little bit early, take on too much size, right? Now trading multiple tickers at the same time, right? Stretching your mental bandwidth beyond limits, cutting corners, as I talked about before. Now taking these 50-50 trades, and now taking impulsive trades with reckless size, right? This is overconfidence at its most extreme, and unfortunately, right, kind of like a parabolic move, right, that is going to have perhaps a bigger crash. That's kind of what happens here, right? Is the overconfidence really starts to accelerate, maybe fueled by success, right? You get to level 5 because you've done really well, only then to have, a significant pullback in your own P&L, your own performance. All right. So for those that want these worksheets. They're freely available on my website, right? This is a confidence profile is kind of where it's, the map kind of lives right in the middle of it. So jaredtendler.com/worksheets.
Yeah, and we'll link it in the chat too right now, so be on the lookout for that link.
Perfect. Thank you. All right. So awareness is not a solution. You're going to correct the overconfidence. It's not just about the recognition of it and the like kind of management of it, because like any emotion, you can create like a pressure cooker like effect where the more you're trying to gain control, the more you're trying to suppress and keep at bay that emotion, it's only going to kind of raise in intensity, and then it can kind of come screaming out. And that's true of FOMO, revenge trading, anger, and obviously overconfidence as well. So if you're really going to correct it, you've got to figure out the flaws, the biases, the illusions, right, that you are succumbing to, that is allowing your emotions or allowing your confidence to rise this high. Here are a handful. Okay, this is not an exhaustive list. Talked about this a bunch already. Just predicting outcomes, right? Right. That deviation between prediction versus probabilistic outcome. Right. There's a dramatic difference, and if you don't know the difference between those two things, then you are clearly overconfident. Right. Probabilistic thinking is how traders make money. Right. Your job is not to know the future. Your job is to make probabilistic bets about the future that have a positive expectation. When you believe that with absolute certainty something is going to happen. Now, you might be right at times, right? But you can't know that long term, right? There's you're not a psychic. We'll just say that much. Right? Now, the illusion of control, the illusion of emotional control. Again, the false feedback that the market gives you helps to reinforce this, right? When you're getting a lot of wins, perhaps at a higher win rate than normal, maybe thinking that the discretionary decisions you're making as those adaptations are to increase your win rate is a result of your own doing versus the market just handing you a bunch of wins based on recent conditions, right? Of which then when conditions are less stable and you're taking the same amount of trades, and things even out in the long run in terms of your kind of overall win rate. And that does not mean that you can't be improving, but generally speaking, changes in win rate don't move as quickly as they can based on recent results. Illusion of emotional control I was alluding to earlier, right? It's this belief that you have firm command and control over your overconfidence or over any issue that you have, right? And recent success can kind of blind you to the risks. It takes a lot longer to kind of truly resolve emotional reactions, including overconfidence, than most people realize. So this illusion is a sense of mastery that's just far more premature. Right? The illusion of learning, this like finding it flaw. I think Richard mentioned it, and one of your examples here. This like just sense that things just kind of clicked, like I've like kind of figured it out. And when you actually ask somebody like, well, what do you actually mean when you say you figured it out? Let's say, well, I don't think that I'm going to make money forever, but like, something's clearly clicked, and now I'm going to be good for a little while, or now I've got kind of turned the corner. I'm never going to have the mistakes of the past. Like, the reality is that you don't know that yet. It's premature to expect or assume that you've kind of found it and now you're good. Like, again, have the proof be there historically. Don't make the assumption about what's going to come. I can't tell you the number of traders or clients that I've worked with who have said that, oh man, I'm so close. Like, working with you would be kind of the last piece of the puzzle. Like, you don't know that. Like, I'm not a magician here. Like, we don't know how many more steps there are for you to take. Maybe there's 15 steps just with me. Is that okay? Well, maybe there's a few more steps after that from a technical standpoint. Once you clean up some emotional stuff, sometimes you get a better vision of some of the real mistakes or the imperfections that exist within your strategy. Right? So this idea that you kind of are like one step away, I can see things just around the corner. It's an illusion. Your mind is trying to gravitate towards some certainty to make it feel a little more comfortable in a dramatically uncertain environment, right? Rather than getting better at dealing with uncertainty, you're kind of latching onto something just for that perceived safety, that perceived confidence, and it actually blinds you to some realities. High expectations, right? Obviously, there's a big one. High expectations yourself now start to get realized. Well, now you are who you think you are, and it's just easy now to scale up, size up, maybe quit your job, make some bigger decisions in your life because you're realizing what you thought you always could become. And again, you may not be wrong. You just don't have enough proof yet. High expectations oftentimes create this because you'll have expectations of like making money every day, and when you're doing it consistently, it really can start to feed the belief that you are the one that is producing all that, and obviously that's not the case. Dunning-Kruger effect. This is an interesting one. There's two sides of the Dunning-Kruger effect. One is that for people that are so underskilled, they do not know that they are underskilled, and then that produces overconfidence. And in this case, many of you, I would argue, at the beginning of today, perhaps were that way if you came in here thinking that you knew enough about overconfidence, right? You were overconfident in part because you thought you had more skill than you actually did. And so how do you know if you have enough? I'm not trying to get you to become on the other side of the Dunning-Kruger effect, which is people that have a ton of skill oftentimes undervalue that skill and then become underconfident or lack confidence. So neither is optimal, right? We're trying to kind of converge, not on a neutrality, but on something that is true. And the reality is in trading, in the short term, it's hard to know what is true. And that's okay, right? But you can build some confidence and conviction being open-minded. So having that be your truth. Like I'm 80-90% certain that my strategy is winning at this rate and winning in this market, in these market conditions. I'm just not getting rewarded now. So you're able to kind of deal with the realities of the situation, right? And that's where confidence is its most stable. When the beliefs that you have about yourself, your strategy, your style, your experience, your wisdom, etc., it's resting on some fundamental truths, and you're not convincing yourselves of things that are true that are not, just for the sake of giving yourself more confidence. Because at any level of the game, you can be confident. You don't have to have more skill to be more confident. You just have to have a greater sense of reality with your skills, with your knowledge, with your strategy. All right, lastly, wishing. This is some of the more extreme cases where you really get swept up, but those wishes drive some of the top end kind of euphoria because maybe you're making some of the money that you always dreamed of. You're wishing that trading could be a source of infinite money, and start having some success, and those wishes start to feel like they're coming true, and it really sparks some of that intense overconfidence. So if any of these have resonated for you, then you've got to find some very distinct corrections that you can make to each one. You craft injecting logic statements that you're bringing into those real-time moments where the overconfidence is beginning to kind of creep up. You hit it hard and aggressively, and it should dial back a little bit. You should feel yourself kind of get a little bit more on solid ground, and you might have to keep doing it again and again, especially if you are in a good spot where the market is you are a bit more in sync with the market, and making a good bit of money and having some higher consistency than normal, right? You're going to have to use this regularly and often to keep yourself solid and stable. And if you do, it might get to the point where you're actually under more tension than you've ever been before, because now your results might just start really getting outsized. You've been used to kind of undercutting them, right? Having the overconfidence lead to some pullbacks, almost like a little bit of a breather, like, okay, you kind of reset again, reversion back to the mean, so to speak. The mean here is like reversion back to your comfort zone. It's very common at this point where you're making some progress with overconfidence for your results start to get outsized, which then of course is going to put more strain on your mental game, potentially leading to even bigger overconfidence. So just don't think that you have full command of this, right? Just because you've had some small success over a short period of time, right? We're talking about months of consistent progress before you start to feel like, not that you have it controlled or gone, but until you feel like you have some solid ability to manage, control, and correct it. And then even longer to firmly prove that it's gone forever. But I would always maybe kind of keep in the back of your mind the potential for it to come back, just to keep that small little window so you're not overconfident about the fact that you'll never become overconfident again. All right. So in the chat, what was your biggest takeaway? Was it perhaps spotting the signal that you're overconfident, right? The one signal for you? Is it just understanding confidence in general, right? Maybe you didn't understand some of the kind of basic fundamental principles of confidence. Or was it some of those flaws that are driving your version of overconfidence? Curious to hear what your thoughts are there. Mentioned it before, right? If you want more information about my system, my strategy, I've got some handful of tools for you. First off, got the Trading Psychology Masterclass, something that I'm still incredibly proud of in terms of how well constructed it is and how well it walks you through my system for being able to actually correct, right? Not just manage or control, but to correct permanently these issues that you're struggling with, obviously, namely overconfidence, but FOMO, lacking confidence, discipline issues as well. Obviously, the mental game of trading, incredibly happy with how well it's continued to do now, just over 4 years since it's been released. So that's exciting. Also have the mental game of trading live. So if you want to have basically the benefits of one-on-one coaching with me, just at a fraction of the cost, right? Kind of have these strategy sessions on a monthly basis where there's kind of a lot of interaction with other like-minded traders like yourself. You can kind of find some accountability for people who are all there working on their mental game. And of course, as I said earlier, you can download free worksheets, profiles included, but also a handful of others that will help you to enhance and use my work at my website, jaredtendler.com/worksheet. So with that, thanks everybody. Thanks, Richard, for having me here today. And yeah, I know it's a little bit on the later side for some of you here on a Saturday, so appreciate you sticking around.
Yeah, awesome. Jared, first of all, thank you so much. I always feel a little bit more confident about my mental game, but not overconfident. I've got a few more questions that I think would be good talking points. First, I really like what you said about making mistakes that aren't being punished, because I often think there's a strong market that just kind of boosts everybody. Newer traders think they've mastered it, or get overconfident about their abilities, and then like Wile E. Coyote, the market turns and you just fall. And the mistakes you are making, improper entries, not managing risk correctly, oversizing, then in a down market or even just not as strong a up market, that's where you get the drawdown in your account. So I think that's really well said that you mentioned there. Would you be able to go back to the map of the technical changes and emotional changes? Because I have a few questions related to this. I think this is excellent. You walk through for all the different emotions in the masterclass, constructing this, which is excellent. A few kind of questions for food for thought for people who haven't been through that. Any tips for people as they are building out their first one for confidence here? Are there any reflection questions that you found helpful working with clients to help get them to different levels? And basically the idea, again, is to map the level of the emotion from, one would be, not too overconfident, and then 5 is where things really impact you and you get way stretched on the other end.
Yeah. The process, I think, kind of begins with the daily note taking. So certainly any time that's occurring, you want to be writing down, again, some of the thoughts, the emotions, or from a technical side, like the changes in your strategy, perception, etc. I would have, I use a data collection worksheet. I didn't want to kind of go throw too many things at you today, but again, that's freely available on the website. But it basically is just a kind of handy reference guide to be able to kind of walk you through step by step how to kind of gather up the data. But like piece of paper with these kind of data points is enough to get you started. But I would have it in your mind to do every day, and then when you recognize that your strategy is deviating, something's getting a little bit off, you're getting a little bit too excited, some of those early warning signs are kind of going off, then you start writing down in real time kind of what you're experiencing. So you do this for a couple days, a week, longer, and each one independently can be viewed as almost like a puzzle piece. And basically what you're going to do is at the end of, let's say, 2 weeks, you've got 7 situations where overconfidence took place. You look down at them and say, okay, well, let's now try to scale based on degrees of intensity. What I've kind of captured in this first one, that was pretty bad. Okay, so maybe that's like a 4 or 5. And this one is like, okay, I clearly made a mistake here, but it wasn't nearly as bad. So maybe this is like a 2 or 3. And then, towards the end, you were getting a little bit more sensitive and like, oh, well, this was like, I didn't even make a mistake here. I was just thinking about deviating from my strategy. I actually didn't do it. I was just thinking about P&L. I didn't even check it, right? So like that's a more sensitive example, so that might be a level 1. So again, I think the process is, give yourself some time to gather up the data, gather up the puzzle pieces, and then you're basically trying to ask yourself the scaling question. Which version, which example is more or less intense than the other examples I have, and you're just kind of trying to line them up together. And look, you do the best you can at start. You might only have a couple data points to start with, and that's fine. But as you go along, you keep this top of mind, and 2 weeks later, now all of a sudden you're doing well again, and you're looking at this, and then all of a sudden something else kind of pops up, something new that probably was there before, right? You just couldn't see it. Now, you become aware of, and maybe it's like you're just leaning into the screens more. Like that's reinforcing that tunnel vision.
Yeah, excellent. And then, defining stuff with language really helps you understand it and hopefully realize it in real time. You also mentioned that the one that you think might be your level 1 might actually be your level 2 or 3, and there's stuff early on. I imagine it would take, you just need more time to get that deeper insight into what might actually be the first signs of it. And any other advice for people as they dive deeper into to try to get as close as they can to recognizing that they're starting to go to the overconfidence levels?
Yeah, I suppose it would just be that revisit. Like, so let's say you've got a good understanding. Every 3-6 months, you might want to revisit it. Because there might actually be some changes, right? It may not be necessarily things that you could have seen before in the past but didn't. It might actually be I'm factually having more success. I've now quit my job and I'm being successful, or I'm buying a house, or now I have kids. Like as things in your life change, you may need to be updating the details just to keep it fresh. The creation of it, right? It takes as long as it takes. If it takes you a week because you're pretty well knowledgeable, if it takes you several months because it just doesn't happen that often, and self-reflection, self-awareness is new for you, like that's okay. Don't let the difficulty of the task deter you from its value. That's the thing, is you're trying to create some insurance for yourself, some protection for yourself against the cost of overconfidence. And so if it takes you a little bit more time, that's what it takes.
Great. And you mentioned at the very start that even institutional traders, you've worked with them to address this. For the more experienced traders out there watching this, is there anything you would say to them about the benefits of, doing this process, doing this exercise, and anything else to look out for when you've got your trader with more experience in terms of, identifying overconfidence in their trading?
You obviously want to make more money, so you just calculate how much overconfidence costs you. Number one. Number two, the line between intuition and overconfidence is going to be really, really narrow at times. It gets wider the better you can distinguish it. So, yeah, I would really spend some time trying to determine what those indicators are for you for that intuitive state, or what intuition type decisions look and feel like. So, that could be characterized as like the ideal confidence for you. Same general idea, because there are going to be very distinct qualitative differences when that's present versus when you're in that overconfident state. So yeah, I mean, there's a number of institutional clients I'm thinking of. Right? Again, they're not immune to it. In some respects, they're more at risk for it because, the size and the numbers are quite large. So yeah, that would be kind of the first thing. The second is, if you're watching this, right, you're clearly going above and beyond the education that's being provided for you, in that institutional environment. So yeah, this is going to take more work on your own outside of it. Don't let the environment itself kind of leave you vulnerable here, because if there aren't other traders that you're surrounded by who are regularly kind of working on this, or just aware of it for themselves, you can very easily kind of get sucked back into that kind of group think where everybody, is now a genius and everybody's just kind of crushing it, and who's going to be the sober one in the room here, right? Just that risk of getting kind of sucked in is obviously greater for you than independent traders. But look, we certainly see trading communities where it can happen as well. But I think on an institutional level, just the nature of the fact that you're all highly skilled, highly capable, highly confident can just lead you to just some excessive beliefs, about the recent success you've had, and B, maybe even just about how you're all thinking about the directionality of the market. I mean, it can easily just kind of get you a little bit just blind, and that blindness is not absolute. It's not like closing your eyes or having your eyes open. It's just losing just a little bit of that clarity, and that can make a very distinct difference.
Excellent. And just one last question, because you mentioned, finding that ideal level of confidence that kind of blends into intuition. Is there a benefit, especially for the more experienced traders out there, to kind of have it be more of a spectrum from underconfidence to overconfidence, where they're trying to identify also that other end of the spectrum where they're becoming too underconfident and that's causing issues? And, again, that would help them identify that medium where they kind of operate at their best. Is that something that you found with clients? Or, obviously for the traders just starting this, probably just 1 to 5 is probably the way to go. But that might be helpful for more experienced folks out there.
It can be, yeah. I think if you know that you experience a lack of confidence, then absolutely. But not everybody does. And, one institutional client I'm thinking of does not, right? It's just, overconfidence is the problem. If he's kind of trailing into another emotion, it tends to be anger, and sometimes that's on the heels of overconfidence. Sometimes it's just from losing and being out of sync, and then making some mistakes, and so there's not really a lack of confidence for that particular client. But yes, if you are somebody that is going to kind of oscillate between underconfident and overconfident, then finding the full spectrum is beneficial, because sometimes you can very easily kind of jump from one to the other. There's a kind of in a period where you're struggling, and then all of a sudden get a couple wins, and then you're kind of flying off the other side of the coin. I guess I will add one more thing here, especially for the institutional crowd or the more experienced crowd. You can be aware of, sometimes overconfidence can be an indication of actually like growth and progress. You kind of get excited because something does actually start to kind of click in your mind a little. It makes a little bit more sense. And that doesn't mean that you're going to make mistakes. It doesn't mean that you're overconfident because you feel that way. It becomes overconfident when you start to think that now there's some predictive powers associated with whatever just happened. So, that can be a kind of a sensitive, subtle version of this, right? But the thing that I think is the worst part about that is that it hijacks like the recognition that you deserve, right? You've clearly put a bunch of time and effort in, either actively or passively, to be getting yourself better. I say passively, meaning just trading, right? Just the act of trading can make you more skilled. But regardless of whatever you've done, like, you have moved your A game forward, right? You are a better trader today than you ever have in your life. And to then have some predictive power kind of come from that, just like hijacks the recognition that you deserve, like the pats on the backs, be like, dude, well done, like you're doing great, like. But that doesn't mean anything about the future. It just means everything about the past, and that recognition, you deserve that recognition. But the overconfidence sometimes removes you from getting it, basically.
Great. Perfect. Well, Jared, thank you again so much for your time. Any last words or key takeaways you want folks to have from today about overconfidence, or just working on your mental game in general?
Yeah, just don't be overconfident about this problem, because it's a risk for everyone. Even those who think that that are lacking confidence. Sometimes actually there are times where you're lacking confidence, and it's because you're overconfident, right? You're thinking negatively about the future, right? And all the losses and the pain that you kind of foresee is causing you to feel bad about yourself, but it's actually overconfidence about the future that's causing you to feel bad. So again, it's a risk for all of you. It doesn't mean that it's going to be something that you deal with on a regular basis, but the more that you're aware of it as a potentiality, I think the safer you'll be, and get to kind of preserve your growth, preserve your progress, preserve your profits, and just keep you leveling up as a trader.
Great. Well, Jared, thanks again so much. To everybody watching, I hope you guys enjoyed. Again, let us know your favorite takeaway in the chat, and we'll be right back to close things out. Thanks so much. All right, so that concludes day 3 of the 2025 TraderLion Trading Conference. Thank you guys so much for attending. We had a fantastic group of presenters, so I hope you guys enjoyed. Let us know in the chat right now who was your favorite, and maybe what was your favorite takeaway from any of the sessions here today. I look forward to hearing your guys' thoughts. Again, thank you so much to everybody who attended. To get the most out of the presentations, to get the slides, all of that, definitely just a friendly reminder to register for the free VIP pass. This gives you access to all the recorded material, all the slides, the bonus resources we're creating, and enters you into free giveaways of masterclasses and more. So definitely go ahead and scan this, or click the link that's basically in the chat, as well as in the description of the stream. A huge thank you once again to NinjaTrader Live for helping sponsor this year's conference and helping us put this together. This is a fantastic resource that I highly recommend you check out. They're basically live 6 days a week with futures-related educational material, featuring excellent educators. Basically, you can tune into NinjaTrader Live for daily futures trading, real-time market coverage, and actual strategies. So definitely check them out. Scan this QR code, or you can also click the link that's in the chat or in the bottom of the description below the stream. So definitely check out NinjaTrader Live if you're looking for additional material, educational material with fantastic traders on futures-related strategies. All right. A friendly reminder again to check out the Trader's Handbook if you haven't already. This is our book that we worked tremendously hard over more than a year to put together, and we're really excited and proud of how it turned out. We've got fantastic reviews again, over 400 plus reviews, rated 4.9, which is pretty rare on Amazon. So if you haven't yet picked up your copy, you can scan this QR code right now to pick yours up, or click the link that's in the description. Here's a testimonial from Stan Weinstein himself, the author of Secrets for Profiting in Bull and Bear Markets, which is a foundational text. And he says the Trader's Handbook is a clear, no-nonsense resource for anyone serious about improving their trading. It's rooted in common sense, sound technical principles, and most importantly, discipline. The authors focus on price action, trends, risk management, and teach you how to build a real process, not just chase opinions. It's a practical book that respects and emphasizes the core truth that the tape tells all. I recommend that you pick up a copy for your trading library. So that's from Stan. Go ahead and listen to him if you haven't yet. And if you've already read it, let us know in the chat what you thought about this resource. All right, and we've got another fantastic lineup of speakers here tomorrow. We're kicking things off at 9:30 a.m. Eastern with market wizard Peter Brandt discussing risk management and a general conversation about what it takes to succeed in the markets. This will be fantastic. Then at 11 a.m. we've got Pax Trader discussing everything from trading opening range breakouts to his journey as a trader, going from the pits at the CME all the way to now finding success trading electronically. This will be fantastic, sharing many hard-won truths. You don't want to miss this one with Pax. Then at 12:30 p.m., we've got market wizard Jason Shapiro discussing 3 characteristics of a strong risk-reward trade. That will be great as well. Then at 2 p.m., we've got Deepak Upal, who is a top performer in the U.S. Investing Championship the past few years, both in the regular division and the money manager division. He's a fantastic trader, and he'll be discussing positioning for outperformance, tactics for strong returns, and sharing a lot of trading case studies as well. You don't want to miss that. And then at 3:30 p.m., we're closing things off with our very own Ross Haber discussing CanSlim in modern markets, how he's tweaked what he learned directly from William O'Neill to basically work and improve performance for him in modern markets where things are faster. And this includes alternate entry tactics, tighter risk management principles, and other great tips that you can apply tomorrow to improve your performance. Or not tomorrow, but Monday and in the future. So this will be fantastic, and just a great lineup. Again, let us know in the chat, who are you most looking forward to hearing tomorrow? There's going to be some great stories, amazing lessons as well. So I look forward to each of these speakers, but let us know who you're personally looking forward to the most. And with that, thanks again for tuning in today. Leave a like down below on the stream if you haven't already. Again, this is recorded, so you can scroll back at any time and revisit any presentation you want. I'll be adding timestamps as well, so you can easily find different parts. But again, a huge thank you to you guys for attending. We couldn't do this without you. A huge thank you to the fantastic presenters today, and we'll see you guys right here tomorrow for the next session. So thanks again, and we'll see you guys